is probably going to lead to people maybe moving out of their sort of target market and maybe going back up to Target or whatever is above Dollar General in the pecking order. And then the other thing is inflation is going to maybe have some increase in cost for them in terms of sticker costs, and that might actually impact some of the low to middle income families, which is sort of their wheelhouse. That may sort of hit their demand a little bit as well. So it's a little bit more of a cautionary note, and they just bumped him down to perform from outperform. So I don't think it's anything to be overly concerned about. The other thing, though, is, when you're an analyst, and usually you always expect to see a lot of analysts have, if they have a perform rating on a stock, that price target's going to be somewhere at least at or above where the stock is trading at. And right now that stock price is around 206 or 207, so below where Dollar General is trading at right now. So I certainly would think there's probably going to be a little bit of a cap on upside in Dollar General unless they can come out in future quarters with some pretty incredible numbers.
Okay. So DG right now is under a little bit of pressure. I want to shift over to electronic arts because the gaming stocks have been a very specific quarantine style trade around their earnings, though they've been pretty calm. And I think that one's very noteworthy because you think very clearly these tied to the dynamics of the stay-at-home life. But electronic arts, little changed after their earnings. I know it might seem interesting to talk about a stock that's little changed on a day like today, but a lot of companies with these direct ties to quarantine got blasted. As soon as they showed big growth, investors said, okay, that's it. But electronic arts, Activision, these are steady right now. And I think that is quite impressive in a market that has been dumping tech and quarantine winners.
Yeah, and I think really it comes down to management being able to lay out sort of this path forward. And right now, if they're saying, we're just going to find ways to monetize more out of the existing customer base, whatever that might be, that is something that probably is going to give investors a little bit of a pause. But really what we're seeing out of electronic arts is when they had some incredible quarter last year, when everyone was sort of stuck at home, then you started seeing, video game sales. If you're sitting on the couch, you're going to just fire up one of the EA Sports games or whatever else it is that they have out there. But what they're doing now is they're talking about going into mobile. And so you are seeing that there's going to be some costs associated with that, but they're really focusing on moving into the mobile gaming space. And if you think about some of the numbers we've been hearing from these, these smartphone companies, think of Apple, just some of the numbers they have in terms of the installed base that's getting out there. That's probably good for Apple in their services business, but it's also can be good for companies that are in mobile gaming. And EA is sort of seeing that as their path to continue to grow on their customer base, and if nothing else, at least not give up too much of what they put on in this same quarter last year. So there's a little bit of a tough base effect going on for them. And it actually, we're talking about CPI, that base effect was low, and now it's making it look extremely high. It's almost the opposite for EA Sports. They had incredible numbers that were extremely high, and now they're starting to get back to sort of normal revenue numbers. You don't have everybody flooding in the door at once, and so now analysts just sort of need to reset, see what they're doing. The revenue guidance was above what was expected, but the earnings per share guidance was a little bit below. But I think analysts are sort of giving them a little bit of leeway on that. They're not giving them a full pass, but I think they're going to wait and see what happens with a lot of these acquisitions, because when you are aggressively acquiring companies and you have a lot of the other video game makers out there probably going for same companies, that can drive up those prices. So that can maybe cause some sort of weird effects with their earnings or bottom line, at least for the first year or two.
Okay. All right. So for video games, maybe we've got a more sticky trend to some degree than kind of a one-time need and a one-time push into a service or a tech that was essential over the past year. It's just has awoken the gamers, myself included. Let's talk about one of the big winners this morning. This is kind of a bizarre story, kind of out of nowhere, Sean. Norton LifeLock is up 5%, adding on to a gap higher yesterday. I don't even know if a lot of people knew this was a traded company, but the big jump around perhaps some of the concerns regarding cybersecurity, the oil, the pipeline hack, and then a bunch of upgrades. What's going on here? I mean, this just like came out of nowhere. This is like one of the least watched tech companies out there, and it's just crushing it right now.
Yeah, well, I think certainly the Colonial Pipeline has shined a light on this, and you probably have every company, probably every individual starting to ask how secure, their devices are and their networks are, and they're probably going to go out and do a little bit of spend to beef it up a little bit, and that would favor a company like Norton. But they were already in a little bit of a turnaround plan. I think they're still in phase 2, and the analysts were sort of looking to see how they felt they were executing on this phase. The phase 2 of their turnaround plan, and how the catalysts were coming along. And I don't know if you can have a better catalyst than something like Colonial Pipeline, and you're seeing one of the largest pipeline operators come to a grinding halt due to a hack. Even you assume they would probably have some pretty good security going on there. So you start asking yourself, well, what do I need to do if I'm just sitting here with my iPad? So that can incrementally drive probably a lot of people to come in there, and they have been moving to more of a subscription-based model over the years. So that's something that you do like to see from tech companies, when it's not, all right, just go buy the latest version of our software off the shelf for $30 and we'll see you next year. Now they're starting to get into more of that subscription type model. That's something that investors like to see, and it looks like they finally have the catalyst to really get a lot of people onto that platform now, and it could be something that set up for another leg higher here. But I checked earlier, it looked like they were still off of some of the highs we had seen recently, so there could be more room to run here.
Okay. All right, so this analyst certainly likes it, thinks there is another $5, $5.50 to go from here. Cruiser, thanks for the walkthrough here on some of the movers. Thoughts on the macro as well. NASDAQ still down 1%, but stabilizing and no additional selling since the open. We're going to talk some more about some of the big tech stories next. That includes the semiconductors, which are one of the worst performing groups this morning. We've also got an a downgrade, but still a rally on Alibaba. So we'll talk some China tech in there as well. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
I'm Jenny Horn. Here's a few more of this morning's movers to keep on your radar. Fubo TV shares are soaring after the company reported better than expected quarterly revenue. The streaming provider issued second quarter and full year sales guidance above estimates. However, its first quarter losses of 59 cents a share were wider than the expected loss of 46 cents a share. Following the report late Tuesday, the company received price target cuts at Oppenheimer and Roth Capital. Papa John's and Starboard just announced the restructuring of their relationship. The pizza chain said it will repurchase 31% of the preferred shares in the company controlled by Starboard. This was stock Starboard purchased back in 2019 for roughly $250 million. As part of the transaction, Starboard will convert the rest of its preferred shares into common stock. The charge attributable to Papa John's shareholders will occur in the second quarter. And Yeti is lower after BTIG reiterated its buy rating and boosted its price target to $100 a share. The analyst says the stock is positioned for a beat tomorrow ahead of its first quarter report as a result of its consumer adoption and strong digital business. The analyst noted that Yeti.com's traffic is projected to be up 94% this quarter, following 99% growth in the previous quarter. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. Let's talk some more tech as the NASDAQ struggling this morning after warm inflation print. Semiconductors are the worst performing sector or industry within the group. Matt Bryson joins us from Wedbush Securities, SVP of Equity Research covering hardware. Matt, so when I think about what is cyclical within tech and an economic recovery that maybe includes some inflation, I think hardware, I think chips. So what's going on here? How come we're continuing to see pressure now built in this group over the past month?
So I think it's two things, Oliver. I think one, your prior guest was certainly talking about inflation. I think tech names, particularly semiconductor names, were one of the big beneficiaries in terms of stocks from a low inflationary environment. But I think the other piece that factors in the semiconductor names is concern that at some point we are going to have oversupply, right? So the chips are very cyclical. Their performance is very dependent upon supply versus demand. And so I think that over the last few weeks, some concerns have percolated with increasing CapEx that we're going to see too much supply, and that's going to cause a downturn in the cycle.
So this brief moment of the supply chain is still kind of wreaking some havoc in this group, it seems like.
Yeah, I think the concern is there's going to be a turn. Now, I'm on the other side of that. I look at lead times for products. So to get certain chips, you have to place orders a year in advance now. I've seen that those increases happen across technologies. So it's not a single type of chip. I've seen it across different types of manufacturing. So it's products made on older technology like 8-inch equipment or 8-inch wafer equipment. It's the newest products. So like the new Apple CPUs for their handsets. So I personally think that we are still in a shortage situation, that this is going to last well into 2022. But regardless, there are concerns that is not the case. I think that's what's affecting the stocks.
So which companies look the most stable right now? What in your suite of coverage, Matt, looks like the safest bet? If you want exposure to the semiconductor group, if you think that the concerns right now are short-term or transitory, to use the word of the day, what are those companies?
So the names I like, Oliver, are AMD. I think even if PC demand starts to come off, AMD has been very much supply constrained. So they have been taking less share than they might have been taking had they been able to get output to match demand. So I think if you see demand come off a bit, I think they will simply take more share from Intel. So I like AMD here. On the smaller side, I like Silicon Motion. I think there is a shortage of SSDs. There is a shortage of storage modules for handsets. I think there simply are not enough controllers for those modules. It's relatively cheap here. And then the last name I point to is Western Digital. And there I think it's a combination of, again, same story, not enough NAND, so not enough storage. But also on the hard drive side, I think for the first time in a long time, we're seeing hard drive makers having supply that doesn't quite meet demand. Historically, that gives them some pricing leverage, so that helps the other portion of WD's business.
Matt, what about NVIDIA is absent from that list and a very specific graphics utility in the crypto space as well that it's been tied to in the past, in addition to the gaming side? I mean, we had this epic breakout, and then it just faded right back down.
So I think NVIDIA has a great long-term story. It has a solid short-term story. So on the short-term side, you're absolutely right. Crypto prices remain elevated. You look at something like Ethereum, which is predominantly mined using GPUs, and pricing is at all-time highs. That certainly creates a buffer. If I look at the gaming market, that's a market that's not been saturated. So it's very difficult to get a GPU right now to build a high-end PC. It is very difficult to buy one of the new gaming systems. Switch numbers just went up. That benefits NVIDIA directly. So yeah, in the short term, I don't see any problems. If you look at the long term, I think the longer term for NVIDIA is all about AI and the data center. I still think that right now they are a bit production constrained. When you look forward 2-3 years, it's a bit hard to figure out exactly what the growth number is, but it's going to be a big number. There are certainly more competitors that are trying to get in that space, but NVIDIA's created a great situation where their investment in software has really created stickiness. And so I think they will grow with the growth in AI. So yes, that's certainly another name that I like here.
Okay. Matt, thanks. We're going to do some trading here. Appreciate the rundown here of the different names. We're going to start with NVIDIA. Let's bring in Tom, and let's trade this thing with a little bit of bullish potential, but you're not betting the house on it, Tom. You've got some neutrality here to kind of reflect some of that mixed short versus long-term take on NVIDIA.
Yeah, and I think that's the key here. You know, you've got a high-priced stock. You've got the tech sector, kind of in this realm where we've been pulling back. There's more pressure on it. If we continue to see yields rising, as those CPI numbers might indicate, then that might put some pressure on it. So how do you play Intel in a bullish way, but then giving yourself some room? So we looked at one of the building blocks of option strategies where we're going to stay risk-defying, but give ourselves an opportunity to profit if it remains above a specific level, and that's below the current share price. So I looked at selling a June 4th weekly 535, 525 put vertical. So it's a short $10 wide, neutral to bullish put vertical. If I can collect roughly about $3 credit on that, that's going to be my potential reward on this trade with a risk of $7 per spread, right? But why is my risk reward offset where I'm risking more than twice what I'm collecting? Well, because you're giving yourself a better probability of success, because that break-even point is now down at $532 before you start getting hurt on this trade over the next 23 days. So there's give and takes and offsets on these type of strategies where, hey, yeah, I want to be bullish in NVIDIA, but there is still some risk for a pullback, and I still want to be protected if it does go down. So you profit in 3 out of 4 scenarios in this type of strategy where you profit if it remains here, goes higher, or goes lower, and remains above that 535 put that you sold on this particular position. But this might be the way to play it because it seems like tech has got some volatility and it might stick around for a bit.
Does seem like that right now, down 1.4%. Tom, what about for AMD? First one right out of Matt's mouth when they asked which one he likes. So let's do that one. It's on lows that AMD owners are not used to seeing, this thing trading at the bottom end of a year-long range.
Yeah, and if you take a look at the pressure that it's been under just this month and so far this year, the stock was trading over $99 in January, but it's had a good base around that $74 level where it's hit that support level repeatedly, including yesterday. And it's bounced off of there. So with the stock just above $75 a share, I looked at something a little bit more long-term than the NVIDIA trade that we just looked at, and a little bit more aggressive. Instead of buying the shares, let's do a call diagonal as an example here, where I'm going to go out and buy an in-the-money July call. And in this case, we'll look at the July 72.5 strike call. We'll buy one of those and then sell against that a near-term May 28th weekly 80 strike call, creating this call diagonal that's got about 65 days in it because July expiration is just over 2 months away, where I not only hold that in-the-money call, which is a 72.5 strike below that support level, which acts like the stock because it's got a higher delta, close to 70 delta on that one. So that'll react like the stock where that goes. But the short May 28th weekly 80 strike call that I sell allows me to manage this trade, collect credits by rolling or adjusting that short call over the lifespan of the trade, which reduces risk, reduces my break-even point, which is just around 74 and a quarter, 74 and a half, around there, where I can actually chip away at the debit that I took, which is about $5.30. That's your entire risk on that particular position, $530 per spread, as opposed to buying the shares outright. So this stock replacement type of strategy or call diagonal might be the way to play it over the next 2 months.
Okay. All right. So two different ways here to approach semiconductor group, and bullish. So you're buying dips. A little bit of a hedge on an NVIDIA, but certainly other one, you got to be ready to have some diamond hands because they are coming under some more pressure here this morning. NASDAQ back near the lows of the day. Tom, thanks. Thanks as well to Matt Bryce joining us from Wedbush for the case for why to hold on to those chip makers. When we come back, it's hour 2. We're 30 minutes into the session right now, and equities are having trouble getting going. We'll talk a few other price target hikes out, looking at Walgreens and CVS, companies that are still near those highs.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Welcome back to Morning Trade Live, Hour 2, 30 minutes into trading. Stocks under pressure. The NASDAQ now finding another push to the downside. Not a lot of buyers this morning. Bonds are being sold. There's not a lot of relents in the 10-year yield right now, which is moving higher. That's, of course, after warm inflation. The print heard around the world today is now, once again, we are talking the word transitory, and the debate really happening in earnest now around what the Fed can do, and maybe more importantly, even if the Fed doesn't move, what investors are going to do and what they want to own if we are now formally in that inflationary environment. A lot of talk now leading to action. Chartmaster is going to take a look at a few other moves for us on some of the analyst reports around earnings season that is winding up. We're going to talk pharmacy stocks in a sec as the companies have been sitting near the highs. Walgreens has been a great trade. CVS too, around some of the vaccinations. So let's talk more about some of that market reaction, though, here with Ben and check in on the indexes because we are still red. Ben, we're not making new lows since the open, but we're pretty much there. There's not a lot of buyers coming in for the NASDAQ like they did yesterday.
Yeah, I think that's what's most important, Oliver, is that we haven't rejected these lower levels as of yet, and very similar in terms of what we saw with the Dow yesterday, which was the weak link in the chain. Keep in mind, we're really just holding at these lower levels. It kind of makes you feel like we're just waiting for that next leg lower, but I think for me, what's most notable is the significant sell-off that we had seen, well, precursor to the move that we have seen recently in terms of the move lower off the all-time highs in the ES and the Dow, and that was the NASDAQ, the tech-heavy index coming under pressure, but really was the big move off that nice round, unusually round number, 35,000 for the highs that we saw in the Dow futures, down to 34,000 yesterday. A swift 1,000-point move, something to be taken note of.
Okay. Ben, we were talking chip makers a lot here this morning. The SOX is down, SMH is down, 2.5%, a really important group here. You and I were discussing more the macros. We've hit some of the stocks. To go back to the macro side for a sec, thinking about what works in this environment, right? Crude oil seems to be working. We're hearing all the stories about lines at the pump and the prices going up. Ben, is crude going to break 68? And what happens if we do get through that previous high? I mean, that was a big level from March.
Sure was, Oliver. And earlier in the show, we were talking about the inflation narrative. You just mentioned into the beginning of this segment here out of the break how that number was heard around the world, and a lot of focus here on the commodity prices here, because while the financials, as we were talking about earlier in the show, really a reflection of some of those concerns, the inflation narrative, I think the commodity prices are at the epicenter of. Let's take a look, as you were mentioning, crude oil and the move we've seen this week. It's getting a lot of attention here, Oliver, tied to that Colonial Pipeline shutdown, the gasoline shortages that we're starting to see on the East Coast, and the impact that's going to have. We're apparently waiting for some news today in terms of when that pipeline is going to start flows again. But oddly enough, aside from the gap up that we saw Sunday night into the open, kind of limited in terms of real directional conviction one way or the other. We actually dipped down to 63.68 to begin the day session trade yesterday before rallying back with the indices. Now, keep in mind, it's not uncommon for crude to track the indices pretty closely, and then you've got that inverse correlation to the dollar at play. We also have some activity here. Let's just zoom out of this intraday look here, Oliver. You can see on the the weekly time frame, this move that we're seeing this week, the bit of a bid coming back into play does bring us back into those highs that you just mentioned recently from March, up around 68, and those coincide with some highs we saw back in April of 2019, all the way through to that triple top from the end of 2019. But also you can see some hurdles above in terms of crude oil. Now, you know I've been keeping a close eye on the RBOB, the gasoline, in conjunction with this Colonial Pipeline story, but also today, Oliver, we heard from the EIA. Now, I'll get into the inventories aspect of things in just a second, but they reduced demand forecasts on India, cut European oil demand for the first quarter, and, well, cut 2021 global oil demand growth forecast by 270,000 barrels per day to 5.4 million barrels per day. They did leave the second half of 2021 oil demand forecast largely unchanged, though, with a slight cut to America's oil demand for the first quarter of this year by 515,000 barrels per day to 28.4 million barrels per day. But, Oliver, I want to point out, API yesterday reported a build the second week in a row. Today we get the EIA. They're expecting about the same, around 2.5-3 million barrels in terms of withdrawal. We saw a nice run up in gasoline futures products, but certainly energies, again, at kind of the center of that discussion in terms of the inflation narrative. And as prices continue to higher and prices at the pump are higher, you can understand why. That hits us directly as consumers.
Okay. So, Ben, the commodity space is what's working here, and that's happening even as the dollar is higher. I think that's really important to point out that these standard kind of assumed correlations and relationships come under a little bit of strain, and in these fairly unique, somewhat extreme times. I mean, look, we've never seen a month-over-month like that going back. It might be ever. I'm not sure. Not ever, but it goes back a long time. So the fact that we've got the dollar higher and these commodity moves happening means there's a lot of conviction behind them.
Yeah, Oliver, I think you bring up a good point there in terms of when you see that inverse dollar correlation to commodities that you'd expect to see kind of break down. It does speak to the magnitude of the fundamentals in terms of the individual products. So in this case, crude, we've seen, hey, I just mentioned EIA, but earlier in the week, IEA, OPEC comments coming out. We have, again, the pipeline fundamentals at play here contributing. So, and then you've got the whole rate narrative as well, because that does impact prices also. But Oliver, I want to move away from crude because also kind of feeding into this inflation discussion, it's not just energy prices.
right, man. Good morning. Good morning. Good morning. Been in meetings ever since about 8 o'clock this morning. So, of course, I got jumping on the live stream before that even happened. Today is going to be, it's a crazy, crazy day today already on the market. I mean, I've got today's live stream really focusing more on cryptocurrency and Dogecoin. I mean, what's interesting about Dogecoin is that I'm sure you guys have seen as well. I've got the chart, I've got the 7-day chart for Dogecoin, because ever since it surged in the weekend, Friday and Saturday, and then of course it dipped Sunday. Just again, like I said, it's restabilized over the past 3 days. We're right at about 50 cents. Now, if we go back to before that, if we go back to the mid-April surge, after the mid-April surge settled down, it built up a nice shelf of resistance at about 25 cents, maybe between 25 and 30 cents for quite a for about a week and a half. I mean, volatility was there, but it kept stabilizing around the time. And then it started going upwards as we get into May, and then it hit the gas again. And the surge, the kind of double peak surge in mid-April looks almost the exact same as the double peak surge here in kind of mid to early May, whatever you call last week, and then now stabilized again. So if it stabilized at 25 cents then, and it's going to stabilize at 50 cents now, and if it's on a 1 month cycle, I mean, it can very easily, you can very easily see it restabilize either at 75, because it's going to go up a total of 25 cents, because it's kind of where it was before. I mean, it stabilized at 5 to 7 cents, and then went up to 25 to 30 cents. So that's about 25-cent jump, and then another 25-cent jump from 25 to 50. Or the other option is it 2x's. If it 2x's, then it's going to go to $1. So that surge would then be at potentially $1.50, and the next stabilized resistance would be at $1. So that's kind of what I'm looking at. It may happen in June. It may happen, and then the next one, this surge could be up to $1.52, and then restabilize closer to $1.25 to $1.50. So those things could happen in the next 2 months. Or the other option, it completely goes into nothing. So it is very much a crapshoot, but it is continuing to pick up steam in volatility volume. There's now way more volume being traded both in the surge in April and in the surge than it was back in January. That was a big deal back in January. So that's going to continue to create a lot of issues. So Walgreens, yeah, I mean, to me, Walgreens is such an odd success story, honestly, over the past little while. It honestly very surprising to me. It honestly is. Like it just seems odd. Maybe I'm the only one that thinks that it's odd, but it's very odd how it has done so well during this pandemic. But I guess they have both the small, I guess they have both the small grocery kind of model, and they have the pharmaceutical and healthcare and whatever model. So they have two great revenue streams coming from. They have CVS, would have it from CVS, but CVS, of course, now owns Health. And so I think there's a lot of, well, I'm sure they should be doing as well as Walgreens, but Walgreens seems to get all the attention. Let's see what else we've got here with with the cryptos. We looked at Dogecoin. Dogecoin hasn't really done a whole lot today. Yesterday, I think it was Bitcoin Cash was taking off, so it's Bitcoin SP. And then in 43 something, maybe 44, not quite, 43 something, still over 43, 43.12 right now. I think 43.50 was its high, give or take, which was 2% or so higher than it is right now. So volatility with these things same. Most of the rest of them are actually trending down. Premium Classic, for example, is down 30% from its high last week. Litecoin is down a little bit low. Its high, it hit a high Monday or Sunday, and it's down 8%. It took a steep dip a couple days ago, and then it's come back a little bit since then, up to 396. In the bottom right, you'll see that the Grayscale Litecoin Trust, which trends with Litecoin but doesn't track it to $1, so it's not perfect. And then we'll go pharmacy stocks. CVS. Okay, so CVS is up. Friday down. Walgreens down. But either way, Walgreens still gets all the glory. Otherwise, what we got going on, tech stocks not doing too hot. I think there's a really good chance that AMC busts out to the next level. Let me see if I can zoom in on AMC. AMC doing super well today, up 3.5%, up to 10.4 to 40 for the first time in a while. So I'm hoping we see some awesome things from AMC. Take a good chance of it hit a big recovery trade right here, which boosted it, and then of course people sold because of that boost from 10.7 to 10.5 super fast. But then it's drifting back up. Yeah, I mean, I feel good about AMC. I really, really love to see AMC take off and get back up to that 12, 13 range. All right, let's turn it back over to you. We're watching TD Ameritrade TV today.
Pharma play and even an actual brick and mortar retailer can be the winner.
Yeah, it's interesting. Of course, the last year, pharma has been in vogue play to talk about. And we were thinking that we were going to see some of that tailwind for these types of companies. I think CVS, it certainly helped getting people into the store, getting people used to the store, and just anecdotally, just talking to people around. I feel like there's a germophobia that's just going to be with society for some time. Anytime you get a cold, we're going to think, oh, I got some variant of COVID. We're going to want to rush to the store, get the flu remedies, get everything to make us feel good. And I think that's going to be good for the company. Also, with these types of convenience stores, they've always had a nice markup, always been able to have that purchase or the pricing power, which that's been the play that I've been hearing about for the past week. People are looking for these luxury names, companies with brand awareness that people are going to be able to, these companies are going to be able to raise their prices as inflation starts to hit their bottom line. And I think that the convenience stores always have had that markup, and I think they're going to be fine because people just, they go to the pharmacy, they pick up what they need, and if they happen to see some ice cream, see some chips, they just put it on the total and they don't really think about the price.
Yeah. All right. So some tailwinds that can last is the message I'm hearing. Do you want to just buy upside of this, buying calls? How do you figure out which strike you want? What does the options market look like right now?
Yeah, well, personally, I think right now the market, the sell and May trade might be sitting there in the market. I'm a little concerned for the short term. I'm looking at a longer term trade. I got a lot of room to work with that upgrade up to over $90. So I'm actually just looking at the money 85 strike in November. Finance that by selling the 95 strike. It's about $3 for me to get into that trade. And if I was owning CBS right now, I don't think I'd want to own it right now in these summer months. I'd rather have it on with a risk-defined trade. So that's how I'm looking at it. A risk-defined trade. I'm risking $3. It could pull back to the mid-70s where it was only a week ago. So $3 is a better risk there. And of course, if it does trade up to 95, I get to make $7 on that trade.
Okay. All right. So pretty straightforward. Looking at upside here in CVS and the duration and the time you want to hold this, Joe. If there's a certain level where you go, okay, even though I've got some time left in my options, I'm going to get out of here and take the trade. What's your profit threshold for getting out?
It depends on the rest of my book and the portfolio, I guess. It's there's a long time. I just want to let this work. Of course, I'm concerned about the short term for sure in the market, but I do like this story for the long term. So This is kind of like a little less risky than owning stock. It gets me into the trade. It's a lower delta, of course, than owning owning the stock outright. So I'm comfortable with some losses. I think it will recover. And yeah, if I doubled my money, get it up to $6 this trade, I think I'd be comfortable taking some off for sure.
All right, Joe. Thank you, sir. The long-term CVS hold and looking for gains here on the pharmacy stock. Appreciate it, Joe T-Game, portfolio manager at the Rational Equity Armor Fund. And by the way, this afternoon, we're going to talk some more earnings and stock specifics. We've got the CEO of Fubo TV joining us. One of the most wild rides in the stock market, especially in the streaming space the past year. We'll be joined by David Gandler after the shares pop on earnings that beat expectations, but still a long ways off from those highs of $63. Stock trading at $19.75 this morning. We'll get the update then. We'll be right back for more. We're going to talk about how to gauge investor sentiment across assets as inflation worries are the story this morning after a print that was the biggest since 1982, the month over month. There's the stat, 1982, 0.9% core CPI, month over month change. Be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Hottest month-over-month inflation since the early 80s, and investors this morning maybe a little paralyzed. We haven't done much since the opening bell. Stocks are down, bonds are down. Let's talk about what this does for sentiment. Joining us from Contigo, running applied research, Melissa Brown is a managing director. Melissa, welcome to the program this morning. You guys have a pretty interesting approach to thinking about sentiment. Walk me through what you do and what it tells you right now.
Yeah, thanks. It's nice to be here. The way we think about sentiment is basically let the market tell us. So what kinds of stocks are investors buying or preferring? Are they looking for more defensive kinds of characteristics, whether that's sectors that they're buying or the style factors? If, for example, if investors are loading up on higher dividend yield, that tends to be a more defensive kind of move and suggests that investors are more risk averse. On the flip side, if they are, going all in on growth stocks or technology stocks, that tends to suggest that they're more risk tolerant. And we look at the balance between the two. And so if we want to see that either investors are, really leaning one way or the other, and then we can make some statement about whether we think where we think sentiment is right now.
So the big question today is, of course, about inflation. Is, it too hot for the Fed? Is it okay? Are they going to hold everything together? So where is there anything more important than sentiment there? I guess the belief, does that show up in the analysis? How do investors feel about this dynamic?
Well, one of the features of this sentiment index that we look at is that when investors are risk averse, they tend to react badly to bad news, and they may ignore good news. And the opposite is true when they're more risk tolerant. What we've seen over the past couple of weeks is that investors have been getting more risk averse, and that would suggest that this, if you view the inflation numbers as bad news, which I think many people do, that they're going to tend to have a big reaction to that. If the news had been much better, they might not have done anything.
So these numbers come in, they're warmer than expected. Markets, I describe it as paralysis. We're not really doing much right now, kind of stuck since the open. If this isn't the kind of pen to once again deflate some of these high growth assets that have been under pressure, what will be the primary narrative? I mean, it seems like when you think about sentiment, that ultimately comes into a narrative, right? What do you see as being that dominant narrative for markets right now?
Well, I think we've got this push-pull between inflation and does the Fed need to raise rates versus, let's say, the relatively poor unemployment numbers from last week. And does that mean the Fed needs to stay firm where they are? So I think there's a lot of push-pull. There's other, kind of discrepancies, I guess, between growth and what's happening with the resurgence of COVID in parts of the world, and so I think you're right that that does cause some kind of paralysis, and we certainly have seen that over the past month or so. This is not just today, but we've seen trading volume come way down. Particularly in the U.S. And so I think that suggests that investors are waiting for some news, before they decide what they want to do. The other narrative, I'm sorry.
No, go ahead.
Is which stocks will do better in this kind of environment, and we've seen also just over the past few weeks a big reversal in that lower volatility and lower beta stocks have been doing better after over a year of high volatility, high beta stocks doing well. So we have already seen a reversal to maybe a more cautious stance. And then just recently, we started to see a resurgence in value as a style factor to invest in versus growth, which has done quite poorly.
This is where it seems characterizing kind of sentiment important to gauging when enough is enough for the growth stock beatdown that's been happening. A lot of favorite funds and trades are now in bear market territory, some of them in technical downtrends, 20 to 30% off highs. And yesterday I started to notice some of the chatter from what I pay attention to, people saying, enough's enough, too much. But then this morning, we get this inflation print that suggests maybe yields can continue to go. So how do you gauge when that valuation contraction has been enough? I mean, to your point, I'm looking at your notes describing the market as .com highs in valuation. I mean, that's the fact, right? So should we think that, there's a dip buying opportunity just because we're down 20% in some of these stocks that are still at record valuations?
Historically, the market tends to way overshoot fair valuation on one side or the other. So valuation levels are extremely high right now. I would have to say if they're going to come down, they're probably going to come down more than, what seems reasonable, because that typically is the way markets work. So, whether, buying time is next week or next month is harder to say. But I wouldn't think just because we've had a 20% dip that means it's time to buy.
Okay. So maybe still pressure here. Does that mean that there is life left in this value rotation? Melissa, do you see that potential for that kind of cyclical event to maintain and keep the strength that it started off this year?
Well, it's interesting because we've looked at the relationship between inflation and the performance of value stocks, and to some threshold of inflation, higher inflation is actually good for value. So value does tend to perform better when inflation has risen. The question is, where have we reached that tipping point where we've gone from good inflation, which is a signal of a strong economy that's going to help value stocks, industrial stocks, those kind of stocks, to where it's going to really start to hurt overall, whether it's because bond yields go up enough that they actually become a very attractive alternative, or because it hurts future earnings. And I think we can't base anything on one inflation number that's been reported, but it's certainly something that we need to keep watching. I think for right now, we're fine on a value play. Although I would also point out it had stalled for about a month until the last couple of days. But this inflation is going to be extremely important to what happens going forward.
Well, let's really like the introduction to how you think about markets, and let's dive into some of the quantifiable kind of metrics that I know your team looks at in your risk on and risk off scores next time. Appreciate you joining us here this morning.
Thank you for having me.
Thanks a lot. Melissa Brown joins us from Contigo, Applied Research Managing Director at the firm, and looking at a good reminder about how valuations overshoot in both directions. I like that point, as right now we are shooting lower as the NASDAQ is sitting on the lows of the day. Do we break them and take another lag, or will we find support? It is oddly quiet right now, so let's talk about something that makes everybody happy. Pizza, next.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
We got stocks making new lows in the morning here, but let's focus on some specific companies. Ben Watson joins us for some overlooked earnings. Ben, today we get to talk a little pizza. So let's try and get away from some of the ugliness in this market right now. But I should make people aware that, yes, we are making the lows in the morning. So in all seriousness, the NASDAQ is down about 2% right now, Ben. But on the earnings side, a couple stocks that we haven't talked about much. We've looked at just about everything in tech, et cetera. But we've got a couple companies out. Pizza, Wendy's over the last couple days. Let's start there with Papa John's. What's going on?
Well, I tell you what, Oliver, you know, this has been one of those charts. Pizza is one of those things that that people have enjoyed, but the trend has really been overall sideways. You know, you'd think in the face of all that's been going on in the restaurant space that pizza would be consistent. It's been really choppy, to be honest, and we've seen this move to the upside, the gap down on the last earnings, and then this intermediate rally back to the upside. And that intermediate rally to the upside build a cup and handle pattern that had a breakout, a pullback, and a retest, and that's where we are right now with this breakout again yesterday. So we had the gap down rally above the rim of that cup and handle at 96. Today kind of falling off a little bit, but it's still up above that rim. So if it can gain some traction and move higher, the next level, the next stopping point's that previous high at 102, and then out at 106, which is pretty close to the projected target for this cup and handle pattern. If it breaks down, look for it to come back down to that handle.
Look at Ethereum over here.
Sentiment definitely moving, at least long-term sentiment, moving in a bullish direction. Intermediate term sentiment falling just a little bit versus that price action today.
Okay, so it's pretty stable as the market comes into some trouble here. You know, if there's anything reliable out there, it's got to be pizza. Unfortunately, Papa John's has not been the most reliable pizza trade over the last couple of years. Right. But it's stabilized here. And to your point, it's been a little bit of an up and down story. But since earnings, you know, they're not selling it. And the last earnings kind of formed a floor there. So apparently there's something fundamental here that is positive. And they're also buying back shares. So they're going to repurchase stock and conversion of all convertible preferred stock owned by Starboard Value, which has been in the company. So 31% of the outstanding shares of those preferred shares after doing, you know, some pretty decent numbers ahead of expectations. Right. All right, makes sense. You know, not bad, not great. A perhaps a COVID-specific stay-at-home ordering pizza trade, but you know, not getting hit too bad on the earnings. Wendy's is actually doing pretty well today. It's up in a down market. It's faded a little bit, but still up 1%. Definitely stands out.
Yeah, and I think that up in a down market, but that little bit of a fade, I think, is the way to look at this, right? So, you know, we get this intermediate long sideways, the intermediate up, and in fact, Wendy's here breaking out of an intermediate length cup and handle pattern of its own with that rim right at the 23. Now, here's the key. If it can hold above the rim of that cup at 23, then I think it can bounce and move higher. Otherwise, at least that's what the chart suggests. Otherwise, I think things get a little bit frosty if the price breaks below this 23 and stays there, because then you've had this false breakout. Then I think you've got to look for this to be settling back down on the handle support of this cup and handle on the right-hand side there at the 22 mark. But long-term sentiment rising, still up in overbought. Intermediate-term sentiment, though, that's the challenge. It's diverging bearishly, and we're kind of seeing that coming home to roost here in this combo meal of the gap up sell-off here, Oliver.
All right, quite a red candle there, right? I mean, just it seems like there was a lot of selling pressure. I mean, that's basically exactly what this tells us. It was viewed as an opportunity to get the heck out. And still below those highs, the all-time highs, but above the previous ones from December. So, you know, kind of thinking about a range perhaps that has a, you know, support down at like what, 22.5 essentially.
Yep, exactly. That's the handle side of that cup and handle pattern that's been built there, and I think if you can, if the price can't hold 23, the rim of this cup, you got to watch that 22 pretty carefully, because below that, now you've really had a strong kind of intermediate term bearish reversal going on.
Okay. Hey, did I hear you say the word frosty, Ben? Did I hear that in there?
Oh, I did.
Okay.
I did say frosty.
All right, I missed that one there. Control room caught it, but I missed it. Sounds darn good, though, right now, I got to tell you. Is it too early?
It does.
I don't think it is. It's never too early for a frosty.
Never too early.
As long as you're not getting vanilla. That's ridiculous. They're chocolate.
Yeah.
I don't know this
Totally
vanilla
chocolate.
thing. Yeah, it's absurd. Okay, Ben, you got one more chart for us. TSEM, not Taiwan Semi, but still in the semiconductor category. Tower Semi, right?
Yeah, exactly. And one that we haven't looked at very much at all, so kind of overlooked, but a long uptrend, kind of gone intermediate sideways, and very similar to a lot of the technology and specifically semiconductor patterns that we've seen, where we've seen that big rally into the end of the year and into early spring, and then it's tapered off into this descending triangle. In this case, above the 27 support level, and it broke support on this earnings gap down sell-off, which is continuing. Now, to be fair, yesterday it had a gap down rally right at that 27 level. So if we get a little bit of a bounce here, we might see it retesting 27 as resistance, because we remember that old support can become new resistance. But if it continues to break down, you've got a pretty solid level at 24 that was tested before on the run up. But below that, there's a lot of open air down into the mid-teens for this to fall. But combined sentiment clustered at that oversold line could be a bullish sign.
Okay. So a potential break of that triangle, but you want to see confirmation of that. And it's not a pretty session, down 9%, just crushed on earnings. But there's a possibility of support still intact even after this.
Even after this, so down at that 24 level, there is some support. That became a support level on the way to the upside. That's that horizontal line that I've got drawn in there at 24. But if it doesn't stop there, there's not a lot of clear-cut support below that until you get down into the 18 range.
Okay. Well, it's getting pulled even more as we speak, because tech overall keeps dragging. So we got to run. We're going to get our panel in here and talk about the action this morning as we're making new lows, down a clean 2% into the NASDAQ futures right now. Ben, thanks for the update on the earnings response to a few of the overlooked companies here. Chip makers are taking it on the chin right now. We'll get our panelists to join me next, talk about the blowback from the inflation number this morning, way above expectations and clearly an unexpected event, even though it's been the talk of the town nonstop. It's all anyone's been discussing now for months, but yet still coming in above expectations. And somehow investors were not ready for it. We're down more than NASDAQ. It's getting pretty ugly out there.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. You don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Jenny Horn. Here's a few more movers to keep on your radar this morning. Intuit announced it expects to exceed the high end of its fiscal 2021 earnings and sales guidance. However, the financial software company did warn that results for its third quarter were impacted by the extension of the tax filing deadline. The company will report its most recent quarter next Tuesday after market close. Unity Software is lower following strong quarterly results, with adjusted earnings losses coming in narrower than expected. The company posted sales of nearly $235 million, which beat estimates by over 8%. Unity also raised its full-year guidance by about $50 million, now projecting sales of about $1 billion. Following the report, Stifel upgraded the shares to buy from hold, while Wedbush and Barclays cut their price targets on the shares. And Cathie Wood's ARK Invest said the crypto market could be a $1 trillion space in the long term. An ARK analyst said in a recent interview that this is the beginning phase of what will create an entirely new asset class. He also said this space can one day potentially rival the safe haven gold play, specifically when talking Bitcoin. In regards to Ethereum, the analyst called this asset a multi-trillion-dollar opportunity. Ethereum's market cap currently sits at roughly $500 billion. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. Lows of the morning here, and NASDAQ coming under more pressure. Bonds, too, as we are making now new highs in yield for the day. Stephanie Lewicki and Alex Coffey can't get in here fast enough. Steph's Senior Manager of Trader Education. Alex, co-host of Fast Market. Steph, so where do you hide on a day like today? Apparently, it is none other than WTI.
That's right. Crude is doing its own thing, right? Going against the grain in the market here. So crude is up nicely, up above that 66 level. That's April 2019 levels, I believe. And we just did get the EIA data. Now, it was a draw of 427,000 barrels when they were expecting a draw of 2.8 million. But I think crude has got that optimistic bid in it after the IEA came out and they said that record glut is gone. Now, they did cut their 2021 global demand growth by 270,000 barrels a day to 5.4 million barrels per day. But they did say the second half of the year should be pretty strong recovery. And part of that cut really is India. They cut their demand down 13% because of coronavirus. So I think you're getting a bid in the dollar today. Some interesting action in the dollar right after that the CPI number came out. Up, down, now we're back to up. Couldn't decide what it wanted to do with that number. I think most of the market is still, but I think that dollar getting a boost as it did touch below 89 yesterday. That's back to March 2020 levels. Is also helping crude right now. But yeah, crude really, the rest of the market, crude is saying, hey, things are looking good. Demand is picking back up. But yet we got some volatility in the rest of the market here with VIX up to 24 and the equities selling off now for the third, fourth day in a row.
Okay. So that's a really important part here, is that this is continuing on top of a lot of weakness already, in particular with the NASDAQ. For the S&P, for the Dow, as we were just making highs, okay, but for the Qs here and for specifically these growth trades, the ARK fund, all that stuff, Alex, it's been under pressure. It's getting not insignificant for the NASDAQ. We're now down about 6% from the highs, a little bit more than that, almost 7 if we go from the tip-top highs. But more importantly, the Tesla part of the world the high growth ARK fund, which is down in a bear market, well within a bear market. Yesterday, a lot of the commentary I heard was that this has gone too far and that there was a good opportunity here to basically start thinking about getting long and buying dips on companies that have worked. So now that we're seeing more selling here again, ARK down 3%, I mean, it just seems like we are really in a trend now. And that's different than a correction, right? In the market overall, we're in a correction or something like that, a pullback, whatever you want to call it. But for some parts of the market, we are in a straight up downtrend and bear market, and that is the high growth tech. So how does that leave investors, Alex, thinking about what to do?
Well, I think it's important to take a step back and look at the performance over the last year, the last 2-3 years, and you see a lot of those names that are really feeling the brunt of the weakness right now, Oliver, have been extremely high performers. They've had extraordinary runs. Tesla, even with its volatility, is still up extraordinary amounts over just the last year and a half. You have to keep that in consideration. At some point, some of these moves to the upside got a little ahead of themselves. Regardless of the macro situation, regardless of the micro situation, there was extraordinary demand for those companies. However, if you're a passive investor parked in index-related funds tracking the S&P 500, I think the most wary you could possibly be of a market condition is one where these tech companies, these growth companies, are the laggards, as they've really been the part of the market that's bolstered things for 5 years to a decade now.
Yeah.
Without those companies outperforming, you have to start questioning, what drives this market higher. And so if you add on to that, not only are they not outperforming, they're actually a drag on the market. It might be too much to overcome.
Yeah. That's where, the 2.5% poll here is just gravity. Apple down 2.25%. Is just, we haven't seen something like this really, not ever. There's been moments, I think about September last year as actually being the most analogous, when it looked like maybe we were done with COVID and then all those COVID trades unwound.
September 2018.
Right. September 2018 being more rate driven. So that's relevant to now. The only catch with that one is that it was fairly gradual and we weren't just crashing after earnings. That's such a big deal here, is that even in previous instances of tech weakness, it never came on the back of such incredible numbers stuff. So should we try and avoid this group as investors right now? If you are in these stocks, is it about still trying to go to rotate to other things? Because unless you're in energy or in WTI, there's nowhere else to rotate today.
Growth tech stock.
And it seems like, we're getting some movement in treasuries today. Well, we're getting some selling there, but it seems like almost the last few days that maybe some cash went to the sidelines as there was a small bid in treasuries and rates were holding steady. But it seems like there's some money going into cash. And Oliver, it's really, really ironic to talk to you after we can't remember or forget the Apple's earnings report when we were on when they reported and saying, what a blowout quarter.
Right.
They should go back to their highs of $145, and now look what we're talking, $123 after a really awesome quarter, really solid quarter, and that was the story for most of these big tech companies. So I think this does get a bit scary here. Now still, 5-6% down from the highs, like, VIX, back to 24.5. I think if we get VIX back up to a 30, I think there's some worry definitely there. But to see this selling, for so many days in a row, and then you get that headline inflation number here this morning, but you have the Fed consistently saying, we just heard from Clarita this morning again that, well, he said he was surprised by the number, but said, it's transitory. They have the tools. They need to control it. But he also said he does not have unlimited tolerance for inflation. So now it's that inflation narrative, which is the big picture, which it has been for a while. It's inflation and tech, right? Rotating out of these big names that have led the market for so long after they just reported Q1 results that really blew it out of the water. So I think this whole dynamic, I think there is a little a warning of caution here right now.
Yeah. All right. So there is definitely caution. The other thing, too, is that, like, frankly, it's hard to know kind of what more analysis to put on here, Alex. It's like this has been the entire trap for the market. In my editorials, I've been warning about this now for months. We've talked about it here as the clear risk that tech was going to roll over once quarantine ended. It's like you take that, you combine the peak earnings with the inflationary impulse. So the peak earnings story was enough to kind of get this weakness going, and the inflationary impulse was really the risk point to make it even worse, right? To exacerbate the selling, as you and I talked about yesterday coming into the inflation print, where even though we were expecting to see warm inflation, if it beats, then we're going to have problems, and we've got some problems here. So what stops this? I mean, what turns this around? Is there a silver lining here at this moment?
I think there could be, Oliver. The problem is this is a monthly issue now. We're going to have to look at this number every single time it comes out and have kind of this same uneasiness around it.
Transitory is not going to be a month.
When you look at stocks, though, there was a repricing that clearly took place around this. However, we talked about this yesterday on the Market on Close panel, where we said bonds have been pricing in inflation for months now. I think you look at the reaction today in bonds, and you really look at the reaction today in the dollar, and you say some of this has been preemptively priced in. The dollar should not be higher if this was entirely a surprise to the market. The bond market held pretty flat initially. It has somewhat sold off now, but it's not a massive move. It's not a move that you're really shaking your screen worried about. The tech trade and the stock trade in general, the broader index, the S&P 500, that's where the surprise was. And I think it's not entirely confusing to see that, because so much of the narrative for the S&P 500 has been tied to recovery. Well, higher interest rates and inflation can derail a recovery. And of course, if the Fed's truly on the sidelines, that bolsters the NASDAQ ahead of its peers. Well, if that narrative comes into question, you're really going to feel that pain trade within the NASDAQ. So I think there was a stock repricing today. Is it day two of a several-day sell-off? We'll have to find out. But I think it is encouraging to see some of these more risk-off assets performing the way they are today in the midst of really was pretty historic CPI number.
Okay. Hey, Alex, real quick, what are you trading today?
We have a couple earnings names, Oliver. We're going to look at Alibaba ahead of its report. Like Folio is going to stop by. We're going to talk some Sonos.
All right.
And we're going to close out the show talking one of Kevin's favorite names, the industrial plane maker Boeing.
All right, the industrial plane maker Boeing. Thanks, Steph. Thanks, Alex. That's it for Morning Trade Live. We'll see you this afternoon for Market on Close. That'll be after the U.S. Treasury auction that happens at noon Chicago time. Keep your eyes open.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
(24/7) access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ, Rewrite tomorrow.
Good morning and welcome to Fast Market. It's Wednesday, May 12th. I'm Alex Coffey. Big day today in the market. CPI day, surprising number, sends the market lower. Let's take a look at where things sit 90 minutes into this morning's trading session here. A lot of red on the board here as we take a look. The S&P 500 currently sitting down 49.5 points. It trends towards the lows of the session, down 1.2%. The NASDAQ 100 leading the charge to the downside, down 286, 2.15%. The Russell 2000 down 1.33%. And the Dow Jones, the strongest of the bunch, but still down almost a full percent, down 8.85 or 292 points here for the Dow. So about 0.9%. Guys, let's go to the platform real quick if we can, though, because I want to break down some of these reactions around the report, because I think there's a takeaway to be had. And of course, we'll get the thoughts from Kevin and Tom White here in just a moment as well. But looking at the NASDAQ 100, this is where the pain would be felt if inflation truly is a surprise. The Fed has to step in, raise rates. It's more pain on kind of what's already led the kind of the downward move in equities. Well, today we got a little bit of that response.
So over to me, Alex. Thank you very much. What Alex was doing, he was looking at the reaction in the overall indices to the CPI data. And what I thought happened in the CPI data and why the markets have softened here from that level is the fact that the 10-year yield, which originally had a very muted response to the CPI data, actually started to weaken even more or rise even more. The notes and bonds are down more, and the 10-year yield, if you look at a 1-day, 1-minute chart, which I love to do on these days, we sit 1.684, which is where we hit the high, but the 10-year yield has climbed all day. So I think that is what is keeping a hood over stocks right now. I think that is what we're looking at when you have a down market. We knew this number was going to be hot. We knew the 4.2% number was going to be a warm to hot number. But if you look at the comparison, what I talked to Oliver Rennick about this morning was the comparison between where we were a year ago and where that year-over-year comparison was. Remember, a year ago in April, where we hit probably the depth of the pandemic during this. So I expected this number to be a big one, especially in the year-over-year numbers. I think some of the data, when you break it down, was not as harsh as we originally expected. That said, this market is paying attention to one thing, and that is yields on the 10-year. And they have continued to climb throughout the day, and that's why I think you're seeing weakness. Let's bring in our other guest for today as we wait for Alex to reconnect, Tom White. Tom, what did you see from the number today? I think that the fact that the 10-year has continued to creep higher is what's affecting stocks as we get to the 10 o'clock hour, Tom.
Yeah, to your point, Kevin, I think the big shock for me was that initially when this number came out, that bonds didn't really do too much. They went down from elevated levels at the start, but we didn't get to see that acceleration to the downside in treasuries with yields popping for about a half an hour to an hour, which I think is, to your point, putting pressure on the equity market and those risk assets as people, try to figure this out. Now, there's one key thing to look for at noon Central Time here in Chicago is that 10-year auction that's due. If that one's bad, does that reverse stocks at this point? Or if it's if there's a lot of bidding for those treasuries and it's just a strong report, are we going to get pressure to the downside on yield? So we'll have to wait and see on that. But to your point, Kevin, I think if you look at what the Fed had mandated, what they're going to do, let inflation run a little bit hot. So this basically is right up their alley. It's a really hot, strong number out of CPI. But Kevin, we talked about this before with Alex, is the fact that with the PPI numbers that we saw in February and March that were hotter than expected but haven't flowed into the CPI data yet, well, now you're seeing it. But I think the key thing moving forward here is everybody says this is transitory, right? But I look at inflation being like toothpaste getting let out of a toothpaste tube, right? It's easy to get out if you stomp on it and it just pours out, getting it back in, because that's inflation. It's not going to be transitory, I think. I think it's going to last longer than you expect because those price pressures aren't going to dissipate over the next month or two. This base effect that they keep talking about, I just don't see it. So we'll have to wait and see on some of the data points moving forward.
Guys, it's really hard to speculate on the direction in which inflation may go, how long it will last. It's difficult. It's been something that the Fed is trying to spur for really decades now. But Tom, the one thing that I think that you're on to something, it's a point that I've made, I think, several times here on the program and across the network, which is with the Fed's kind of taking a back seat, letting inflation potentially unfold before stepping in when it gets worrisome, it's already out of the tube, to use your analogy. So it's going to be very difficult. The big thing is trying to prevent it from coming out of the tube to begin with. And so I've always had concerns with the Fed potentially being late to the show. But guys, we wrap up everything here and we kind of bring it all full circle. I think the response in stocks is telling. It says that the stock market has been riding high on this kind of transitory narrative. But you look at some of these other assets here, gold lower. That tells me that gold has somewhat priced this in for a little bit, at least this print or this kind of direction inflation. It took the bonds all morning to sell off a point. They're certainly not on their highs in terms of yields, at least initially here. It's saying that the bond market has been a little bit ahead of this as well. But most perplexing to me, Kevin, is how is the dollar up a full half point here in the U.S. dollar index futures if we're really worried about inflation? And I guess you have to say the dollar has sold off extraordinary amounts over the last couple of weeks. But to me, this is the head-scratching move of the day.
Yeah, there's always one, Alex, isn't there? You look at a reaction to this number and you go, boy, the dollar. You know, now, in all honesty, full disclosure, the dollar had sold off pretty dramatically over the last few weeks. So maybe there was a little flight to quality there. But you're right, that's counterintuitive to what you would think is going on here in terms of the strength in the U.S. dollar. And you look at the softness in gold, that's directly linked to the strength in the U.S. dollar. The U.S. dollar's having a pretty powerful move on the upside today. So that's probably making a lot of commodities. I see gold, I see copper, I see Bitcoin is now down 1.5%. Pretty interesting price action here as we get to midday. But, you know, the risk-off assets, you know, bonds have crept lower, not really spiked lower. I think the VIX is now 24.5. That's really the biggest mover of this move. I think how VIX has reacted to move down in stocks. So, yeah, there's a lot of things moving on here, but the dollar is a very interesting take on this market, Alex.
Guys, let's talk some trade management here. We looked at EA yesterday with Mr. Bill Ruby, Kev, if you recall, and we did kind of an interesting iron butterfly, but we scooted in a couple ways and we took risk in certain directions here. And with kind of the volatility crush that we've seen, even though we didn't necessarily get the directional move we were looking for, we actually have very, very nice open P&L on this one, simply because of the strategy selection and the lack of movement in response to EA's earnings report. Right now, up about $1.25 per each one of these spreads. And Kev, we said yesterday, this is a strategy that you put on around earnings. You typically look at the next day, you get that volatility crush, and you look to buy it back. Is it time to think about buying this one back, even though there's $3.29 left in this particular trade?
Well, I mean, that is the choice of each person. Yeah, you're never going to max out on a trade like this, selling the straddle and buying the wings. You've got a nice profit. You didn't get the directional move you wanted, but you did get a muted move. So all things being considered, Alex, I think you take your profits. They're not as big as you'd like, but they're certainly profits, and move on to the next trade.
It's important to note, too, with this type of strategy that we would need it centered around the 142 mark, with right now EA trading at just under 140. Some of that's, actually intrinsic value in these options. So if we just fast forward to expiration, not all of this would come out. So that's important to note, too. It depends on your outlook for EA, but we'll continue to kind of work a closing order there, and we'll see if we're able to get filled. Kev, the final one to look at here, we only had 2 earnings trades. This one's very interesting, which is Fubo TV, because the strategy selection and the movement we got post-earnings are almost a perfect match here, Kev. With the stock trading 2027, we have the long call diagonal where we're short the 20 call, long the June 15 calls.
Yeah, this one, and this is when you tip your hat to Likefolio, whose, frankly, their data was different and stronger than we thought it was, and it changed our strategy on this one. We went from a more passive trade that we were thinking about to a more aggressive trade, and that aggressive trade has worked out pretty nicely as it's gone right towards our short strike. We did the 15-20 diagonal, and we got a nice move in Fubo right up to the $20 and change. This is kind of it doesn't always work out this easily, guys, but this is a pretty good move here.
Guys, what I'm going to do is I'm going to take off one of them. And Tom, I want to bring you back into the conversation here, just kind of philosophically and theoretically. If you're talking about a name that maybe you like long-term, that's why you chose the long call diagonal. Maybe earnings was just kind of the reason to push the button, if you will, what got you motivated to actually make the trade in the particular name. You get the move you want, maybe a little bit quicker than you anticipated, but that's a good problem to have. But let's say we wanted to maintain at least some position here in Fubo. Now we kind of face the question of, do we roll this out? Do we change the structure of the trade? What are some of the questions you ask yourself when you're in that position where you're long call diagonal, where basically it's moved right to your short strike, a little bit through, and you're coming up on expiration when it comes to rolling and potentially maintaining a longer term position?
Yeah, there's a couple different ways. Like if basically taking off maybe half of the trade because it's worked out so well, you did it as an earnings play. But if you still believe in the position over the next few weeks until June expiration, this gives you a perfect opportunity, because that's what diagonals do, as opposed to buying verticals or just buying calls outright. Is it allows you to adjust and manage that trade, which actually reduces risk, reduces your break-even point, increases potential profitability. So taking off half the trade and then starting to roll, with it being at the apex of your profitability on this type of trade at the 20 strike, I believe the roll value just on a week-to-week basis right now, with 2 days to expiration, is over 50 cents per contract. So you can start whittling more away at that. But at the same time, because it's a diagonal and you're dealing with that embedded calendar spread, your profitability can actually be higher than the initial risk profile that you saw there. So that gives you that increased opportunity on that side. So manage. If you did it for an earnings play, you can take the whole thing off, lock in your profit, take your capital, move on to another trade. But if you still believe it's going to hang out around this 20 strike within maybe $1 or $2 either way, this is a perfect opportunity to reduce risk, increase potential profitability.
And so, Tom, I went ahead and did what you said. I took off one of the 2 that we had, and then Kevin, to kind of keep on the kind of the theme that we typically do around our example trades and trade management, I went out 1 week and I was able to actually move up a strike. So we'd be selling out of the money premium, and we were able to get a small credit here. So we'll gain $1 in strikes and then a small credit to kind of continue this position and keep the dream alive here in Fubo. We'll work one of these rolling from the May 14th 20 call to next week, the May 21st 21 call. And it'll keep a very similar risk profile. It'll move up our short strike slightly, but it extends duration a little bit. So we'll work that here. Guys, let's talk some Alibaba. Kev, this has been a very interesting name to monitor for quite some time now, because this is one of the pockets of the market that really performed strongly in the initial parts of the recovery. But since basically fourth quarter of 2020 has really trended downwards quite substantially, losing about a third of its value over that time frame. So you can arguably look at this and say it's somewhat been an underperformer, even though it was so strong for so long last year.
Yeah, the question is why, right? Because, let's face it, this is a company that does most of its business in China. And Jack Ma, the CEO of this company, got himself in a little bit of regulatory trouble with China. And they imposed a fair amount of sanctions. He just paid a $2.8 billion penalty to Beijing. He just, changed parts of his company to make his e-commerce platform a little less anti-competitive. So, but, this is, Jack Ma has some serious problems over there with not only Alibaba, but the Ant Group as well, and everything he's doing. So there's a difference between what's going on in the United States, what's going on in China. It's not just free, open market capitalism going on in China. There's some other things that may cause some uncertainty in this name. So it's still a great company that makes a lot of money and brings in a lot of revenue, but there's some geopolitical risks involved in this name that at least have to be accounted for, guys.
Definitely, and that's, of course, not unique to Alibaba. Of course, any name that's going to have exposure to other countries is going to have different things geopolitically to consider. But the interesting thing here, Tom, is this stock's really come full circle. You go back to the beginning of last year, the stock's not even up a full percentage point. It's only up 0.5%. So this is really one that has been a roller coaster ride of sorts, to the upside, to the downside, and really back to where we started here. So, Tom, talk to us a little bit about trading here, because it's a $220 stock, likely one where risk-defined option strategies make it a little bit more accessible. And there's still a decent amount of volatility in this name, looking for about an $8 move in either direction. So we can say about 4% up or down. It's fairly healthy with its 66% IV for this Friday's expiration.
Yeah, I think the big thing, I think it's perplexing for a lot of people. Kevin mentioned all the headwinds that have been created and has dragged the stock down nearly $100 since hitting those all-time highs last November. Everybody's wondering, like, hey, Alibaba is the Amazon of China, right? Their user base is nearly 800 million people. That's more than double the population of the United States. So think about that in scale. Now, one of the things that they're relying on for their growth in the future is going to be their cloud business, right? They already own over 40% of the cloud business in China. They grew revenues at 50% year over year last quarter. That's supposed to expand to about 60, 64% this quarter, but this stock can't get out of its own way. So if you're going to trade this, you have to be cognizant that there are regulatory issues, and maybe we don't have as much transparency and clarity about their businesses, but they're in everything that Amazon is, whether it's cloud, selling to consumers. Their consumer base is huge, and then AI, Internet of Things. I mean, they're involved in everything. So they have a lot of pipelines, just like Amazon did. And you have to remember that what happened to Amazon after their earnings, it was a blowout quarter, right? And actually, China recovered a little bit more quickly as far as the pandemic goes. So maybe expecting blowout numbers, but you want to be risk-defying going into this. So I just looked at something really simple to the upside, taking advantage of that about $8.50 move plus or minus that you're looking at for the shares according to the option market, where just buy a simple 1 week wide call calendar to the upside, where you buy the 230 strike call in the May 21st monthly options, and then you sell the near term May 14th 230 strike call, creating that just a 1 week wide call calendar. It's trading around $1.30. And that's with the idea that, hey, maybe we'll see a good number, and tomorrow it pops up to around 230, but you've got a wide range for it to trade in to the upside a little bit to be profitable.
Kev, we talk calendars almost on a daily basis, I would say, here on Fast Market. So the trade, as always, we're looking for a movement towards the strike. So in this case, 230. It'd be a move to the upside, and that's where you kind of see the mountaintop peak on the risk profile as we approach expiration of the short options. $1.25 if we're filled there, that would be the risk on this trade. And really, the risk is the stock moves drastically far away from 230, be that to the upside or the downside. Kind of trending towards 230 or slightly beyond is likely to still be kind of in our profitability zone as we approach expiration. But Kev, I want to show a quick side-by-side here and then get your thoughts on the trade between Alibaba and Amazon. And the reason I think we maybe can kind of put to the side some of our earnings responses and our theme, Amazon is up 67% since the beginning of 2020. As we just said, Alibaba not even up a full percent. So it's not pricing in all this optimism that so many of these US-based big tech names have. And that could actually lend to an advantage to the bullish side potentially. Maybe there's actually some room for some upside surprise here, Kev.
Sure, because just like when we talk about Facebook, right, and all the regulatory and political issues that surround Facebook. But, however, Alibaba's revenues are supposed to be up 58% for this past quarter. So that is a number, it's going to be about 28 billion US. So this is a company that when their earnings come out, you don't really talk about the geopolitics. You just talk about the earnings and how much money they made. So this may be a rare case to trade Alibaba without the wet blanket of geopolitical risk. So I think this is a good opportunity. I think Tom's got the right trade here. $1.2325. It's trading at very low levels that might give you a nice, if you get a nice move towards right around the expected move of 230, you can have a nice winner here. Right, obviously the risk is this is a bullish play. You want the stock to go at least towards 230 to be profitable. It's a 1 weeker, so you've got a short period of time. But I think this trade fundamentally sound. Small to medium accounts can trade it. It's risk defined to $1.24 where it's sitting right now. This is a fundamentally sound trade, guys.
I filled 3 in the example portfolio at $1.25. So most importantly here, as we do kind of take an upside shot, it is a little bit speculative in terms of direction. It's risk defined. We know the risk going in, and it's limited to that debit spent times the quantity of calendars that you do. Tom White, it is always a pleasure. We appreciate you stopping by this morning. We look forward to talking to you again soon. All right, Kev, let's take our first short break of the program. We get back. We have an interesting conversation coming up of one of these consumer products. It's been very interesting to track. That, of course, is Sonos ahead of its earnings release. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities. Trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey alongside Kevin Hinks. Kev, S&P is holding fairly stable, but still down substantially here, down 47 points. The NASDAQ down 253. Russell and the Dow down quite substantially as well here, about 0.9% for both of them. The Russell, though, relatively gaining some ground on the Dow. So we'll continue to monitor that. Gold lower, crude oil higher, the dollar higher, as we said. Bonds lower as well. So some interesting moves kind of brewing here as the day goes on, but still plenty of trading day left. Let's shift gears though and talk some Sonos. I want to welcome in TD Ameritrade Network contributor Jenny Horn to the show to set things up here. The consumer product, oftentimes associated with its speaker systems that interact in kind of a smart fashion, a very interesting company, and one that's had a really, really nice run over the last year and some change.
Absolutely. So this is one of these high growth tech names we talk about a lot that have witnessed sort of a degree of rotation now, falling about 5% ahead of its earnings today. But what is interesting, I actually think about Sonos is a lot of its tech peers saw this weakness hit at the end of 2020, beginning of 2021. This stock, rallied up until about April 14th when it hit all-time highs of $44 a share, and now has fallen about $12 off cents. So it's sort of interesting to me that this stock sort of waited to take a pause. So it makes me wonder if something else here is going on. But this is obviously a highly competitive space. And earnings, which will be announced today post-market, are actually expected to grow, despite some of this weakness we're seeing in the stock activity lately. So analysts are expecting a year-over-year rise in revenue of about 44% from a year ago, with quarterly losses totaling around 22 cents a share, which would signal growth of still 54%. So despite the fact that they're not able to turn a profit or expected to not turn a profit, they are still growing year over year, which I think is a good sign. Now, another thing that's interesting about Sonos is it is high end. I mean, these are speakers that are not cheap, not for the faint of heart. Their baseline speaker starts at about $179, with some of their surround sets costing as much as $1,900. And what I think here is that there's so many players now in this space. What was once sort of dominated by, say, Bose and Sonos, now we have Amazon Alexa's offering different kinds of speakers. We have Apple offering their HomePod speakers. So all of these sort of tech giants are now offering their own version of speakers, which I could see being a headwind for Sonos long term. But it is very focused on growth and staying relevant in this competitive market. It announced in early March its entry into the highly popular portable speaker market, which I would say it's about time. I have a Jambox I think I bring with me everywhere. But they also announced it earlier in 2020 that they will be offering a new ad-free HD streaming tier of their radio service for about $7.99 a month, to compete, of course, with a Spotify and Amazon Music and Apple Music of Pandora. So they are really, really trying to stay relevant. And some of the theme I think we've seen over the last year is similar to that we've seen in these home furnishing retailers, like, say, a Wayfair and RH or a Home Depot or Lowe's, where just because we're spending more time at home, we want to, say, purchase more things for our home. So that sort of brings me to our first tweeter today, which talks about this extended time spent at home. She says, "The best investment my parents made was in our sound system. These Sonos be keeping me alive working from home when I'm by myself." So I thought this was interesting because it's so true. I mean, there's things we just bought over the past year because you were like, hey, I'm spending so much time at home, I'm not eating out, maybe I'll splurge on these speakers. So I thought this just sort of speaks to the price activity we've seen over the last year. But our next tweeter sort of focuses on this earnings and some of this price activity around this next earnings report, which we'll get today after hours, which says Sonos earnings released today after the bell. Must keep above 34.52 for some hope and stay above 35.80 for max hope. Otherwise, you see the beginnings of a descending channel. $30 to $33 is possible. Sonos is up 49% overall since January 2021 and is up 267% from 1 year ago. Careful. So I loved this because it sort of highlighted something I believe we all discussed yesterday, where it depends really the time frame you look at with these companies. You look at a year-to-date chart, it's actually fairly strong. You look at a 3-year chart, it's very strong. And you look at, say, a month-to-date or a week-to-date chart, it sort of paints a different picture. But all things considered, Kevin, I would say that there's a degree of stickiness, which we often talk about with these tech names, in Sonos, because say you purchased a Sonos speaker, you're more likely to purchase another Sonos speaker to sort of create this whole ecosystem. I don't believe you'd be purchasing different speakers because they all sort of work in tandem. So I would say all the people that started investing in Sonos over the last year will most likely continue investing because they all work in tandem, Kevin.
Jenny, you brought up a lot of the most important points about Sonos, is that, full disclosure, this is a very competitive market and there's a lot of big players. Now, other full disclosure, Sonos are fabulous products. The wireless speakers that you can hook up to basically through Wi-Fi to your phone and the music on your phone, they are fabulous and they sound fabulous. Full disclosure, I have a pair of them. Full disclosure, Jenny Horn, your friend Alex, just got a pair of them for her birthday. So I am not only a purchaser of them, but I have bought them for gifts. They are the highest quality, and their ability to tap into the, most people, if you look at homes that are 5 or 10 years old, have the speakers in the wall that are pre-wired and cost a fortune to put in. Believe me, I'll show you the receipts. These are easy, they're portable, you can move them around from room to room. They are the highest quality sound. So now the valuations on this and their earnings that's another story, right? Because as you know, no matter how good this company is, sometimes they get overdone. The stock's down about 25% since the April 14th. So it's corrected significantly here. So this earnings play to turn this around will have to be a big one, right? In terms of the numbers they're putting up and the growth that they need to show, guys.
Kev, the ultimate compliment that you can maybe give a company is buying it as a gift for someone else, really showing the expression of positivity you have for a name like Sonos. But this is really a unique company in the sense of how everything builds together, even though it's a premium product. I've always had a pleasant experience with it as well. Jenny, great setup as always, and we appreciate you joining us as you do on a daily basis here. Have a great rest of your day, and we'll look forward to talking to you again soon. As we say goodbye to Jenny, I want to welcome in Andy Swan, the co-founder of Likefolio.com. And I think that's the perfect kind of note, Andy, to set this up as we kind of start talking about some of the data here. Another name that reports in the next 24 hours is Canada Goose. And I know that they're completely different companies, but they're both seen as this premium, high-quality product. The difference, as I see it, outside the glaring difference in the products, is you buy one Sonos, you're more likely to be a return customer because it builds on your system. You buy a Canada Goose, you're probably set in terms of winter wear for quite some time. And so the business model for a company like Sonos is about making that first purchase. And when you're looking at this, how important is that kind of a business model when you're analyzing a company?
Well, it's extremely important. The other big difference between those two companies is that, Canada Goose selling you jackets you really didn't need because you really weren't going anywhere over the last year, whereas Sonos is selling you speakers and sound systems that you really did need because you weren't going anywhere last year. So I think that's the big difference. And for us, we're looking at, there's this balance with Sonos that's really difficult to analyze, and that is, how much demand did they pull forward into 2020? And you can see it on this chart of purchase intent mentions from Likefolio. So this is people talking about, buying the Arc and Move products from Sonos, two of their biggest hits. One, very expensive, $800. You can see on that kind of second hump right in the middle, a a massive acceleration of adoption of consumer demand for these products as the pandemic started to take hold. Folio was able to get out in front of this because of this data, put out a bullish report on Sonos under $15. We saw this demand coming into the market. Now, as we get into, May of 2021, things are a little different. Still higher than what we saw historically, so that's good, but definitely significantly lower than what we saw in 2020. In other words, there was definitely demand pulled forward. But as you point out, that also brings more consumers into their ecosystem, which is good long term. So you've kind of got this dueling narrative, I think, going into earnings, and that is, all right, you had a great 2020 because you pulled forward a lot of demand. How well are you executing on upselling and cross-selling those customers, or turning yourself, like Kevin, into a gift buyer for others? That's what's going to be the biggest, point of the call, I think, for Sonos. And I think it's going to be very difficult for the executives of Sonos to give very clear guidance. It's one of those things. This was a once in a lifetime, hopefully, type of event. They benefited greatly from it from a sales perspective, and now it's got to be all about selling those new items into that channel. And it'll be very interesting to see how they report that's going.
Andy, when I look at this company and I see how they have entered this market, and like I said before, you look at any house that's more than 5 or 7 years old, and they've got speakers in the ceilings, right? And this is like a game changer to home sound, much like the iPad or the Apple devices were changed to music and how you listen to music. For someone who has music on a lot at their house and has paid exorbitant amounts of money for speakers and home wiring in a house, I can tell you that this product is really affordable. So the price tag that you it may be, it feels expensive, but I guarantee you, I've spent multiples more than that on a inferior product. So the question though is, how much was pulled forward? And how much data can you show? Your data looks like, correct me if I'm wrong, Andy, it looks like where the data is sitting right now is matching that peak around December of 2019. And that seems like a fairly positive reaction. And it goes back to that stickiness that we've been talking about. It looks like some of their customers that they're holding on to and becoming, not only buyers of them, but buyers of gifts for them, like me, Andy.
Yeah, I think so. I think the one thing about this chart that troubles me a little bit is that there's no reason to think that there's no trajectory towards being able to put up comps anywhere near what they had in the summer of 2020. It just doesn't look like it's going to happen. So they've created a new baseline at higher levels, which is fantastic. They've got some really difficult comps coming up. And just from a personal perspective, I'll agree with you on the speakers. We just moved into a house that's maybe 10 or 15 years old. There's speakers in the ceilings and the walls, and one of them wasn't working. And a guy had to come out and crawl through the attic to try to figure out where this wire had gone wrong. And I'm thinking to myself, man, if we had just had, something better. But on the other hand, I do think Sonos has, significant competition. Their speakers are really good, but so are a lot of people's speakers. I don't think it's nearly as difficult as it used to be to create a great speaker. And so the competition that they have is really coming along right as their company was poised to shine. So it's a tough balance with Sonos.
No, and especially as kind of smart interaction of technology is really accelerating, and that was really something that set Sonos apart. But Andy, I want to zoom out here a little bit, and obviously Sonos in a unique position here. It's going to have tough comps coming up, as you said, a lot of demand pull forward. We know the interactions between the products themselves and the build on, but general kind of trends. You're watching macro trends as well, and we read all this about people moving out of cities to more suburb kind of environments, starting families, getting houses. The housing market's booming. you just mentioned recently moving, I believe. And when you look at all of that considered, isn't all of those kind of macro trends setting up favorably for a company like Sonos? Although, as you said, competition really ramping up as well.
Yeah, absolutely. I think every macro trend that we track, so home renovation up 41% year over year, from really good levels. That urban exodus mega trend that you're talking about, all of those types of trends definitely in Sonos's favor. In fact, just the quality of entertainment that you're able to stream through devices and then wanting to put that out into good audio experience, I think is another thing that's just, driving people towards these smart speaker, high quality speaker solutions. The question is, can Sonos hold off the competition? How much did they pull forward demand that would be hitting now? And then the big question is, once they get people in that ecosystem, can they convert them over and over again to new products, or do they tap out? And I think that's the biggest question for this company over the next 2 to 3 years. And it'll be really interesting to see what the early indications are. Hopefully management's able to talk with some clarity on that, although I doubt it on tomorrow's call.
We're looking forward to it. We're looking forward to getting these answers over the coming months and years in regards to Sonos and so many of these other companies. But Andy Swan, it is always a pleasure, the co-founder of LikeFolio.com. Great insight, great conversation. Look forward to talking to you again soon. Kev, I think there's also an interesting kind of stock market implication question to be answered here as well. And of course, I'm not saying that as Sonos goes, the market goes, but this is one of those unique situations where the market can either look at things glass half full or glass half empty, depending on what these numbers are. You can look at the performance over the last year, Kev, and say it's up 100%. You can look at the performance as of late and say it's down 25%. We can look at, as Andy said, settling to higher numbers potentially, which is good for the long term, but potentially difficult comps. And so I want to see, what does the market latch on to, and what are we favoring right now? With that, I'll pass it to you to walk us through an example trade and see how we want to approach this one.
Yeah, this trade, Alex, is tricky, and it's tricky for many reasons. But I'll tell you one thing that makes this easier, and that is the price of this underlying only being $32, right? You're not trading a $250 Teledoc or DocuSign or something with big numbers that there's been a major correction. This stock has lost 25%. Now it's trading from 44 down to below 33. So at least you don't have big in terms of, another 10% from here is $3, right? It's not a catastrophic move. So that makes it a little more palatable. The other problem is no weekly option, so you've got to trade this on a monthly. So here's what I came up with, although Andy has shaken my confidence in this trade ever so slightly. But I'm going to do the June expiration, May expiration, 30-40 diagonal. And it's trading about $4. I don't want to do a lot of them because I've lost a little confidence. But I think with a 25% correction in this name, that a lot of the bad news or the lack of ability to keep this going is built into this. So, but we'll see. I don't trade this with a lot of confidence, and the fact that I'm trading a monthly. But remember, over the next all the way out till June expiration. Go ahead, Alex.
So I always, full disclosure, we don't talk these trades through before. We want to make it as live as possible. We want to get the information, kind of build these real time. I always kind of in my head kind of guess what you may do. And this was the strategy that I thought you might select. But as you say, maybe your confidence is a little bit shaken here. Do you ever consider rolling down that call maybe to the 35 then? Reduce the deltas a little bit, chip away at the debit, lower our break even slightly, although we pass up some upside. Is that ever something that you would consider doing, even though we'd be selling it a little bit inside the expected move?
Great question and great discussion topic, right? Because, yeah, the expected move is $4.50, which takes you to about 37. So you've got a decision to make. You're either much higher than the expected move or lower than the expected move, and you're right in the middle. So that is a great thing that each viewer can decide whether they, because you're right, maybe based on like Folio's presentation, we bring that down to the 35 and take a little more money, because you're basically, the 35-40 call vertical in the front expiration is about $1. So you'd be taking about another $1 out of the premium. That brings it down to $3. Mm-hmm. And now remember, you've almost got about $3 in intrinsic value on this trade. So that makes it a lot more palatable. Actually, I like the idea, Alex. So let's do that.
Another thing
let's
too,
make it the 30.
Well, I was going to say, if we wanted to make this really interesting, Kev, we could do one of each, and then we kind of synthetically have the 37.5. So you can kind of adjust things here. And as you said, depending on the outlook that the individual may have, be that on Sonos or any name, you can see how slight adjustments can make pretty big differences and really change the kind of the makeup of the trade.
Yeah, you're on fire, Alex. I mean, if you do two and you do one at 35 and one at 40, you basically did the 37 if you look at it like that. So I like that idea too, actually.
And so we'll do that, make it a little bit more fun, and we'll also have a little bit more to talk about for trade management. Hopefully we get an upside move, so we have the opportunity to really talk that through tomorrow. But what you're going to see is that the ultimate position in the end will show two 30 calls in June, and then we're short 135 call, 140 call, creating kind of a synthetic 37.5 call in terms of how this will perform on an upside move. But Kev, we're going to take a short final break here. We come back, we're going to talk another one of Kev's favorites. That's Boeing. Boeing on the move lower here today, 225, down 350, about a 1.5%. Stick around. We'll be right back.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Let's look at the stories making headlines this hour. Ahead of Target's earnings report next week, UBS raises its price target to $210 from $185 and keeps a neutral rating. UBS thinks Target will report same-store sales growth of 12% compared to the consensus estimate of 9.3%, mainly because of its apparel and home furnishing categories on easy comparisons. Apparel was down 20% in the first quarter of last year. Meanwhile, Morgan Stanley maintains Target with an equal weight and raises the price target from $195 to $205. Shares of Domino Pizza are up 1.6% after Bill Ackman's Pershing Square Capital sold Starbucks stock to swap into Domino's Pizza. Bill Ackman said he now owns about 6% of Domino's Pizza, around $330 a share. He said he likes the restaurant industry, and Domino's has technology and delivery, and they own their own delivery infrastructure. Starbucks is down around 2.5%. And eBay will now permit NFT sales from approved sellers. The company says NFT inventory will be provided by trusted sellers who meet its high standards across categories like trading cards, music, entertainment, and art. It also said in the coming months, eBay will add new capabilities that bring blockchain-driven collectibles to their platform. This has been your TD Ameritrade Network Market Update. Now back to Fast Market with Alex Coffey and Kevin Hinks.
Thank you, Stephanie. I'm Alex Coffey. He's Kevin Hinks. Kev, I got a little overzealous there. Wanted to talk some Boeing with you, but let's come back to Sonos real quick. Just want to cover the risk reward in the trade and talk some break evens here, and then we'll dive into some Boeing talk. So we looked at the long call diagonal. We talk about this strategy quite frequently. We refer to it as the stock replacement strategy. And as always, if you do nothing with the trade in terms of rolling or adjustments, the debit spent on the trade is the risk on this trade. And so in a way, it's one position, but it's two separate trades. So we filled at 313 and 409. So each one of those would be the risk on those particular trades. And then the overall risk on the position would be $722. The break even, Kev, you take that 722, divide it by 2, you're left with 361. You add that to 30, that would be the break even for the overall position. Each independent trade, of course, you just add the debit to that 30 strike. So 33.13 for the 30.35 and 34.09 for the 30.40. All right, let's talk some Boeing here. Kevin, I want to hold you back because I know you're excited here with this one. Incredible ride that we've seen with this one over the last few years. And 2021, while on the chart might seem a little bit less volatile, has certainly not disappointed when it comes to Boeing.
Yeah, Boeing is an interesting company that has really caught my attention in the last few years with the 737 MAX. Now, as we know, April 7th, there was some electrical problems with the 737 MAX that caused some of those planes to be pulled out to be fixed, some wiring. Now, even today, the FAA administrator, the news out is that the FAA administrator calls the electrical issue that has grounded some of Boeing's 737s a straightforward fix, and that he has full confidence in the safety of the 737 MAX. So they're getting some incremental good news about this. Chairman Dave Calhoun says he's finalizing plans to put the 737 MAX back into flight. So there's good news there. There's been more sales of the 737 MAX. But, you know, a lot of the things that this company does, and the high profile part of this company is the 737 MAX. But did you know, Alex, it should be a new segment. Obviously they make Air Force One. Obviously they make the Chinook helicopter and the Little Birds and the F-15 and the F-18 fighter and the B-52 bomber. They are a huge, enormous defense contractor as well. So there's a lot of interesting things going on Boeing aside from the 737 MAX. That being said, the 737 MAX is where they have a lot of their chips slid to the middle of the table, right? So they have a lot invested in this plane. That is by the chairman of Southwest's comments, 15% better fuel efficiency and 40% quieter than the comparing planes. So a lot of positives here, but they got to get this planes back in the air, get through all their inventory. They're start ramping up building of 737 MAX to 31 a month pretty soon. So there's a lot of good news, but this stock is still, strong. It's a long-term play. So, Alex, with all that good news, there's still challenges, and the stock is down 1.8% today with the overall market. Now, this stock just hit $278 not very long ago. It was about March 12th. It hit $278. Now it's $224. So it's sold off about $50, which is about 20% from its highs. So I think the way you play this is to make a long-term play in Boeing, which a function of diagonals, right? So what I'm doing for Boeing is the June 18th, 225, and then this week's 232.5 diagonal. And that's trading about $10. One thing about Boeing, the premiums are kind of big, so you've got to be ready to trade them in small numbers and adjust the prices as you go along. But this diagonal is it collects about $20 a day in theta. So obviously you're going to be extending duration on this trade and using the rolling strategies to do that. But this is a play that you have to believe in a bullish future for Boeing. If you don't, this isn't the right trade for you to have on, because this is purely a bullish play. It's a calendar spread with an embedded vertical call spread that gives you a little more teeth, a little bigger delta, a little more upside direction to this trade, Alex.
Boeing's had just about all the negativity one company can stomach thrown at it over the last couple of years, and at least for now, certainly still standing. But Kev, the one thing too to consider when you see kind of the same strategies across the different names,
we are going
it's a function of where volatility is. Kev, IV percentile for Boeing is in the single digits. Low volatility strategies, things like calendars, things like long call diagonals, are the strategies that are implemented in lower volatility times. And so
on
we're
average.
taking a buying the dip as well. Stock down $4 today after some weakness as of late, as you highlighted.
Right up here,
But
which
10,
is
20 upward build there would be the
55,
risk,
56.
assuming we did nothing
Then it went
else
down to
with this
44,
position.
went back up
But
to
Boeing, of
51,
course,
and
high premiums, as you said,
out it's probably
weekly
around 40,
options, as you mentioned as
49,
well.
50, something like
We would
that. So
have
it's building
opportunities
up this
more than
level of
likely
resistance over the
to
past
continue to chip
3
away at this
days at
10-20 debit if we're
50
filled there
cents.
by selling
Then
additional
back
out of the
a
money
month, it was
premium
kind of doing the same
as
thing
time goes
here.
on, kind of
20
nurturing that
20
225
cents,
call
really closer
out
to
into
26,
June.
27 cents
It
on
is a little
average.
bit more
And then if
expensive
you go
trade,
back
but we're going to do
farther,
two
it
to
was
give
doing the
ourselves
same
more
thing right
flexibility
here
around
for a long
management. I'm going
time,
to work it at the midpoint right now
5
at
cents.
10.06.
So
We may have to adjust that.
you
We're
can
at
look at it two
filled and
ways.
price a
Either
little
you
bit
look
to
at
the
it as
one.
it went up
So things on the move
5x
here a
from
little
here to
bit,
here,
as you see.
but then it only went up
Kev, with this
2x to here.
this is really a trade
Or
that
you can look at it as
requires
it went up
constant
25 cents from
attention
here, and
in
then
the
it went
sense
25
that
cents
you
from
may have
here.
opportunities to
And up the
roll and
next shelf of
adjust this
resistance at
that might only last
about
for
75 cents,
moments,
and
and
put the
that's kind
next
of the
peak,
crucial
this
thing when you're
double
talking
peak
about
here,
names that
double
move
peak
around as
here.
much as Boeing does.
Potentially that's up to
But all right, hey,
56 and
exactly.
72, so it's going to be
Make sure you
double.
check
So
out Kev later on this
second peak
afternoon on
up at
midday
about
trade.
$1
Sorry about that, and
20, maybe
stick around for
close
your
to
first trade
$1.50
with
at the
Scott Connor. That's
max.
coming up next. It's always a pleasure,
And
and we'll see you tomorrow.
the next level of resistance around 75 cents if it's a 25-cent trend. So we're seeing some resistance. But 25-cent trend doesn't make sense going from here. This shelf is about 1 cent.
Whether you're an
Right
experienced
there.
investor or
And
just
we're up
getting
to 5.
started,
So it's about from there,
TD
there's
Ameritrade
5x. From there,
offers a
there's
webcast
5x.
that's
From
right for
here,
you.
2x.
Are you a long-term
So
investor?
it's not completely
Our investing
consistent,
webcast
but
series breaks down different investing
there's
styles,
these
including
shelves
growth,
building,
value,
these shelves of
income, and
resistance,
more.
which is quite
Best of all,
fascinating.
you can ask questions by chatting directly with an
Which
educational
gives it
coach.
even more
It's interactive learning at
legitimacy
its
to
finest.
not
Tune in live
down to
or
nothing.
watch
Like
on demand.
a lot of people are thinking,
Head over to
I think it will eventually at some point
and start
go down
learning today.
significantly, but it builds up. A lot of people now are saying it goes up to $1. It may not go crazy above $1, but if it goes up to $1 and then
Binge
loses
watch the market
75%,
with TD Ameritrade
well, it's
Network.
still going to be
The
25
dollar,
cents. Like,
interesting
that's still
activity.
So
that's
now
still
I did some
huge.
deep
So
research into this.
People are
it's
out of the
it's a
house
very interesting
and engaging with the U.S.
situation.
economy. Tune in 24 hours a day,
SAFEMOON's
7
actually
days a
down
week on
today. It was doing really well
TDAmerictradenetwork.com
last
to
week,
all your
last
favorite
week,
streaming
last few
services.
days.
You
This
can
is the whole
also
week
take
chart
us
right
on
here.
the go with our CarPlay-enabled
Here,
iOS
and then
app
here today.
and our audio-only
Overall, still doing really
podcasts. TD Ameritrade Network
the
available
rest of the market,
anytime,
man,
anywhere.
it's not even worth talking about the rest of the market. The rest of the stock market just sucks. The glimmer of AMC volume is super low. So it's all not good. Ethereum was doing super hot this morning up to 40, but then it bounced off. About 1. It's just volatility. Not as crazy. Similar dip happened here with Bitcoin. Dogecoin to 17. So, and then Tesla's down back below 600. The second time in a week. So, I mean, they obviously bumped back up pretty high up to mid sixes, I think, yesterday. Bad day today for Big Bill. Negative 3% again.
Welcome to your first trade. I'm Scott Connor, 30-year veteran trader, and it is Wednesday, May 12th. Now, on our show, we'll be covering several topics. First, we'll kick things off with Sean Cruz, talk about the markets and the reaction to the CPI number. Then we'll join Michael Keeley, and we're going to talk about the basics of buying and selling options. What are the important takeaways? Why is it important to know about rights and obligations? We'll break those down. Then we'll join Ben Watson for an example trade on Yeti, which has earnings before the opening tomorrow morning. And finally, we'll wrap things up with Pat Mullally, and we'll talk about single option risk profiles. What is that shape? I think we refer to it as the hockey stick, but we'll break that all down for you later in the show. But right now, let's check on the four major indices. And of course, they did open lower on the surprise CPI numbers, but they have been trending just a little bit lower as the day has progressed. Right now, the S&P 500 is down about 1.6% with a loss of about 65 points, putting the S&P at 4,086. Now, the Dow Jones down about 1.3% with a loss of 441 points. That puts the Dow at 33,824, and the NASDAQ down almost 2.5% with a loss of about 327 points. That puts the NASDAQ at 13,023. And finally, the Russell down about 1.6% with a loss of 36 points. That puts the Russell at 2,170. VIX definitely moving higher today. It started off a little bit higher, but as the market has sold off, it has crept higher and to levels we haven't seen in a while. It's up to 26 now. That's a gain of 4.23 points with in terms of a percentage gain, that's almost a 20% move to the upside. So definitely a little bit of fear lingering in the marketplace as the market sort of moves a little bit lower here as the day progresses. We'll continue to watch VIX going forward. All right, let's break down a little bit further what's happening within the markets themselves, and tell you what we'll do. We'll go to the Market Watch tab, open up the quote sub-tab, look at the sectors across the board. Now, not all 11 sectors are down, as you might think. Take a look at energy. I'm going to start there at the top. That's up 2.25% on the day. We are seeing some strength in oil. We just had inventories come out. There's another drawdown this week. Yes, absolutely. So that might be adding to a little bit of the value of oil. But outside of that, it's pretty much down across the board. We see financials down, but let's move down toward the bottom here where we see some of the bigger moves to the downside. Real estate down 1.5%, industrials down 1.6%. Now they had shown some gains yesterday, particularly materials yesterday, down 1.6% as well. Communication services down 2%, information technology down 2%, and consumer discretionary down 2%. Now, these are the three sectors that are lagging today, are the ones that hold most of those big FANG-type names within IT. So we can see that's definitely where the weakness is today. Let's go to the heat map and take it a step further. I'll click on the Visualize sub-tab, and we'll look at the heat map of the S&P 500. And first of all, you can see where we see most of the grouping of those red colors. Now, remember, the brighter the color, the more it's moving in either direction. So we're starting to get some brighter colors on the red side here. I'm looking at Alphabet down 3% and Facebook down about 2.4%. Now that's communication services, and you can see that's a drag there. If we go over to IT, which we also saw was in one of the three weakest sectors, Microsoft down 2.75%, Apple down 2.5%. So again, see that. Now, consumer discretionary, well, the big names there, Amazon and Tesla. Amazon down 2.25% and Tesla down 3%. So you can see why those big names are dragging down those three sectors. But take a quick look at financials. We see some green there, a little bit of green in healthcare. And of course, if we drop down to energy, we see not only green, but actually we see some bright colors in that group. And that would explain why we're seeing some strength there. All right, well, that's a quick look at the heat map just to get an idea of what we're seeing here. Red on the left, the big FANG names, and a little bit of green on the right. some of the other sectors. Let's take a look at what happened internationally coming into the opening bell for the U.S. markets. And we can see Germany, as wrapping up the day there, up about 0.2%. France up about the same. And the UK up about 0.8. So really, we're seeing a little bit of strength as they were wrapping up the day in Europe. What about Asia? Well, Japan was down about 1.6%. But Hong Kong was up about 0.75%. So kind of mixed there, and the Dow Jones Shanghai was up about 0.5%. So a real mix there. Nothing definitive coming out of Asia, and pretty quiet in terms of moves in Europe, though it was a little bit to the upside. All right, well, that's a quick wrap-up of where we stand right now. We'll continue to watch the major indices, but let's talk a little bit about what's behind today's movement in the stock market. And to do that, we're joined by your First Trade contributor, Sean Cruz. Sean, thanks for joining us here on this day. And of course, all eyes were focused on the CPI, Consumer Price Index. And we talked a little bit about this recently coming into this number today, that if that number was quite a bit higher than expected, we might actually see a little more pressure on interest rates and inflation numbers. And Sean, it looks like that's kind of playing out here. What's your take?
Yeah, I think the number came in. It was a little bit of a headline shock when we saw the number come through, both on the headline and then also in the core reading. But I think markets are probably going to need to have this initial jolt, and the prospect of interest rates moving higher certainly is going to hurt a lot of these high growth companies where they're expected to earn a lot more and grow those revenues a lot further out into the future. It makes sense that you're seeing those companies sort of getting hit the hardest here. But if you look at the CPI data, I think it does bear a little bit of close attention to what was really in this number. And if you actually look at the number for all items less food and energy, that core reading, up 3%. But if you look at some of the data that came into that, new vehicles, the cost for those is only up 2%. But if you're looking at used cars, Scott, actually up 21%. So that's a pretty big spike, and that can drive that headline number a little bit higher. So I do think a lot of the reasons why maybe you saw a pretty big pop in this number, there's some things that I think maybe aren't going to really matter and could end up being somewhat transitory here for the near future. And I think that's really what a lot of economists are saying is this going to be something that we're just going to continue to see over the next year or two or three? Or is this just something that's really going to play out over the next couple of months? And then as we start to see a little bit more of a slowdown, then we'll see inflation moderate a little bit.
Well, Sean, let me ask you this for our viewers. They're probably wondering what this really means, in the bigger picture. What does it mean to the Fed? Of course, they're sticking to the transitory story, meaning that they expected these moves higher in inflation, and they're just going to wait and see. But we did hear from one of the Fed members, I think it was Clarita today, Sean, that said that, there was a little bit of surprise in that number to the upside. And, but initially the markets didn't really sell off that much. I thought we'd actually see a little bit more, but it was kind of tame, the sell-off. And of course, now we're creeping a little bit lower. But any changes to the Fed, Sean?
Yeah, I don't necessarily think this is really going to be something that changes the Fed. I think the reason why is when they say transitory, they mean that they don't expect it to really last long. They expect it to maybe be something that happens for a couple of months, and then it sort of goes back down closer to that 2.5% type level that they sort of target, or they think they want to see inflation remaining close to. So right now, they said coming in that you should expect some higher than what you would usually see inflation, but they don't expect it to last long, so they don't feel like they really need to do anything in response to that. And I do think it's worth pointing out, Scott, if you look at what the data that we're getting this for April, and we're looking at the change that was going on for, April of 2020 to April of 2021. And it makes sense where in April of 2020, when you pretty much had lockdowns, pretty strict lockdowns in some of the largest, economies, largest cities in the country, you're probably not going to be selling many used cars when you've got everybody locked down and no one really thinks they're going to be driving anywhere anytime soon. So that's when they talk about the year-over-year effects. They're saying, look, it's going to be some pretty stark comparisons to where we're at last year. And that's one thing you need to keep in mind. Not only are we seeing a lot of demand right now, but there was such a lack of demand last April. A lot of dealers, used and new car dealers, were probably offering some pretty steep discounts just to get people to come in and buy a car. And now they can almost ask for a little bit more of a premium on those costs because there's such a shortage right now of automobiles to go around. And you've heard that from a lot of the vehicle manufacturers too, where there's chip shortages and they're having to make decisions to maybe not produce as many cars as they would like. That's what's really driving a lot of this demand too. So you have incredibly low prices with very low demand, and now you have prices spiking with extremely high demand and not a lot of supply to meet it.
Sean, great breakdown of the CPI number, a highly anticipated CPI number. And I like your takeaway there about make sure you remember we're comparing to April of 2020, which was sort of the trough of the pandemic effect, if you will, on the market. So that's important to keep in mind, Sean. Well, let's move towards some stocks that we typically talk about here with you, Sean, at the end of our segment here, which are the mover, stocks on the move. But I think today we're looking at not so much individual stocks, but sectors. And one of the takeaways today is that we're seeing the 10-year yield move higher based on these inflation numbers. The TNX, as a matter of fact, I have a chart up right now, Sean, and I'm looking at where the TNX was just last Friday. It was down to 1.5. Actually, it got even lower than that. It was 1.47. But I'm looking at it right now, 1.68, almost up to 1.69. So 1.47 to 1.69 in about 3 trading days, Sean. So we're definitely seeing interest rates go higher. Now, this is having an effect on a couple sectors I think you're watching, one of those being financials. What's it doing there? And the other being tech companies, tech stocks, Sean. So what's your takeaway with this move in the yield higher here?
Yeah, I think it's something that is going to make sense that you're going to see banks moving higher, and that is, we've talked about this before, Scott. The Fed is pretty committed for the time being to keeping short-term interest rates pretty low. So for banks, that's usually where banks get a lot of their funding, is at the shorter term borrowing costs. Those are incredibly low. Meanwhile, you have the 10-year yield moving higher, and a lot of products that banks sell track pretty closely with what the 10-year yield is doing. So when you see the 10-year yield moving higher, that means banks are probably going to be making a lot more interest. So they borrow $10 at 0.2%, and then they loan out that $10 to a consumer at maybe somewhere up around 1.5%, 2%, or even 3%. I think it makes sense then, if you're doing that at massive volumes, that's a pretty good backdrop for the banks.
Got it, Sean. As a matter of fact, let me do this real quick. I'm just going to jump into the heat map one more time, if we can switch over to my laptop here. And I'm going to drop down to financials and open it up and drop down to banks, specifically banks. I just want to show on this red day, Sean, that we're seeing across the board, take a look at the banks. JP Morgan up on the day, Bank of America up 0.5%, Wells Fargo up 1.5%, Citigroup up 0.8%. And this is on a pretty big down day, so you're really seeing that play out here in the financials. Now, what about tech stocks, Sean? Obviously, they have not reacted well in the past to higher interest rates.
Yeah, and so when you look at these tech stocks, are considered high growth stocks because they're expected to grow revenues out into the future, not just next year or the year after, but 5, 10, 20 years out in the future. They're expected to have a lot of their growth and a lot of their full potential realized a little further down the line. So when you start to see that playing out with higher interest rates, that actually makes those future cash flows worth a little bit less. And so that's why when you start to see concerns around what's going on with inflation. Inflation rising usually means at least, longer term interest rates should be expected to rise as well. And that's going to hit these high growth companies. So I think it's one thing to see what's going on with inflation, but a lot of it is actually commodity inflation and inputs. It's not just a lot of demand, but there's supply issues just getting the commodities out of the ground and into the factories, which for the factories right now, these semiconductors, they use a lot of expensive commodities when they make these chips. When you think of all the various metals and everything that go into making a microchip, if that is something that is expected to maybe hurt them in terms of profitability, if they're getting rising costs out of a lot of their input commodities, that's something that just maybe has a little bit of concern here for a lot of investors. And also, if you are worried about not getting a product delivered that you order, you're probably just not going to order it. And so one thing we saw in the ISM data last week, Scott, that we covered, was down a decent amount. And that's because people are saying, look, I'm not going to order something if I don't even know when I'm going to get it. It could be 8 weeks, 10 weeks, 20 weeks. I have no idea. And I'm paying higher prices. Maybe I'm just going to hold off, wait till maybe some of this stuff clears out, prices for various input goods go down, and then maybe I can even get a better price in the future. But right now, you're seeing maybe a pullback in new orders, and that could really be hurting some of these semiconductor stocks. And people were expecting some pretty big revenue from these companies this year as we started reopening the economy.
Sean, great breakdown on the on tech stocks there. I went back and looked at the heat map of the semiconductors inside the information technology, and names like Broadcom, AMAT, Lam Research, all down 4.5% to 5% on the day. So you're definitely seeing play out what you just explained. Well, Sean, thanks again for helping us break down the big number today, the CPI, and what else is affecting specific sectors like financials and tech. Thanks again, Sean. We look forward to having you back on Your First Trade. Now, coming up next, I'm joined by Michael Keeley, and we're going to talk about the basics of buying and selling options. What are the particular rights and obligations that align with each of those strategies? We'll break that down for you in just 2 minutes.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Your First Trade. I'm Scott Connor. Let's check up again on the four major indices. After opening slightly lower, all four indices seem to be trending, continuing lower today. It seems almost like there was a slight like lag or delayed reaction to the CPI numbers. Let's see where they are right now. The S&P 500 down just about 1.8% with a loss of about 73 or 74 points. The Dow Jones down 1.4% with a loss of 480 points. NASDAQ down 2.64% with a loss of 352 points. And finally, the Russell down just over 2% with a loss of about 45 points. VIX holding up in the mid-20s, 26.8 as we speak. Okay, let's turn our attention back to today's topic. And as I mentioned, we're going to be reviewing the all-important rights and obligations for options buyers and sellers. Now, we'll compare and contrast the two, and you'll learn why it's essential to have a clear understanding of the distinct rights and obligations that both buyers and sellers will assume. Now, joining me to break down the essentials of buying and selling options is your First Trade contributor and education coach, Michael Keeley. Michael, welcome to your First Trade. I think this topic today, obviously something very important for options traders, particularly those that are sort of honing their skills and learning about options trading and you know, building their experience levels. These are some just foundational, very important parameters for options traders to learn early on. And these rights and obligations that come with individual options or single options. So if we're going to talk about you know, buying and selling individual calls and puts, maybe we'll start with the buyers, Michael, and talk about, you know, what rights do buyers of calls and puts, what rights do they have, and why is it important to know about these, Michael?
That's a great starting point, Scott. And it is really the foundation here that we're establishing when we say that option buyers do in fact have rights. And it can be, you know, much more clear in using an example of something like purchasing a call option. So going long a call will entitle that owner of the call to purchasing 100 shares of stock for a standard contract at the strike price up until the expiration date. And so it's, again, a really important, you know, element to your understanding of option contracts to understand that the owner of a call or a put has a right. It's not an obligation, Scott.
Very important distinction, right? Obviously, it's when just think of buyers, think of rights, and sellers of obligations. Well, let's just walk through it real quick for our viewers here that are maybe, you know, learning more and more about options as they go. Let's go to the Thinkorswim Trade tab. I put in the symbol Apple. That's we'll just use that as our example. And I'm looking at some options that expire in about 30 days, as you can see. That's the 11th of June. And you just talked about buying a call, for example. Well, I'm going to move down here, and the stock is currently trading about 122, somewhere between 122 and 123. So I'll look at the 124 call. Here, let me highlight that. Now, again, looking at the strike price, you can see that this call is the 124 strike. And that's why that strike price is so important. That gives the buyer of that call the right to buy 100 shares at what price? The strike price, 124. Now, obviously, that's higher than where the stock is now. So that option, the right to buy something at 124 when it's trading at 123, doesn't have any intrinsic value. But should obviously the stock go higher, then having the right to buy stock at 124 certainly would have value if the stock goes to 130, obviously, and it will definitely have intrinsic value. But that is an important takeaway. You have the right to buy the stock. And let's talk also a little bit about exercising, Michael. I think this is important as well. Anybody who owns that option has the right to exercise it anytime. To go ahead and buy the stock at that strike price. Is that right, Michael?
Absolutely correct, Scott. That's one of the underpinnings of owning something like a call, is that at any point in time up until expiration, you can put that that contract into motion, so to speak, by exercising to purchase at that particular strike price.
Yeah, I think it's worth mentioning also that we're speaking about American style options. Those can be exercised anytime up to the expiration day. There are others called European, which can only be exercised on the final day, right? So they will be assigned or exercised on the final day in the money calls, for example. But again, most stocks that particularly we look at here are of the American style, which gives the purchaser the right to exercise any time. All right, so I think we got a pretty good picture of buyers of calls and or puts have the right to either buy or sell 100 shares of stock. Got it. Now, what if I'm a seller of that example you were talking about, of someone buying a call? But what if I'm on the opposite side? What if I'm a seller of a call, Michael?
Yes. So this distinction between buying and selling is really critical for a variety of reasons. Scott, one would be, let's just look at what this entails. When selling an option, you're essentially selling rights to the purchaser. And another way of looking at this, of course, is to say that you're taking on the obligation as an option seller of fulfilling the buyer's rights. In that call example, the buyer has the right to purchasing 100 shares of stock at the strike price. Therefore, the seller of the call, Scott, has the obligation of selling 100 shares at that same strike price.
Okay, well, that's an important takeaway. Now, again, we're assuming opening trades, right? So if the trader has no position and someone buys a call, well, then their new position is +1. And with that call, they have the right to purchase 100 shares. Now, if I'm a seller and and it's an opening position, in other words, I had no position, now my position says -1. So I'm short a call. Michael, I have that obligation for sure. And that means no matter how high that stock goes, I have the obligation of selling 100 shares at that strike price. I think our example was $124 a share. Okay, so I think we've got this so far. Buyer's rights, seller's obligations, very important. I mean, if our viewers just took that away today alone, that would be a big first step, particularly for options traders that are, like I said, fairly new to the options trading. Now, let's talk a little bit about the risk and reward for buyers and sellers. We got the rights and obligations, but what about the risks and rewards that go with those, Michael?
Well, this is another one of those areas, Scott, in which we can really appreciate the distinction between these two when looking at these rewards relative to risks. In the long call example, the risk to the buyer is simply the purchase price of the call. So that's the maximum degree of loss that would be sustained plus transaction costs. On the reward side, the potential upside gains on a long call purchase, they are unlimited, Scott, because in theory, the stock price can go up as high as it wants to infinity, if you will. So that's the real, kind of bottom line of going long or purchasing a call option, is that you've got that, constraint on the risk. That's the purchase price of the call plus any transaction costs, and then the corresponding reward potential, which is unlimited.
Got it. All right. So that's as important a distinction as it is the difference between rights and obligations of buyers and sellers. Because now we're talking about risk and reward, and this is obviously a very big distinction as well. Let's do this. Let's go back to the trade tab for a second, Michael, and we'll go back to that same call we were looking at, the 124 call in Apple. And I'm going to go ahead and left click on the ask price to create a buy order of 1, just to buy 1. So we're buying 1 of the 124 calls. It's trading for about $3.80. All right. Now remember that in dollar terms, that's $3.80 times 100. That's $380. Now I'm going to click on the confirm and send box, and this is an important way for all options traders to get a quick look at that maximum gain that you were talking about being unlimited. Because whenever we look at this order confirmation dialog box, you can immediately see your max profit and your max loss. Now my max loss is whatever is paid for that call. So the buyer obviously has the right to purchase stock at 124. But he's paying $380 for that, and that would be the max loss plus any transaction cost. What about the profit? I'm going to highlight that. That's that word right there you were just talking about, Michael, infinite. There's no limit to how high the stock can go between now and expiration, and there's no limit to the potential gain that someone could have with that long call, all right? So they have the right to buy stock at 124, but what if it goes to 134 or 44 or 54? There's no limit, right? Now, obviously, the probabilities of those happening, Michael, are low, but we get the idea. Now, let's flip it over, Michael, and talk about the seller of the call. Now, remember, they have obligations, but what happens to their risk reward, Michael?
Right. Looking at the seller of the call, Scott, we're no longer going to define the risk as we had seen with the buyer of the call, because the seller is obligated to delivering 100 shares at that strike price, selling it at that strike price. So the higher that the stock would go above that strike, if that's the case, then the larger the losses can become. Therefore, it's really critical to, to understand that the seller's risk, their max loss, is undefined. On the reward side, however, the gains are defined. So there's a threshold to the gains, unlike what we had seen with the call, where we had an unlimited amount of gains. So the maximum gain potential in selling options, Scott, is the price or the credit received in selling that call less transaction costs.
Okay, so Michael, it just flip-flops here. So the buyer of the call has unlimited or infinite potential gains. The seller of the call has those same gains become losses, so it has infinite losses. I'll tell you what, let's go back to the trade page, walk through the process, and check it out on the confirmation dialog box. Let's go back to that same 124 call, 124 strike call. This time I'm going to click on the bid price and create a sell order, selling one of the 124 calls, and I'll keep the same price, 380, and then again click confirm and send to go to the confirmation dialog box and check out the max loss and max gain on this. And as you can see, max profit is, like you mentioned, Michael, the $380 or the $3.80 times 100. That's the max profit minus transaction cost. And the max loss, now as you can see, it's flip-flop here. Now the max loss is infinite or unlimited, if you will. So again, here we go. Rights and obligations, risk reward, max gains, max losses, all very important for buying and selling. Now, this concept of undefined risk, as would be here, we're looking at infinite here for a call seller. Maybe we should talk a little bit about this concept. This is a key concept to understand how undefined or unlimited losses or risk can factor in to options trading, Michael.
It sure is, Scott. And that's why we incorporate this risk and reward kind of analysis or perspective into the Your First Trade trader checklist. We want to be, considerate of things like time and price and those effects on the particular trading strategy that is being entertained in terms of a possibility here. But we should also recognize that where there is unlimited risk potential, human emotions can really step into place and be an impediment to traders when the emotions actually cause a trader to do things with respect to how they exit the trades based upon emotion rather than based upon the more systematic, kind of approach using logic.
Michael, that is a key consideration. And you're right. We always talk about, a couple criteria, one of those being having defined risk within a trade. In other words, especially if you're new to options trading, having short positions of calls and puts with unlimited or undefined amounts of potential loss, that can really make a difference in terms of risk tolerance and can I sleep at night with those positions knowing that I have undefined risk? These are very important questions options traders want to ask themselves. So let's do this. Let's talk about that short call one more time here. And what if I wanted to have a defined risk element if I were to sell that call, that 124 call short, and it said -1, and I have that undefined risk character. But what if I'd like to sell the 124, but I'd still like to maybe sleep at night, Michael, and not have the undefined risk? What could I potentially look at?
Yes, well, this would be, a possibility for a combination of options to be used. So, adding another leg to the option trade, as we say, to turn it into a spread, perhaps, would be a way of, curtailing that amount of risk that's on the table, and instead giving the trader an actual defined risk to this. So, adding in a long call on top of a short call would do just that with a short vertical spread, Scott, which will change the reward and risk sides of the equation. But in the case of making it a defined risk, that would be, a step that can be taken in order to facilitate that.
So, Michael, by doing that, so if a trader, options trader, didn't think the stock was going to go above 124, I think it was about 30 days from now, they could sell that 134 call. But just to protect themselves, maybe buy something like the 126 call or the 127 call, and therefore limit their upside risk to either $2 or $3 of the width of that vertical spread that you just mentioned. So again, there are ways to mitigate some of the inherent unlimited risk or undefined risk that naked option sellers would have, calls and puts. So again, we talk about vertical spreads quite a bit, Michael. So if you're following with Your First Trade, you'll obviously learn a lot about that. Well, Michael, we're going to have to wrap it up here, but I think this was a great conversation for options traders, particularly if they're developing their skills, as I mentioned, because these key takeaways are something that need to stay with you for your entire options trading career, I would say. Keeping in mind those rights and obligations and defined and undefined risks that go with them. So, Michael, thanks again for helping us all break that down and make it so clear for all of our viewers. Thanks again, Michael. Look forward to seeing you here again on Your First Trade. Now, coming up next, I'm joined by the chart master, Ben Watson. We're going to look at an example trade on a company that's announcing earnings before the opening tomorrow morning. That's Yeti, symbol YETI. Stay with us. We'll break that down in just 2 minutes.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Your First Trade. I'm Scott Connor. Let's do one more quick check on the markets. Looks like they're trying to come back a little bit, but the S&P 500 now down 1.5% with a loss of 65 points. Dow Jones down 1.25% with a loss of 430 points. The Nasdaq down 2.3% with a loss of about 311 points. And finally, the Russell down 1.75% on the day with a loss of around 39 points. Now the VIX has come down a little bit, but it's still holding at 26.10. Now let's turn our attention to a potential example trade based on Yeti. And to do that, let's bring in the chart master Ben Watson to break down the charts of the stock going into earnings. Ben, welcome to Your First Trade. Good to have you here again. And we've been watching the stock today. It's already moved down quite a bit with the market, in sympathy with the market. But for those who might not be familiar with Yeti, it's a pretty popular brand, at least it has become in the last year or two. They design, they market, and they distribute outdoor recreational products, particularly things like Yeti coolers, equipment, drinkware, etc. But Ben, we're turning to you to get a breakdown of what's happening on the charts. What are your takeaways there, Ben?
Well, I'll tell you, Scott, Yeti has been one of the most consistent trends to the upside through these, discretionary consumer products and all of the things that you listed. But now in the short term, seeing a little bit perhaps of a change in that consistency as the price of the stock has gone sideways. Now, we've seen that before. I mean, we went through an intermediate period of time around the last earnings announcement where the price of the stock was really going sideways. But now we're starting to see in the last couple of days this little bit of a move to the downside. In fact, we get the gap down sell-off today ahead of the earnings announcement that takes the price right back down to very near this support level that it's established around the 81.5 mark. And that's bouncing down from that previous high at 90.5, which is that new high that the stock has been making. So it does certainly seem to be cooling off a little bit going into this earnings announcement, at least the strength of this trend somewhat. So if it breaks this support at 81.5, you've got a support level at 78, right about the 50-period simple moving average, which is still rising at this point. And then you've got a horizontal support down around 75.5 or so, where this might settle into and find some support as well. If it bounces, you got a pretty good resistance that's been tested once, twice, now 3 times potentially up around that $90.50 range or so. But what I think maybe is a little bit more important here is the fact that the RSI, that relative strength indicator going into the earnings announcement, is breaking solidly bearishly below some of its equal lows. And that's leading price down somewhat here as we see this coming off. Now, if we look at the second chart that I've got, that shows a 3-year weekly chart. And this week's movement, despite the fact that it seems to be somewhat sideways, really does establish a pretty big bearish engulfing candle going into this earnings. So, Scott, I think as we look at this earnings announcement, you may see this sideways move, especially if price breaks that 81.5 level, becoming perhaps that kind of indication that maybe there's a little bit of a change afoot here for Yeti.
Okay, so a little bit of weakness going into this number. And like I said, Ben, when I was looking at this morning, it was $4.50 higher. So again, does that change our outlook? Well, we'll factor that in. But Ben, thanks for helping us break down the chart of Yeti. We'll have another name tomorrow for you to break down for us. Thanks again, Ben. Look forward to seeing you then. All right, well, let's go to the trade tab on the Thinkorswim platform. I have Yeti in there. And let's start from the top. Time and price. What do we think the stock is going to do? Or what would a trader think the stock would do after earnings? Well, we're going to take the approach that the stock, as Ben had mentioned, kind of hitting some resistance around that 90 area. Even though it has come down today, a trader who might think that the stock is not going to go much higher than that resistance area after earnings are announced might go above and sell a call spread. So let's open up the options chain. And right now, stock trading about 82 something. Let's go up to that 90 level that Ben was talking about. Now, right now, that 90 level is right about here, has about a 16% chance of being there. Now, that was much higher just a few hours ago. So let's go ahead and look at selling the 90-91 call spread. So selling the 90 call, and then I'm going to hold down my control key and buy the 91 call. Now, this has been trading, let's see, right now it says about 10 cents, but it's actually been trading a little higher. I'm going to around 15 cents. But here's what I'm going to do. I'm going to put it in at, tell you what, we'll put this in at like 17 cents right now, something like that, just around that area. Why? Well, because the stock has come down quite a bit already during the day. This was trading much higher earlier. And if the stock does come back and the market comes back today, if we hold a limit price up there around 17, there's a chance that that could get filled at that limit price if the stock does come back a little bit. Otherwise, at the end of the day, we could sort of rethink the limit price, and as long as the market's open and under normal circumstances, the limit price could be changed and re-entered. But right now, let's leave it in at 17, confirm and send. Max gain, $17. That's the credit received. Max loss, 83. It's a $1 wide spread. That's $100 minus the credit, 17. That leaves a potential max loss of $83 and any transaction costs. So I'm going to send that one out, let it work, and we'll keep our eyes on Yeti, see if it doesn't rally back a little bit today as the day progresses. All right, that's going to wrap up our example trade on Yeti. We'll keep an eye on it. It has earnings before the opening tomorrow morning. Now, coming up next, I'm joined by Pat Mullally. We're going to talk about single options which we just wrapped up talking about rights and obligations, but now we're going to take a little bit deeper look at the risk profile associated with them, something called the hockey stick. You'll see in just 2 minutes. We'll break it down. Stay with us.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
What do you look for when you trade?
I want free access to research,
Yep, TD Ameritrade's got that.
free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Let's look at the stories making headlines this hour. Cowen reiterates its outperform rating on Virgin Galactic after it reported a wider Q1 loss. The analyst says it's an attractive long-term luxury idea and likes its superior brand equity and unique experimental approach to space. Cowen did lower its price target to $23 from $40. Shares are down 9% today and down 30% year to date. Shares of electric vehicle battery technology company Quantum Space are down 8% even after the company reported solid first quarter numbers. Morgan Stanley analyst Adam Jonas remains bullish on the company, noting that it is doubling the capacity of its pilot battery making facility. That serves to facilitate a broader range of potential customer discussions while de-risking the path to commercial ramp for VW. He rates QuantumScape at buy and left his price target at $70. And the global semiconductor market will return to normal supply levels by the second quarter of 2022, according to Gartner Research. Gartner says that the shortage has moved from auto chips to consumer electronics and the entirety of the semiconductor supply chain. They expect device shortages to be pushed out until Q2 of 2022, but substrate capacity constraints could continue until Q4. This has been your TD Ameritrade Network Market Update. Now back to your first trade with Scott Connor.
Hey, thanks much for that market update. Just a quick check on the 4 major indices. S&P 500 down 70 points on the day. Dow Jones down about 485 points on the day. NASDAQ down 326 points. And finally, the Russell down about 42 points. All right, well, let's turn our attention back to the Thinkorswim trading platform. And to do that, we're joined by your first trade contributor and education coach, Pat Mullally. Pat, welcome back to Your First Trade. Good to have you here. And Pat, we're going to focus back in on the Thinkorswim platform, but I think this ties in really well with the conversation we just had with Michael Keeley about individual options, rights and obligations, and what are the max losses and max gains. But now we're going to take it a little bit further. What is it that we're going to be looking at on the Thinkorswim platform, Pat?
Scott, the hockey stick. So today we're going to review a tool, a very dynamic tool, as a matter of fact, that allows traders to easily view the risk profile of an option strategy on the Thinkorswim trading platform. So today you're going to learn how simulated trades or even existing positions, Scott, can be analyzed in one snapshot that's going to lay out the Greeks, the profit and loss potential. We're going to focus, of course, here on individual options and their associated hockey stick risk profile. So what you're going to do, you're going to see how changes in the underlying stock price, the dates, and the volatility can affect profit and loss. Scott, that's the ever important time, price, and volatility aspect of options.
Got it. So we're going to see, like you said, the risk profiles of individual options that we were talking about earlier. But I like what you also said, an easy way to see a snapshot of all the potential gains and losses at different price points. And I suppose this is the benefit for options traders, particularly when they're learning about these risk profiles, Pat.
Absolutely. And even when you're kind of into that intermediate area, so developing that better understanding of risk reward parameters is essential for option traders, new or longer term, looking to improve their skill set. So by becoming familiar, Scott, with that risk profile, the shapes and the leveraging that goes along with the risk profile tools, traders can play out different scenarios to see how the P&L potential changes. So Scott, you can break that trade before you make the trade. And as always, sometimes, Scott, the best way to manage a trade is to start with a smart trade in the first place.
Well, there you go. All right, well, Pat, let's show everybody how this works, how they can get into the risk profile and see that hockey stick shape that you were just talking about. Pat, as you go and explain, I'll follow along on the Thinkorswim trading platform.
Excellent. So let's start with creating a simulated trade of a long call, a single call on the trade tab. And then what we're going to do, once we do that, is we're going to right click on the trade below in the order entry tool, and we're going to select analyze trade that pops up in the box there, in which that's going to display it in the risk profile in the analyze tab. So it's going to take us to the analyze tab. It'll display that in the risk profile box. And then what we're going to do next is click on price slices, and the default settings are going to appear. Now, a good habit is probably to click on reset slices in the show actions menu. From here, Scott, traders can adjust percentages and add or delete slices. Price slices are going to be displayed. Once you do that, they're actually going to be displayed vertically above on the risk profile. And then at that point, we can examine the hockey stick itself. And this shape is going to appear for any individual option, call or put, bought or sold.
Okay, so I follow along with you, took all the steps, and sure enough, we're looking at the hockey stick. Now remember, the blue line we're looking at, this would be considered the blade or the amount paid. The blade or the amount paid. And in this case, it was $3.80. And you can see this blue number here said if the stock stays here where it is, that's the current price slice of where the stock is. That's this one right here, 122.84. If it stays there, well, the entire amount is lost, $380. But follow the blue line. If the stock starts going higher, 126, 128, if this option is held on to until expiration, let's say the stock goes up to 135, which is the upper price slice, that's this one here, that's shown by this dotted line. Now that's a 10% move, of course, as you can see here, but the P&L there would be almost $750. Now, of course, that's a big move, Pat, but again, the hockey stick just shows you this handle just goes off into infinity. Is that right, Pat?
It is, and one of these days, Scott, I'm going to get one of those infinity trades.
Sounds good. Well, let's continue on with our long call example and talk a little bit about the profits and losses here, Pat.
Okay, perfect. So we can see on the risk profile how the profit and loss, the P&L open, changes when the price of the stock is changed. So we can change the price of the stock by clicking and dragging the price on the profile itself, or you can go ahead and click on the gear icon to change those prices manually. There's several other variables, of course, that we're going to look at, which would include the date, in other words, time decay. We're going to look at volatility, rising and falling, which also can be changed. And then you can see the resulting effect in that P&L profit and loss profile.
Got it, Pat. What I'm going to do is also show people how, if they want to just look at one price slice, you can delete slices like this 10% up and the 10% down. I can delete those. So that's if you want to just reduce a little bit of the real estate that's being taken up there. So what I did is I clicked and dragged the stock price from where it was to right here. Now you can see the P&L open. Again, that's open because it would just assume that you still had the option. You'd have a P&L open of about $437. That means that if you were able to sell that option at that current price, or with the stock being up here about 130, you'd have a gain or realized gain. At that point, it wouldn't be open anymore. It'd be a realized gain of around $437 minus transaction costs. Now, to get this price back to where it was, you can always click on the little lock, and that'll take the stock back to where it is. All right, so now we can kind of see what's going on there. But Pat, you also mentioned that by looking at this, not only do you get the P&L at all these different levels here with the hockey stick, we also get some Greeks here that show us, theta and vega, right, Pat?
Yeah, exactly, and then going to be very important to, if you're buying an option, that theta is going to go against us. How rapidly will it go against us? We can figure that out with the P&L chart. The vega, the volatility, if volatility goes up or down on our position, how is that going to affect that position? So on a long option, your long vega, if volatility drops, that's going to affect the price of the premium of that option negatively, as well as the day-to-day on a long option, the day-to-day time decay. So you can determine all those things ahead of time and see if it makes sense to make the trade.
Yeah, that's what's so valuable, I think, as well for this risk profile. Pat, I just dragged that up to, let's say the stock goes to 127, right? Okay, so great. What are we looking at? A P&L open here of 239. But also I can see that each day, this option is losing about $6 or $7 in value due to that time decay that you just talked about. It's positive vega, so if implied volatility goes up 1%, Pat, that could add about 14 cents to the value of that option. And in terms of delta, it tells me what my exposure is to each move. Right now, if the stock gets up to 127, that one long call would be the equivalent of having or owning or being long 61 shares of Apple, meaning for each dollar move, you can make or lose $61, right? So it kind of gives you some great information here on how that plays out. So Pat, one final takeaway here when we're looking at these risk profiles. You mentioned that it's always the hockey stick we're looking for. And Pat, I'm going to flip this over to a sell order. And again, same hockey stick, right, Pat?
That's high stick, and I think you get a penalty for that sometimes, especially if you're shorting calls naked. Yes, it's the same. You've got that same flat blade, and then the downtrending handle of the hockey stick as well. And that's going to show you your losses as price moves up. In this case, if you sold the call, and it'll as time goes on, as volatility moves up or down, you can also see in the price slices how that's going to affect your P&L open.
All right, well, Pat, that aligns with what we were talking about earlier, unlimited risk, selling the call. We got to wrap it up there, Pat. Thanks for helping us better understand the risk profiles for individual options, and remember that hockey stick shape. All right, thanks, Pat. Look forward to seeing you again on Your First Trade. That's going to do it for us here today. Thanks again for joining us. Don't forget, we'll be back at noon Eastern time to follow up on our example trade and look for others. We look forward to seeing you then.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 1 p.m. Eastern Time. We're coming to you live from New York City. Thanks for being with us. Let's take a quick look at the markets. 3 hours left in the trading session. You can see red across the board here as the Dow Jones Industrial Average is down 1.3%, losing 450 points. The S&P 500 down 1.5%. The NASDAQ 100 down 2.2%, and the Russell 2000 down 1.7%, as you can see there. Our top story, CPI data in April surges. Consumer prices jumped 4.2% year over year. That sent stocks lower as this week's weakness continues. So what does this inflation data mean for Fed policy and the overall markets? George Stillis is with us, TD Ameritrade Network contributor, joining us live from Salt Lake City. So what are the takeaways here from the CPI? Obviously, when I looked at it, it's the biggest jump since 2008 for U.S. consumer prices. Obviously, a big move today.
Yeah, I think it is. If you look at the core, it was actually up 0.9%, and we're looking at about a 3% year-over-year clip. On the core basis, on the non-core basis, as you reported too, it was a 4.2% increase, and it denoted about 10% increase in automobile prices too, Nicole. So I think this is becoming a challenge. I think the expectations were only about 0.2% month over month, and we clearly beat that number by about fourfold in terms of those estimates. So right now, I think the Fed is in a bind. I think that what's going on as we speak, we are seeing that there's potentially some consumer demand issues associated with inflation. I think wages aren't keeping up. I don't expect them to. But what's not actually embedded in these inflation numbers is housing prices, which are up on average about 18% year over year. But if you look at what they calculate as part of the CPI, it's called owner's equivalent rent, and that's actually trading or coming in about 1/8 of what housing prices are. And that's equivalent to what an owner would rent their own house for, Nicole. And it gives you an idea that housing prices, which again are not really reflected in CPI, are clearly underestimating the true cost of living. So I think this is becoming a problem for the Fed because, again, they're in a bind. They're pretty much going to be seeing the inflation on the PCE index that they expect, which is above 2%. I expect it to come shortly. But at the same time, I don't think this market is ready for higher interest rates, and we're also seeing wages. They're just not keeping up. So I think this is potentially creating a consumer crimp on demand, and I think that's what the markets are pricing as of today.
Right. Yeah, absolutely. I mean, we look at what's going on here, and it is a tough navigation route, right? Because you have this inflation. Right. We're going to be talking about this throughout the show. Tell me about 10-year Treasury yields, which rose, right? And obviously, financials are always closely tied to these moves. What does it mean here?
Yeah, so if you look at the 10-year yield, it is spiking higher. We're about a 1.65. Again, higher today based upon these numbers as to be expected. A couple things to keep in mind right now, based upon those long rates rising and a sell-off in long bonds, with the expectation of rising yields, bond traders and
portfolio managers are going to be rolling into short duration bonds. So if anybody's asking if bonds are selling off and stocks are selling off where the money is going, it's actually moving into short-term money markets, which are typically invested in short-term liquid bonds. I think financials are reflecting a nice increase in the yield between the short end and the long end of the curve, and we're seeing them to the upside. But also, with that said, we are seeing some challenges in the technology sector and the small cap sector. Again, small caps are typically sensitive to rates, and growth areas of the technology industry groups within the stock market are also sensitive to interest rates. And the cyclicals, I'm talking about the semiconductor companies like Applied Materials, Lam Research, Xilinx, AMD, all of those are trading to the downside, and actually they're leading components in the NASDAQ 100 to the downside. So I think that's creating a concern. There is a semiconductor shortage, but that's not reflected in these stock prices. I think these stock prices are really reflecting a drag on demand based upon potentially inflation and potentially that they can't get their products to market. On the flip side, if you look at energy today, energy prices or stocks themselves are higher because the draw for crude oil only came in around 400,000. The expectations are over about on average 4 million barrel draw. There was a build in gasoline, which actually was reflected in the CPI non-core numbers, which are actually lower than the core numbers because gas prices last month actually fell. But we are seeing, again, a little bit of a build in gasoline, but distillates are also coming down by about 1.7 million barrels. So we are seeing strength in the sectors of energy, financials. I think that if we look at crude oil, we're probably going to be breaking above the $65 to $70 range anytime soon because of the fact that it is a commodity that's reflecting inflation, and so are the banks. But at some point in time, I think also you got to keep in mind, Nicole, that banks may reflect a change in the ability for consumers to borrow money if rates rise too far, too fast.
All right, George Stillis, thank you so much. Great setup for today. George Stillis, TD Ameritrade Network contributor. Thanks, George. Now let's turn our attention to money and fund flows during the market weakness that we've seen. Bill Bailey, analyst at NASDAQ IR Intelligence, has all the details on this. What are you seeing as far as money flowing right now when you look at what's going on here? I mean, what's the smart money doing?
Thank you. So I like to look at, first of all, like what the stocks are doing across the board, look to see what the major indices are doing, then to see who's providing that liquidity. We saw last week the S&P, it didn't really, it kind of moved a little bit higher. The Russell was a little change, not too much, but we did see the NASDAQ drop a little below the pack. So I want to see who's putting the pressure there. Our data shows institutional was selling pretty heavily in the tech sector last week, which drives the NASDAQ lower, since it's such a large component. The interesting thing there is institutional data was showing that they were selling across pretty much every sector last week. So when we think about who's selling, we also want to think about who's buying. And when institutional firms aren't buying, those levels tend to not hold up as well when they're retested. So that's what we're seeing this week across the broader market, is that institutional was selling across all sectors last week, but they're not there this week to support because they weren't buying to begin with. So now we see all that softening go for the first 3 days of this trading week. The interesting thing here is now we see other parts of the liquidity picture hone in on this. So we see short sellers also pick up on this. Our data shows that share lending saw a huge uptick last week. And what that means is short sellers are getting their shares on loan, and they're putting pressure on the stocks even more. So they really focused on those price levels being weak, and then they're taking a little bit of advantage. So that's really what we're keeping an eye on as far as the flows of the institutional side. And next week will be interesting to see if they continue to put the pressure on, or where they wind up.
I think it's pretty amazing as you talk about institutions selling basically all the sectors and the short sellers stepping back in. That doesn't give much confidence in a turnaround in this market. So then you start to say, what happened to that buy the dip mentality? Are there any flows in any way, shape, or form to show the buy the dip mentality?
Yeah, that's interesting. I mean, I think we're going to see how that plays out next week when the data comes in. But we are seeing some, the rotation out of small caps has been the theme. That continues to be the case. We're also seeing the equity factors show that they're selling out of growth and into the total market funds and financials. So, there is buying of the dip. That's why the stocks have been able to, tread water near highs. But we are seeing it go toward the safer place. I think last time we talked, we spoke a little bit about the TLT bidding higher. That's down a little bit this week with a lot of equity vehicles, but ultimately it's pretty clear that found some support range. And we're also seeing consumer staples outperform stocks. Even today they're lagging, they're behind, but they're not nearly as much as the rest of the market. And then gold, of course, is, on the uptick, and then that's got everybody's attention right now. So, people are buying the dip. It's just going to be interesting to see, how much they're buying, how much flying to safety they're going to continue to go toward. That's all kind of to be determined, but we are seeing some other technical aspects that, might encourage, discourage institutional participation going forward.
When you look at the technicals of what's going on here, what are you watching when it comes to the major indices? I know you're watching, for example, the NASDAQ, which broke the 50 days, in fact, is closer to correction territory than it is to highs, to your point. So what are the technical analysis that you're watching?
Absolutely. So a lot of that we think has to do with the institutional putting pressure on that. The S&P, they're not too far off all-time highs. They're testing the 50-day average right now, but it's really ultimately that big of a deal. The attention goes back to the small caps. Small caps, they're testing correction territory as we speak, well below the 50-day moving average. They're actually testing a support level that has been tested in March and in April. It's just a little bit around that, a little bit above that 2150 level. It's going to be interesting to see if institutional, continues to buy that dip, because in the past they've been there to support stocks and the stocks within that index when the market those levels. As of right now, there's not necessarily any proof of that, but that's going to show up in the data next week, and it'll give us a better idea how that moves going forward. The other thing to take note of is the breadth indicator. So last week, the S&P did move a little bit higher. We saw pretty healthy breadth still there, and around 75% of stocks participated in that rally last week. The Russell was only around 50%. So we continue to see that negative in the technical breadth indicators for the Russell. That also plays hand in hand with how we keep seeing the flows leave the small caps and the rotation out of them. And then the other interesting aspect is the amount of stocks above their 200-day moving averages in the Russell is now back at 75%. That was up as high as 90% earlier in this year. So there's like tremendous deterioration in some of these breadth indicators. And historically, we've seen the Russell and the small caps forecast a larger move lower. But ultimately, it depends where institutional stands and where their confidence comes in at. Because if they start to buy stocks again, or feel as though 10% the correction territory is enough, we can see some ongoing stability, and there's no reason why trends have to persist in either direction.
Right. Bill, great to chat with you. Thank you for that. We appreciate it. Bill Bailey, analyst, NASDAQ IR Intelligence. Thank you very much, Bill. Coming up next, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, will join me. We'll get her take on the April CPI data and headwinds that she sees for this market, and what investors need to be focused on: quality, value. She'll explain. And the CEO of Cerence joins us, the company's latest earnings report, where it sees growth opportunities this year. Also, Stephanie Lewicki standing by to talk about the analyst moves for Target ahead of its earnings report next week. And our panel is ready to discuss all things about the CPI, inflation, what it means, and possible Fed moves. Stay with us.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Welcome back. Let's take a look at the biggest movers in the market right now. Shares of Domino's Pizza jumped to a new record high before falling back some. It comes after Bill Ackman says Pershing Square has taken a nearly 6% stake in the company. Ackman tells the Wall Street Journal he puts Domino's in the category super durable growth companies and likes the chain's own delivery infrastructure that doesn't rely on outside delivery services. Shares of NortonLifeLock rise to record highs after receiving a double upgrade at Bank of America Securities. The analyst upgrading the stock to buy from underperform with a $30 price target. The move comes after the company reported upbeat earnings and increased its buyback program. The analyst sees a potential renaissance for consumer security. Now to the downside, Home Depot, one of the big laggards on the Dow. Stock is trading near two-week lows. Wedbush did raise the price target on the stock to $340 from $285, citing sales strength expectations. It has been a real winner this year. Applied Materials, one of the biggest laggards in the chip sector. The stock is now trading near a two-month low. Semiconductors, the entire tech sector, under some pressure as inflation and interest rates been on the rise. Let's check in here on Bitcoin. 55,040, down about 3% right now, 3.1%. So you can see Bitcoin there under a little pressure today. Now back to our top story of the day, and that is the surge that we saw in the CPI data for this month of April. Lizanne Saunders, Senior Vice President, Chief Investment Strategist of Charles Schwab, is with us. Wow, am I glad are you on the show. I mean, I will just say, Lizanne, it's so nice to see you as well. I mean, you and I go way back in the years of business news, but I'll tell you, every time we ever had you booked on the show, we know you were a good get and it was going to be a fantastic show. So glad to have you on, and congratulations.
You're setting the bar high here for me.
No, it's going to be great. I know it's going to be great. And congratulations on Barron's 100 most influential women in U.S. finance list for that as well.
Thank you.
So I'm glad you're here, Lizanne. We have so much to discuss because I just want to start off with what we're seeing today. The Fed's Richard Clarida says he was surprised by the higher than expected inflation data. You tell me, when you look at what went on with the CPI here, biggest jump since 2008, and you break down within it. does it really tell you?
Well, I think it tells you what we knew coming into this, maybe without precision, and clearly the consensus was lower, but that certain categories within the CPI were set to have pretty eye-popping increases by virtue of the combination of base effects, which have been talked about ad nauseum, supply-demand disruptions and imbalances, as well as applied to the supply chain. And it was a fairly concentrated subset in terms of where we saw the increases most significant, and in particular, due to those base effects. I think 1 month doesn't yet give us an answer as to the time frame definition of transitory. It's, it's kind of interesting that that word is being used so much, especially by Powell and the Fed. If you look at the Oxford Dictionary definition of transitory, all it says is not permanent. And using that definition, you could say the inflation, the hyperinflation of the mid to late 70s was also transitory because it wasn't permanent. So I think that's going to be the sticky wicket here, is gauging just how long these hot numbers are likely to persist. And then, of course, what the Fed's reaction function is going to be.
And I think it's interesting that you talk about that, because I was listening to some of your prior interviews and you said exactly that, transitory versus not permanent. How quick is this going to be, and where is inflation really, where does it really exist? It's not that toilet paper that we couldn't get and then there were surging prices. And I know you look within the CPI and things like the owner's equivalent rent, and you look at the core, excluding within the numbers, right, ex food and energy. When you look at the numbers, I mean, don't you want to see a few months of data? And I know that you look at all of this closely, as does the NBER, which you were also quoting at one point as well.
Yes, I think at least if we focus on just the base effects, we should start to see those ease into the June timeframe, because last year it was really the March, April, May where we saw that significant compression in traditional inflation metrics like CPI, which of course means that we'll have about 3 months or so where the comps are easy and the year over year will be high. That piece of it should start to fade anyway in June. What I think is really key to watch over the next several months is not just the components, not just the relationship between headline and core, but whether we're seeing a mindset change. Not that inflation is sentiment related, but there is a difference when it becomes part of the mindset of individuals. And that's why it eventually, like in the 70s, becomes a problem if you've got that increase in wages and it becomes the wage price spiral. I think there is still enough slack in the labor market to suggest that we are not facing a 70s style wage price spiral systemic era of inflation. But thinking beyond the next several months, I think it's tightness in the labor market that will be key to watch simultaneously as we get the next few months of inflation data. And that will really give us a sense of whether we're looking at a 70s style risk here.
It's interesting because I worry about the risks, right? We worry about the headwinds, and we take into account things in which things are just sort of passing or a one-off, right? We got a jobs report last week that was a little tough to stomach. But there's different things that are happening here and things that are transitioning. And when you look out 6 months, 12 months, 18 months, do you feel more positive or negative? I mean, I know you watch things like investor sentiment and other things that have been changing the way we do business, right, overall, or even some very current numbers like TSA and box office and things, open table. Those were some things that you look at that are for right now. How positive or negative are you feeling?
So I've been saying for several months now that I felt the biggest risk for the stock market is a function of the success of the stock market over the last 14 months, which is and has been a stretched sentiment environment. Lots of speculative fervor in, admittedly and fortunately so far, pockets of the market that are not standard leadership areas. And we have started to see an unwinding of those in some of the spec tech areas and the low quality areas like some parts of the SPACs world and in not profitable tech and most heavily shorted. And we've been able to take the air out of some of those bubbles without the entire market coming down with it. But I've also said that sentiment in and of itself doesn't signal the market is imminently going to move in the opposite direction. You tend to need a catalyst. Well, fill in the blank in this environment of now another move higher in rates tied to a very hot inflation number today. And I think the market could have some consolidation here, very similar to when we had a 10% correction in the NASDAQ a couple of months ago, when we had that initial somewhat disorderly spike in the 10-year yield. I think we may be replaying some of that.
Yeah, absolutely. And when that yield spikes, people get spooked to a certain extent. What's interesting is you said that the sectors that you have outperformed on, financials, healthcare, energy, and it's not just those names. You said you were also looking for quality, value, looking at things like free cash flow, and not just saying value stocks, right? But it's interesting that those are the ones that are, in fact, the winners today.
Well, it's probably shouldn't be a surprise that at least before we went on air here, that energy was the only sector in the red and in turn top of the leaderboard. And it is the one sector that is most consistently done well during bouts of inflation, even short-term bouts of inflation. So that's not a terrible surprise there. Not to mention some of the disruptions we're seeing in the energy markets with what happened to the Colonial Pipeline. But I think that the point I've been trying to make with regard to sort of value and the notion of the factor or factors of value should be differentiated from the index labels, either Russell or S&P, of value. And the value factors like free cash flow years, like price to sales, price to book, on the lower end of the spectrum, that's where you have found outperformance in the last week, in the last month, year to date, even if you apply the comp to sectors that are growthier sectors. So value factors have outperformed factors like long-term growth, even in sectors like technology or communication services or consumer discretionary. So we've actually said that even though we do have these sector recommendations, we know and believe we're going to continue to see a lot of flipping around and volatility in sectors. And I think a better way to approach, if you're an individual stock picker, is focus more on those factors with a value orientation than on sectors.
And I think it's interesting, too, how we've changed the way we work. And I know January, you said you did over 90 client events through Zoom or whatever, over the visual, right, versus then in person. So I'm sure it's well over 100 at this point. And education has been very important. And we're doing business in a new way. And you have people now investing that never invested before. What do you tell them? I mean, what is your piece of advice to them at this point when they're trying, people are saving more money, it seems, how they're spending may be changing a little bit. What's your advice to them, Lizanne?
So I'd say my personal advice is very much in keeping with our corporate mission and really almost our purpose for the 50 years or so that we have been in business, all the way up to Chuck Schwab's founding of the firm, wanting to make it about education and financial literacy and not just a platform for traders or investors. And I think that is, especially in this environment where we have an influx of new participants in the market, that so far anyway, probably the label of newly minted day traders is more appropriate. But I see my role, and I think our role as now a combined firm, is to make sure that education piece of it helps hopefully bridge the gap between a newly minted day trader and being a successful long-term investor. And there will inevitably be bumps and painful lessons learned along the way. That's just the nature of the stock market. But trying to reinforce some of the long-term disciplines around diversification, reasonable holding periods, the power of rebalancing as a way to stay in gear and forcing you to add low, trim high, not making all or nothing, get in, get out kind of decisions, and making sure that there's a fundamental basis for investments, even if at times there might not be for trades. So really it is just reinforcing decades worth of what we have felt is important and have imparted to our investors.
And I think it's very much a hallelujah moment. It may have come for the wrong reasons, right? A lot of trading frenzy and crypto and things like that. But in the meantime, you have young folks now looking more at investing and buying a share of something rather than buying sneakers or some designer belt or something. So, and a compounded dollar, obviously.
That's the best.
Isn't it beautiful? I love it.
It is.
Me
it
too.
Is
I
wonderful.
love it.
Again, there's that gap we have to bridge. But even 2 years ago, the refrain was, we're never going to see young people ever develop an interest in the stock market. They've written it off either by maybe because of their own experience during the financial crisis, or maybe parents' experience during the financial crisis. And we sort of wrote the younger generation off. And the good news is we had started to see movement back into markets, interest in investing, even pre-pandemic. But for sure, for lots of reasons, the pandemic accelerated that. Now let's hope we can bridge that gap and make all of them, or at least most of them, successful long-term investors.
Yeah, absolutely. And we have all the tools for that education. Thank you so much, Lizanne. It's great to chat with you today. Really appreciate it.
Nice
Lizanne Saunders, Senior Vice President, Chief Investment Strategist at Charles Schwab. Thank you, Lizanne. Coming up next, the CEO of Cerence will join me here to discuss the company's latest earnings report and what's next in the digital experience in your cars and trucks. Don't forget, 5 p.m. Eastern Time, Market Overtime will focus on your long-term portfolio right here on the TD Ameritrade Network.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to the Watch List. I'm Nicole Petalides, live in New York. The auto industry continues to see soaring demand, and that's driving growth for certain suppliers, one of which is Cerence. Saw record revenue during its fiscal second quarter. Joining me now is Sanjay Dhawan, the CEO, president of Cerence Inc. Thank you for being with us. Tell us more about the earnings report and the future here going forward for the company.
Sure. Thank you, Nicole. Thank you for inviting me. We announced our fiscal Q2 earnings a couple of days back, and we basically announced record earnings, which was $98.7 million in the quarter, in the January, February, March quarter, which was basically 14% increase from the previous year. What was also very interesting in our announcements was our earnings in terms of our EBITDA margin increased as well. We announced EBITDA margin at 40%, which was also, a great progress from last year, which was about 33.8%. And earnings per share also increased, dramatically from 44 cents to 69 cents, which was about 57% increase. So we're really, really happy with the overall results.
Tell me about the guidance going forward, which I know you raised full year guidance. I know you're helping to transform this digital experience inside our cars and trucks. So what's going to drive this all? What is it specifically that gave you the ability to raise this guidance for the full year? What's going right?
So basically, the voice, we are in a conversational AI space. So we provide the AI platform that goes inside the car and basically enables the drivers and the passengers to communicate with the car using voice. This technology, has great kind of penetration that's increasing dramatically, and the reason is because it's nice to have conversational AI, in your speaker or on your phone. We all use Alexa and Google and other products basically in the television, in your remotes and all that stuff. But the place where it makes the most sense to have a voice-based interaction is when you're driving. At that time, your hands are supposed to be on the steering wheel, eyes on the road. Anytime you're fiddling with your knobs or buttons, or you're touching apps in the screen, you are basically being distracted. So voice becomes the natural way of conversation. And this technology is, the penetration is increasing, and that is basically the reason why kind of companies like ours is showing good results. We increased our yearly guidance. Previously, we had guided our investors that we'll be somewhere in the $360 to $380 million for the whole year, fiscal 21 of Cerence. And we have increased that guidance to $380 to $390 million. We also gave the guidance for our Q3, basically, which was between 94 to 97 million, which is going to be a 25 to 29% increase from last year.
I wanted to ask you about what is the really cool part of this? I mean, when we think of AI, or we go right to EVs, right, and we think of Tesla and NIO and all that. In the meantime, you're doing AI, you're working with other companies, AI and smart glasses to elevate the two-wheeler experience. I mean, what is the coolest part about what's going on here? And is there anything in your way, such as the chip shortage, that's occurring?
So, what's cool about this whole technology basically is that, the voice interactions are becoming very natural. So you don't have to remember any commands. You just speak in a very natural way. And we support 70 different languages, and our systems basically will interpret what you are trying to do, and then kind of go and work with the rest of the car or the two-wheeler to basically bring that do the function that you want to perform. So that's the thing that's extremely cool. We announced two-wheelers as a couple of two-wheeler customers as well in this earnings. And what's cool about that is that's increasing our market penetration, our market scope even further beyond auto into an adjacency, which is two-wheelers. About 60 to 80 million two-wheeler devices get shipped every year. And safety and distraction is even more important on two-wheelers, when you're driving a scooter or a motorcycle or something like that. And using our voice AI technology, not only you can kind of do your functions on your phone, etc., but you can also communicate with other group riders. For example, you're going with a bunch of friends and you want to send a message to each other while you are driving. You can basically do that all with voice and kind of say, hey, let's stop at this lunch spot and gather up there. So these sort of functions become all available through kind of voice AI and the cloud services that we provide.
Right. It's great to chat with you, sir. Thank you so much for being on with us. We really appreciate it. Sanjay Dhawan, President and CEO of Cerence. Thanks for being here on the show. Still ahead in the second half of our show, we'll check in on Target and what the analysts are expecting ahead of the earnings report. And as we head to break, we'll take a look at some winners and losers in the S&P 500.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from New York City. Thanks for being with us. Markets are selling off after a hotter than expected CPI data this morning. Check it out. You can see that the Dow is down 1.4%, losing 468 points. The S&P 500 down 1.7%. The Nasdaq 100 2.3%. We're watching Target hitting a record high, which it hit on Monday. The stock is up more than 15% for this year. And now a few analysts have jumped in and raised their price targets for the stock ahead of the earnings that are due out next week. Stephanie Lewicki has been combing through the numbers, contributor for the TD Ameritrade Network, to take a look at what the analysts are saying about this particular stock. Target
did receive a couple bullish price target increases today from a couple different research firms. First, from UBS, they raised their price target to $210 from $185. Now, they do maintain a neutral rating on the stock, but some of the reasons they raised their price target is they're saying that same-store sales growth, their estimate is for 12% versus the consensus estimate, which is for 9.3%. And now they're also saying that two-year same-store sales could be as much as 23% higher. And now they're looking at their apparel and home furnishings that have robust growth really on easy comps last year. So they were down 20% last quarter. So looking at good comps, but you got to remember the base effect there. They're also saying those stimulus checks, at least for half of the quarter, were in consumers' hands. They're also thinking that attention is going to really be focused on the outlook with a big focus on apparel. We saw last quarter that they withdrew their guidance for this quarter, so there'll be a lot of attention focused on that. Their sales grew last quarter $15 billion, so that's a big number to beat. If we look over at Morgan Stanley, now they upped the price target to $205 from $195. They maintain equal weight. If you look at all analysts, 6 have a hold, 15 have a buy, 1 has a strong buy, and the average price target is $186, Nicole.
All right, Stephanie Lewicki, thank you for that. A good preview, too, for next week's numbers. Stephanie Lewicki, contributor for the TD Ameritrade Network. Thank you. The COVID-19 vaccine rollout continues. More than 150 million Americans have received at least one dose. And later today, the CDC is expected to authorize emergency use of the Pfizer vaccine for children between the ages of 12 and 15 years old. So what's next for this group? Sel Hardy is with us, equity analyst at CFRA Research. I'm glad you're with us. I mean, you're here right at the right time, and I know you have a buy rating on Pfizer, Johnson & Johnson, and Novavax. Why? Where is the upside potential for these stocks?
Thank you, Nicole, and thanks for having me today. We think Pfizer-BioNTech is really well placed right now. When you think about the current market opportunity, there are roughly 17 million children in the age group of 12 to 15 years of age in the U.S., and that means like 5.2% of the U.S. population will become eligible to get the COVID-19 vaccine. And when you think about it, there's really no competition there. Pfizer-BioNTech's vaccine is the only one that's authorized for the population between 12 to 17 years of age versus competitors Moderna and J&J, who have their emergency use authorizations for people aged 18 and older. So we have a buy recommendation for Pfizer, and our price target is $45. This points to more than 13% upside potential from current levels. So clearly, we think for Pfizer, the vaccine impact is very high. For when you look at the first quarter results, top line revenue was up 45%, and vaccines contributed 21% to total sales, around $3.5 billion. And we think going forward, this is only going to increase. The company raised its guidance to $26 billion in COVID-19 sales for 2021, but we think this is conservative. We think the company can achieve as high as $30 billion in COVID-19 sales in 2021. And added to that, I mean, the COVID-19 vaccine is not the only catalyst for Pfizer. We think the company is in a better position following the Upjohn spinoff, and we think the company also has a solid oncology and immunology portfolio, which could drive the stocks going forward.
So when you look at what's going on here, and we talk about what the current situation is, it sounds like we'll be getting booster COVID-19 vaccines moving forward, and how that will impact them, right? When you look at how it's not just this year, it's next year, it feels like it's going to be flu shot material, doesn't it?
Exactly. We think with the emergence of more dangerous COVID-19 variants, there is increasing chance that repeat vaccinations are going to take place to boost efficacy, essentially. Even Pfizer's CEO, Albert Bourla, mentioned that there might be a need for a third dose after 6 to 12 months following the initial shot. So that means probably for 2022, we'll continue to see increasing COVID-19 vaccine sales. For 2021, our revenue forecast is more than $73 billion. So that points to more than 75% year-on-year growth.
Yeah, and when you look at this, it's amazing because here in the United States, obviously, we're moving so quickly trying to vaccinate everybody. But in other countries, in some countries, only 1% of the folks have been vaccinated. So it just shows how much more is needed in the world of vaccine production and what this means for the bottom line for these companies. Is there one company out of the three that seems probable or maybe more likely to benefit most or
so we think, Sure. So we think definitely Pfizer is going to benefit more from it as the first entrant, and now also with the extension of the emergency use authorization to a broader population. When you look at J&J in the first quarter, the vaccine contribution was only 100 million, and the company had 22 billion in revenues. So the impact of the COVID-19 vaccine sales were minimal, and then they had some issues with the rollout, and they had to pause, and then they had to resume it. We think for J&J going forward, the main growth drivers are medical device sales, which are recovering. They had a really strong boost this quarter, but also pharmaceutical sales. As more and more people are getting vaccinated, we think patient visits are going to increase, and there's going to be a recovery in elective surgeries. And moving to Novavax, we have a buy recommendation for Novavax, and our price target is $200. So this points to a very solid upside potential from current levels. We think the stock is, however, a high-risk stock. This is how we categorize it due to its volatility. We think their vaccine is very interesting. It's a novel technology, but essentially yesterday in its earnings call, the company had to delay the approval timeline to the third quarter instead of the second quarter. So that's why we are seeing heavy sell-off for the last 2 days. But going long-term, we think Novavax has a very interesting and efficacious COVID-19 vaccine based on their data. So we have a buy recommendation, but we think it's a more high-risk category.
Right. Sal, it's great to have you on the show. Thank you so much. Sal Hardy, CFRA Research. Thanks very much. Still ahead, we will bring in our panel to discuss more reaction from the April surge in CPI data and what it means for Fed policy. and what the Fed should be focusing on: jobs, inflation. And let's check in on those home builders. The sector hit record highs on Monday, but have been under some pressure the past couple of days, falling to around 3-week lows. Check it out. You can see many of which are down 5%.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Jenny Horn. Here's a few more movers to keep on your intraday radar. A hedge fund manager at Octahedron Capital said Peloton has a Netflix-like subscription model, and its shares may rise by 4 to 5 times over the next 4 to 5 years. He estimated that less than 5% of treadmills will be recalled and expects any sales lost in the current quarter to be made up in 3 months from now. He said the recall worries are highly overblown and that Peloton remains the world's best fitness experience. Affirm shares are falling roughly 8% after a Morgan Stanley analyst cut his price target by double to $73 a share from $146. However, this price target still implies a near 32% upside to Affirm's closing price Tuesday. The stock is now trading well below its 50-day moving average of $69 a share and has fallen over 28% this month. And Boeing is also 2% lower today despite positive feedback from the FAA. An FAA administrator called Boeing's 737 MAX electrical issues a straightforward fix and says he has confidence in the safety of the plane. The administrator also said that currently the 737 MAX is performing as well, if not better, than any other plane. This has been your TD Ameritrade Network Market Update. Now back to the watch list, Nicole Petalides.
Jenny Horn, thanks so much. Well, it's time now to turn our focus right back to that April CPI data and bring in our panel: Greg McBride, Senior Vice President, Chief Financial Analyst at Bankrate.com, and Nancy Davis, Founder, Chief Investment Officer, Quadratic Capital, and Portfolio Manager of the IVOL ETF. So, Nancy, I'll start with you. What did you make of the data? I mean, obviously it looks hot, right? Hot meaning that very inflationary, in fact, seeing the biggest jump since 2008. Does it make you nervous?
Doesn't make me nervous. I manage an inflation fund, so it was a pretty exciting morning. I think the core was what was really surprising to me. It was such a big change month over month. Core is kind of what I always focus on. But I think the thing that your viewers need to really focus on is CPI is a consumer price index. It's just one index. It's not the only way to measure inflation. And it's meant to be a basket of consumer goods. And a big part of CPI is shelter. So shelter is mostly calculated by the Bureau of Labor Statistics by owner-occupied rent. And so it's not the only way to look at inflation expectations. And so I wouldn't have people freaking out or causing too much panic over one print.
And also, Greg, when you look at what's going on here, when you look at how the Fed may be looking at this, right? If you were on the Federal Open Market Committee, how do you take this print?
Well, the Fed has been very consistent, Nicole, in saying that they want inflation to move up. They want to see it move above the 2% mark and stay there for a while. They've had that 2% inflation target for a decade and really haven't had success in getting inflation there. So they're not in a hurry to chase down these higher prices. They want inflation to run hot for a while because they want us to get back to full employment. So don't expect one number to deter them. We can expect not just this month, but the next couple of months, we are going to see outsized increases for a number of reasons due to pent-up demand, supply chain issues, the base effect, comparing to year-ago numbers that were depressed. I don't know that today's number tells us anything that we didn't already know or answer any questions that we had. Specifically, is this temporary or more sustained?
All right. So, Nancy, when you take a look at this in your iVol ETF, when you look at the volatility that we could see in inflation, I mean, I don't know what the Fed's going to be focusing on, inflation, jobs. I mean, you know, they look at everything, I guess. And your iVol ETF may even experience some volatility, right?
Well, our fund owns volatility. It's long volatility because we buy options inside the product. So whenever you buy an option, you own volatility on the underlying asset class. You know, when you sell options, you're actually short volatility. So higher volatility or market stress could be very beneficial to our strategy because that's the price of options is calculated by the level of vol. So if you're long an option and vol increases, that generally makes the price of the option move higher. So we think it's a pretty unique time in the history of financial markets where fixed income volatility, specifically interest rate volatility, is still, you know, relatively low given its historical average. And we do think there are very few things in the fixed income markets that investors can look at that are trading below their 5-year, 3-year, 10-year, 20-year averages. So we do think it's a unique time to be adding potentially more diversifiers to portfolios.
Right. And your thought here, Greg, as the response when you look at the outlook going forward and what we could expect, because we got that jobs report last week, obviously, which took people aback, no doubt, right?
It did, but one in a row is not a streak. And so, I think we're going to have to digest, next month's employment report. I suspect there's going to be a lot of catch up in there. Really, we've got to look at this, I think, over a string of, say, 3 successive employment reports before we draw any conclusions. And the same thing with regard to inflation. We will see these outsized increases for the next few months. The reality of it is we will be well into the second half of this year before we can really get a good read on the idea as to whether or not is inflation transitory, as the Fed has suggested, or is it more sustained? We do typically see prices rebound in the early stages of an economic recovery. And so what we're seeing is not uncharacteristic. The question is, where do we go from here?
Right. And Nancy, what's your final takeaway when you look at 6 months, 12 months, 18 months out?
Well, obviously the key question is, where do we go from here? And I think the answer is, at least from my point of view, that nobody knows. It's an unknown. We've never had a global pandemic. We've never had this fiscal response coupled with the very loose monetary policy. So I think it's one of those things that investors really shouldn't overthink it, in my opinion. I think inflation protection is something everybody should be looking to add to their portfolio, especially because it's not in many of the passive indices. Like the Barclays Ag Index has 40% treasuries, but no inflation protected bonds. So I think it's just a good time to say, look, time to diversify. We don't know whether inflation is going to actually happen or if it's going to be stagflation, or we don't know.
Right. Absolutely. It's great to chat with you both, Nancy and Greg. Thank you. Greg McBride, Senior Vice President, Chief Financial Analyst at Bankrate.com. Nancy Davis, Founder, Chief Investment Officer at Quadratic Capital, Portfolio Manager of iVol ETF. Midday Trade is next. Kevin Hanks getting ready to trade with the gang there. Tell us, what are you taking a look at today, sir?
We'll look at a company coming out with earnings tomorrow morning, and that is Yeti. They'll have earnings coming up here very soon, the cooler and container company. And then we'll look at maybe, just maybe, the company that started this sell-off with the May 10th downgrade from Citigroup, and that is Google Alphabet. We'll trade both of those today on Midday Trade, Nicole.
All right, thank you. Thanks, friends, for joining me here on the watch list. Don't forget, 5 p.m. Eastern Time, Market Over Time. We'll focus on what you need to know for your long-term portfolio. I'm Nicole Petalides. Have a great, safe afternoon, and I'll see you later at 5 p.m.
"24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
It's 1 o'clock in Chicago. Good afternoon, everyone, and welcome to Midday Trade. I'm your host, Kevin Hanks. I'll be taking you through the next half hour. We got an interesting show for you today. 2 stocks that are in the news today and tomorrow morning, and the first one we'll look at, may have started this sell-off in the market with a May 10th note out of Citigroup. First, Alex Caulfield stopped by the show. He'll look at what the risk-off assets are doing with the VIX trading about at 26. There's plenty of movement in the risk-off assets. And then we'll look at Google Alphabet, one of the names that may have caused the start of this sell-off with the downgrade from Citigroup. Then Jenny Horn, Ken Rose will stop by. They'll look at a name coming out with earnings before the open tomorrow morning. That is Yeti, the cooler and container company. So they have earnings coming out tomorrow before the open. We'll trade them in the second half of the show. All right, before we bring in Alex Coffey, let's take a look at the 4 major indices and see where they sit at 1 o'clock Chicago time. The S&P 500 down 1.7%, 69 points to 4082. The NASDAQ 100 down 2.4%, the heaviest of all the indices, down 319 points to 13,031. The Dow Jones Industrial Average down 460 points, 1.35%. to 33,806. And the Russell 2000 down 1.6%, 35.5 points to 2171.5. Now, let's bring in my co-host from Fast Market, Mr. Alex Coffey, to the show. He's going to look at what the risk-off assets are doing today. Alex, and they're doing plenty, aren't they?
Yeah, that would be an understatement in many ways, Kevin. With things on the moves substantially in the equity markets, it's not a surprise that some of these other markets we watch are moving as well. The bond market, however, is somewhat interesting. It's a pretty big move now on balance in the 10-year yield, up about 6.5 basis points to just under 1.7. But this has been a slow, steady rise throughout the session. The volatility that we've seen within the equity space has certainly seemed more substantial than the movement in the bond market, but slowly but surely we have watched yields creep higher here, and they're pushing back towards kind of the high end of their range now after that warm, really, let's be fair with it, hot CPI number that we got this morning, historic really in the surprise level and how far in history we have to go to see some of those levels. But volatility near its highs at the session, 26.26. Up 4.5 vol points today in the VIX. No surprise, the market near lows. Volatility is going to be near its highs on an intraday basis. The gold market, this is interesting because gold had been both lower and higher at one point in this session. But as the day has gone on, gold has continually sold off, down 14.20 now to 1821.80. So gold been very strong recently, Kevin, but not able to stay strong today in the midst of all the volatility in equity markets. And a lot of that might be due to its inverse relationship with the dollar, which is catching a pretty nice bid today, bouncing off of 90, up about 60 cents, 90.72. Big move higher here in the dollar, which may be counterintuitive if inflation is creeping in and going to be a bigger problem. So that's an interesting market to watch. But as we talked about, a lot of volatility in the dollar recently. Not a surprise to see a little bit of a relief bounce here in the U.S. dollar. And then closing things out here, Kev, crude oil, 66.32. Even with a strong dollar, some of the micro stories with crude oil are taking charge here. And the demand component outweighing supply is boosting this asset back through 65, comfortably now to 66.32. So big up move here in crude oil.
Yeah, a lot of uncertainty in the crude oil market and a much higher dollar. It's, gold tried to rally early in the morning, Alex, and then the higher dollar eventually just weighed on gold. Now down on the day, but VIX, Bitcoin is down on the day. It's a pretty interesting rally, but the VIX, that purest of risk-off assets, higher on the day, spiking here with the consistent rally in the 10-year yield. Alex Coffey, always a pleasure to have you on the show. Thanks for coming in, as always, and taking a look at the risk-off assets. All right, now let's get to our first trade of the day, and that is Google Alphabet. Now, we're going to trade the Class A, the GOOGL, and remember, it was Monday, May 10th, that Citigroup started their coverage of the day by downgrading Google Alphabet and Facebook earlier in the week, and they said ad revenues were going to slow. So interesting, I think that digital advertising is what they thought might slow, and so they downgraded both those names. You could see on my chart here, this is Monday the 10th right here, when you could see the break overnight, and then the break, and Google has slowly but surely sold off since then, even though the longer term chart, let's throw that up there on Google, they came out with earnings April 27th, and you can see what the stock has done since then when they put out earnings of $26.29 per share and okayed a $50 billion stock buyback. So really, as about as good as numbers as you could possibly put up. And two things have propelled Google Alphabet to these numbers, and that is obviously the strength of their search engine and YouTube, the strength of YouTube TV and the growth of that. YouTube TV, 48% growth. The growth of Google Cloud, 45% growth. So this company, though not a brand new company, is still growing at unbelievable levels here. Hold on one second. And so we're looking at levels in Google. But that being said, even with the unbelievable good news out of Google Alphabet in terms of earnings and projections going forward, it still can't get out of the way of a global sell-off, and that is what you're seeing. Now, what does that give you in Google? I believe it gives you technical spots where you can pick your spots and enter into. And what does that come? Look at this 200-day moving or 50-day moving average in Google around 21.82. Now, that's only $21 from where we are right now, even though in the next 9 days in Google Alphabet, you've got an expected move of about $100. We'll call it $99 in this name. So you could play Google Alphabet two ways here. Very aggressively, marking that 50-day moving average or slightly below if you wanted to, or you could go to that $100 lower level, and that would take you all the way down to about, as traders been known to do, if we rally, about $2,100. And that's where we'll look. We'll look all the way down to right around here and look at all the activity right around this $2,100. It is busy right around there. You can see all the touches right there in at or near $2,100 in Google. First it was resistance. Now it'll probably be support down there around $2,100. So how do we play Google? Like I said, there's an aggressive play around $2,182 that you could do, or what we'll do in terms of Google Alphabet, and we'll play it the high percentage way, and we'll look at the 2100 2090 put vertical. And that is just a put vertical that only has 9 days. It's $100 from where we are right now in Google, actually $103 from where we are right now over the next 9 days. That is after, with everything positive about Google, and after the stock has sold off, as you can see, from $2,430 to $2,200. So $230 off of its highs. So we're just going to play this relatively conservatively and passively by selling put verticals. Remember, this is not an inexpensive name. It's not a name that you can just go in and buy 100 or 1,000 shares of stock. This is a name you have to use options to trade and use in a most efficient way. So I think the short put vertical in stocks like Google, in stocks like Amazon, in these high price names, the short put vertical is a nice way to use theta, use risk definition to enter these names, get a normal amount of delta. Now, we used a $10 wide put vertical. Therefore, the delta is relatively small. 1.6 delta is the theta. But now, let's think about this. You've got a pretty significant 50-day moving average here around 2182, right? And you've got the expected move for next week. What if we wanted to be a little more aggressive? How would you look at that in Google? Well, you could go 2110, 2100. And look at that. Now you're up to about $1.60. Now, in terms of probability of finishing out of the money for next week, the 2110, still 75%, almost 76% probability of finishing out of the money. So this is the way I like to do it. Get all the metrics. Get all the levels that are defined by the Thinkorswim platform. Then tweak it to be a little more aggressive on your part. And so what we're going to do, we're going to take that number, that 2100 level that we saw, and move it up one strike price to 2110, just to up the overall, be a little more aggressive than just the most passive trade like that. Still a 75, 76% probability. So we will create a duplicate order and send that off in Google Alphabet. There you go. And that is in. We filled at 160. All right, let's take a quick break. Come back with our feature stock of the day. They have earnings before the open tomorrow morning. Yeti. As the weather is turning nicer, Jenny Horn is going to talk about Yeti. Take a quick break. Come back in 2 minutes with more Midday Trade. See you then, everybody.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Midday Trade, everyone. Kevin Hinks back here for the second half of our show. Now let's take a look at our feature stock of the day. And for that, we bring in a contributor across the TD Ameritrade Network and my personal partner on this show now, and that is Miss Jenny Horn. She's going to take a look at Yeti. Jenny, as the weather's getting better, I can think of about a couple dozen ways to use Yeti. But what are you seeing in Yeti as they come out with earnings tomorrow morning before the open?
You know, I love the mention of warm weather because here in Chicago, it's like looked nice outside, but it's still been 40 degrees. So I'm here for any mention of warm weather. I'm like, fingers crossed. But Yeti is one of these companies that I feel like you don't really hear its consumers ever talk very averagely about it. People that use Yeti love Yeti. We are like a network of the best free marketing ever because I feel like more and more people use Yeti, the more it spreads in a positive word of mouth. And that has sort of been reflective over the past year. Now, the stock has been sideways for the last 3 weeks, although it did make new all-time highs Monday, but now has sort of pulled back in sync with the broader market, down almost 6.5% today. But it has seen such strong demand over the past year, really fueled by its outdoor gear. Like we mentioned, this warmer weather also makes you think of Yeti naturally. The company has also leaned heavily on its e-commerce segment, which now makes up about 60% of its total revenue. And this shift has been a huge plus for its gross margins, which now are actually outperforming other typical consumer product companies. So sort of the combo of its e-commerce, its product expansion, its increased consumer adoption, plus its DTC marketing have all created huge tailwinds for the company looking ahead. Now, more tailwinds for this name is BTIG actually issued a super strong report this morning ahead of their first quarter earnings tomorrow. They rated the buy rating and they raised their price target to $100 a share on sort of this increased confidence going into the earnings. And this report, I thought, highlighted so many important things. One being that 2021 has been a solid start for the company, and they see growth throughout this quarter with no signs of slowing. And specifically, they highlighted this online traffic, which they've seen on Yeti.com, up 94% expected for this quarter versus about 99% we saw in the previous quarter. So this estimate translated into about DTC growth rate of about 45 to 50% versus 30%, which they were expecting. So they are actually forecasting Yeti's first quarter earnings to come in better than even they expected, which to me is typically a good sign. Now, as far as earnings go, this company has beaten on earnings and revenue in the last 10 straight quarters, so pretty good track record. But I do have to say that when they reported fourth quarter earnings, they did report very strong e-commerce growth. They reported an earnings beat and a sales beat, but the stock still sold off about 10% following these earnings back in February. So that does give you some concern that this company is capable of basically issuing an A+ report card as far as earnings, but still sliding. However, the stock did run up prior to its fourth quarter report about 22% in the last 8 days leading up to that. And so I'm no technical analyst, but with the stock now trading at about 9% down for this week and about 4% down for this month, I would say, although it did hit all-time highs Monday, Kevin, it is not necessarily seeing that same strength ahead of this report, which actually I think gives it a better level in terms of trading as we go into this report, Kevin.
Yeah, Jenny, when you look at a premium outdoor product company like Yeti is, and make no mistake, they are a premium product, right? They're a little more expensive, but they're high quality name. Yeah, you're right. This stock has had an unbelievable run, but it also has sold off about 9 or 10% since early in the week, down from $90 down where it sits now to $81.75. So interesting look at Yeti as they come out with earnings. Why? Well, because they can't dodge or get out of the way of a global sell-off, no matter what you are, right? No matter what your earnings are going to be, if the entire market is selling off, you're going to be caught up in that selling as well, even if it is ahead of your earnings. So Jenny Horn, great presentation as always. Just talking about Yeti makes me feel like summer, makes me feel better. Jen, thanks for coming on and doing exactly the same. Have a great day. We'll talk to you soon, Jen. So let's move over now from Jenny Horn and bring in Mr. Ken Rose live from Salt Lake City, Utah. And he's going to do technical analysis on Yeti. That is, Ken, having a rough week after hitting all-time highs and getting close to that 50-day moving average. What do you got for us in Yeti today, Ken?
Right, absolutely, Kevin. Definitely a tough week here, and especially a difficult day today. This stock is moving down with the overall market, taking a huge move to the downside. Coming down, and right now it's trading at its current support level, that support level being at about 81.48. This support level was also held up during the time of late April and also during the time of mid-March as well. That was also a resistance level back in early January. So we're sitting right on a support level there at about 81.48. If we were to break down below that support level, I would say the next lower support level is down there at about 76.45. This was a resistance level back in March, as well as a 38.2 Fibonacci retracement level. If we were to recover from where we're at right now and start to move to the upside, actually have a resistance of where the open was today, up there at about 85.51. That was a nice resistance level. We opened right up on it as a support level. We broke down below that support level, so now that's a new resistance level. That's also fairly close to the market, make a move up there at about $87, $88. If we look at the bottom of the chart, we take a look at the volume oscillator, we can see the volume oscillator has been moving down as the earnings announcement approaches. This is typical with stocks, not necessarily bearish or bullish. It's just typically what you see when a stock is coming up to an earnings announcement. So I think a key thing with regards to stock right now is whether or not that support level, the 81.48 or 81.50 level, is going to hold up as we go into the end of the session or today. If it doesn't hold up and we break down below, then that, of course, would revert and be the current level of resistance for this stock right now, Kevin.
You know, Ken, we talk a lot about the 50-day moving average and the 200-day moving average as we try to keep the presentations relatively simple for our viewers, but this stock will break below its 50-day moving average as it has quite often. So as it's approaching, that can't give us much comfort, can it? I mean, this stock doesn't spend a lot of time below that 50-day moving average, and it looks like this 65 level is pretty important. But final thoughts on Yeti as we let you go, Ken.
Well, I would agree with you, Kevin. This stock does not have a lot of reference with regards to 50-period moving average. There's somewhat of a confluence of indicators here with regards to support. We have the 50-period moving average sitting at 78. We have the market maker move sitting at about 76.50. We also have a previous resistance level sitting at that 76.50 area as well, along with the Fibonacci 38.2. That is a significant support level. If we were to break down and move down towards that 50, it's not only the 50, but there are several other indications here with regards to possibly holding up a support if indeed we do break down and start testing that later on.
Ken Rose, always a pleasure having you on. Thank you for coming by and talking about Yeti and showing us some technical levels that we can look at on a name like this as they approach earnings tomorrow morning. Have a great day, Ken. Thank you for coming on as always, sir.
Thanks, Kevin.
When we're looking at a stock like Yeti, this is a great learning lesson because they've had a lot of good earnings beats. They've had nothing but good news. They're getting raises as they go into the number. But a couple things. Let's look at their expected move, which is about $5.50, $5.70. We'll round that to, and where this stock is. And then look at a couple things on the chart, right? About $5 from here is about, let's say 82, and 5 is $77. But here's the thing. Look at their implied volatility this week in this sell-off. Implied volatility, like the VIX and the rest of the market, is starting to creep up. You're getting into mid-May, you're getting an earnings event, and you're getting a rise in implied volatility. As you can see, the front month's about 114. So how do we look at something like that? Well, I mean, you have to take all of these things into play. Jenny Horn talked about the upgrades that are going through. Ken talked about some of the levels that it has been hitting. And then what you do is you look at the implied volatility and you look at a play that helps you with that. Remember, I'm cognizant of the earnings beats. I'm cognizant of where Yeti is right now, where it has come down off its all-time high. And I'm cognizant of the rising implied volatility level. So I think the short put vertical using the expected move down to the 77 level is the right play here in Yeti. Why? Well, it's doing three things, right? It's collecting theta. If you do it 5 times, it's about $65 a day. It's risk defined and it's high probability. The probability of the 77 put with 2 days to go is about 70%. Relatively aggressive as we move it right to that level. So we're going to use the 77, 72 put vertical, and that is a 70% probability of finishing out of the money. That is touching the 3 pillars of trading like we like: high probability, collecting theta, and risk definition. And then we will look at our trade and say we are about 74 deltas long, collecting about $67 a day in theta, and short that front month elevated Vega that we're relatively sure will come out tomorrow. Now, a move, as you can see, here's where, let's see, we'll reset our slices. As you can see, it's trading about right here. Yeti stock is trading about right 81 and some change. Obviously, a move on the upside is profitable. A move on the downside is profitable as long as it stays above that $77 level over the next 2 days. And the break even on this, well, it's the short strike, 77, minus the 95 cents that you'll take in. So about the break even, about 76.05 is where this would break even. So all of these things make up for a high probability trade in Yeti going into their earnings. Now, what Jenny Horn mentioned, they have a good track record of beating on earnings and going into that. So make sure that you understand that as we look ahead. Let's see. All right, so we're going to put in that 77, 72 put vertical, create a duplicate order, and send that off. All right. Before we bring in Ben Lichtenstein, something for our viewers to watch as the day goes on today. If you're watching this market and looking, make sure you're watching where the 10-year yield closes on the day, because the 1-day, 1-minute chart in the 10-year yield is showing a slow but steady increase. Bonds getting lower, 10-year yields getting higher. That's why the pressure on the stock market is staying as is, because that slow increase in the 10-year yield as the 10-year note and the 30-year bond have sold off is what's keeping a lid on stocks. So make sure you're watching that as the end of the day. Why? Because you got a PPI number coming out tomorrow. So as long as that number stays high, stocks will stay under pressure here today. All right, that's our show for today. Ben Lichtenstein is the host of Midday Movers with Ben Lichtenstein. He's coming to us live from the TD Ameritrade Network studios in downtown Chicago. What do you have for us on today's show, Ben?
Hey, Kevin, we've got our eye on rates and the pressure they're putting on stocks, the indices as well. I've got my eye on the Dow right now. down over 500 ticks as we speak, and really struggling to get anything going to the upside. The last couple days, large caps have been coming under pressure. Interestingly enough, crude oil prices are higher today after some comments from the EIA and a couple inventory draws, the API and the EIA. In addition to that, I'm watching a volatile day for treasuries and the U.S. dollar. That dollar is starting to inch higher, so even more so kind of speaks to the interesting price activity as crude's higher today as well. But we're going to shift attention from futures on over into a couple stocks. We've got Fubo on our radar after earnings. They're our up mover today. Lumentum lower after reporting quarterly results. Kevin Street's going to join us, Kevin, for a look at Dollar General. They got downgraded by RBC Capital. We'll take a look at Alibaba ahead of earnings. And, well, we've got the chart master for a technical look at Tesla, Target, and Domino's. Lots to come here on Midday Movers, some futures, some stocks, a very busy show.
Ben Lichtenstein coming up next, and then Oliver Rennick will market on close after that. For all of us here at the TD Ameritrade Network, have a great afternoon, everyone. We'll see you tomorrow.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
"24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played."
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon, ladies and gentlemen. Welcome to Midday Movers with Lichtenstein. We've got a lot to cover today. Let's get things started right away with a look at what's going on in terms of some volatility today, the CPI, and, well, the pressure it's putting on the indices. We'll take a look at the charts in just a second, but first and foremost, look at the numbers here. The year-over-year numbers are what really is raising some concerns, some eyebrows. 4.2%. They were looking for 3.6, so a lot higher than expected. Prior was 2.6, but you can see, again, with the core CPI year-over-year up 3%. Take a look at the month-over-month, both CPI and the core, as you can see, topping prior and topping estimates. That's got some inflation concerns here, sparked some inflation concerns, I should say, or adding to them. And, well, that's got the Dow coming off. We just posted a new low as we speak, down to 33,721. You can see the trend environment to the downside. I want to point out here we broke down below that 34,000 level and really have yet to look back. It's not just the Dow, though. Take a look at small caps. The Russell coming under pressure, down 2%. You've got the SPX currently trending down 1.75%. All four majors here in a very similar pattern here in terms of weak on the day and trending lower. NASDAQ, the tech-heavy index, down about 2.5%. We still have some companies reporting quarterly results that you should be keeping an eye on. A couple names that we're going to be talking about with our guests today. And, well, Alibaba, Yeti, Walt Disney, and ACB. We're talking Aurora Cannabis should be on your radar. I wanted to take a look at energies. They're actually starting to sell off a little bit into their late-day trade. They've been bid most of the day, and they're going out around 1%, interestingly enough, with the indices selling off in the dollar bid today. But let's take a look at the move up we've seen off yesterday's lows from 63.68 up to 66.60 today. We saw a couple inventory draws. We had the EIA, the API, and we also heard from the EIA. Now, I do want to point out, as you can see, they're coming off a little bit. Let's take a look at those EIA numbers here in terms of the inventories. A slight draw there. Oh, we don't have that, but it was a small draw there. The API was a draw of 3 million yesterday. All right, let's move on over into a real quick look at the 50-day moving average and where crude stands, because again, coming in bid here today, but you can see struggling to get up above a couple hurdles. All right, it's been a volatile day for the treasuries. They're actually lower today in a big way, and that's got rates spiking. This all comes in reaction to that CPI number we took a look at. How about the bonds? How about the 10-year? And the move low we've seen off the highs from Friday, because if you remember, they spiked in reaction to the employment numbers. The bonds on the left up to 160.15 today, down to 155.19. A five-handle move over the last 3 or 4 days here. That's a big move, to say the least. Now, the move lower in treasuries, well, that's got rates inching back up. Now, I do want to point out that 30-year here on the left, still holding below those highs we saw back in March. 2.5%, 1.75% is the key threshold right now to watch in terms of the 10-year to the upside. But hey, we've got some economic data tomorrow with all the focus on CPI, inflation. I think you should be keeping a close eye on PPI tomorrow. You get the producer side of things. We'll also have jobless claims, the weekly numbers, some high frequency data, and then Fed speakers, in addition to some natural gas inventories numbers. But don't forget about retail sales on Friday, consumer sentiment, and industrial production with business inventories. Let's shift gears from futures on over into a couple stocks. First, one to the upside, Fubo TV up after reporting earnings. Let's begin with the news, and then we'll have a look at investors' reaction too. Earnings per share came in a loss of 59 cents a share. You can see they were expecting 46 cents, but take a look at revenue topping estimates in a big way. Expectations for 103.79 million were beat at 119.70 is the actual number. Let's dive into some of the price activity we're seeing in reaction to the gap up, the net change. They're currently up by about 11%, and well, you can see it's been a volatile couple days for Fubo, actually, after selling off that $22 level. They briefly got down below that $15 level yesterday, down $14.64. They're rallying back today, though, and well, all the way up to $22.67, currently trading $19.61. They said to expect revenue for the fiscal year between $520 and $530 million. That'd be around 100% increase if it found the middle 525-ish. Now, that guidance is an increase of about 75%. The company ended the quarter with 590,000 subscribers. That's up from 287,000 a year ago. They said we should expect between 830,000 and 850,000 subscribers by year end. That would be a 53% increase from their 2020 numbers. And, well, they said that we should expect an increase of, earlier they said a 40% increase. So they're raising the guidance there. Now, while the numbers were pretty good, that revenue number especially, they did receive a couple price target cuts. Roth Capital and Oppenheimer both lowered price targets. Roth maintains a buy rating, but cut the price target to 42 from 55, and Oppenheimer to 32 from 35. They have the stock with an outperform rating. All right, be sure to stick around, though, because today on Market on Close, coming up after Midday Movers, we've got Oliver Rennick. He's going to be joined by Fubo's co-founder and CEO, that's David Gandler, to discuss the company's earnings, their quarterly results, and what lies ahead for the company. You won't want to miss it. Again, that's after Midday Movers. Stick around for MOC this afternoon. Next, I've got to look at another big mover, another stock I wanted to bring to your attention. In this case, we're talking one to the downside. It's Lumentum, ticker symbol LITE, down after quarterly results. So let's take a look at what's weighing on investor sentiment first and foremost, and then we'll take a look at the charts. EPS, you can see missing at $1.40. They were looking for $1.42. Revenue also missed expectations significantly, $419.50. tomorrow. They were looking for 434.6 million. Take a look at the daily, the gap lower and the net change. They're currently down by 16.5%. And well, as you can see here on the intraday, really struggling to get off that low that they posted earlier this morning around 68.20. They said we can expect fourth quarter adjusted earnings of 92 cents to $1.14 per diluted share. Analysts were looking for around $1.25, so well above that. Net revenue is expected to fall between 360 and 400 million, well below expectations. They're looking for up around 409 million. The board did authorize the repurchase of up to 700 million of its common shares over the next 2 years. Momentum back to levels they haven't seen since May of last year with this move lower. If it continues this week, that's 3 in a row to the downside, 3 weeks in a row to the downside, that is, as they've sold off that end of April high they saw up around 95, but on a steady trend lower off the high that they saw up around 112. That was to begin the year. All right, that's a look at a couple futures markets I've got my eye on. Some stocks I think you should be dialed in on. Let's bring in our first guest. Kevin Street, a contributor here across the TD Ameritrade Network, is joining us. Kevin, welcome. I wanted to get your take on the inflation data this morning. CPI raising some eyebrows, to say the least.
Yeah, definitely not only just raised some eyebrows, but definitely upticks within the figures as well. I think, as you mentioned earlier, within the all items index, we're actually seeing a 4.2% increase over the last 12 months. And this is before the seasonal adjustments. But again, just bringing that into perspective, this is, pretty much the largest increase we've seen since September 2008, where during that point in time it was a 4.9% increase. A lot of folks are bringing to perspective, though, on the other side of things, that one of the biggest reasons for the big annual gain has to do with the base effects. So what we mean by the base effects is that inflation was actually very low at this point in time, around about this time last year, as the pandemic was beginning to unfold. So, due to low numbers during that point in time, this may actually cause a bit of distortion or exaggeration in the year-over-year perspective. And some folks' eyes, this is part of the reason why the Federal Reserve policymakers and many economists are talking about how this current round of numbers, they're just looking at it as transitory, with the expectation that things may actually start to normalize or come into those expectations of the 2% range that the Fed has been speaking about in the most recent talks that we've seen. Just going further into the inflation talks, I mean, even from an energy perspective, the energy index did decrease slightly, but bringing into perspective, energy prices overall did actually jump 25% from a year earlier. This included a 49.6% increase within gasoline, a 37.3% increase within fuel oil. Although, again, the decrease within the index on the gasoline side was more than enough to offset some of the others within the energy sector. And just kind of reiterating some of these energy points here. I mean, prices at the pump, they did fall about 1.4% in April. But a lot of folks are starting to see this, tick back to the upside within the month of May, as we're seeing the national average start to eclipse around $3 per gallon right now. This is, again, figures we haven't seen since November 2014. And some folks feel like, and the analyst says that this may continue to rise here from the cyber attack we saw most recently on Friday, which shut down the Colonial Pipeline's transmission from Houston to New Jersey. So it'd be interesting to see how that comes into fruition here.
Yeah, the ripple effect associated with the energy discussion and the pipeline shutdown has certainly raised attention towards the commodity rally that we've seen. It's not just energies, though. Copper, we've seen that in terms of metals, lumber, ultimately. All of this has rates on the rise, and it's interesting to see the ripple effect that I've been watching. Home builders, for example, they've been coming off here with rates starting to inch up. So it's interesting to see how these inflation concerns sort of work their way through the market here. Let's talk about a couple individual stocks that are on the move that you've got your eye on. I think we should as well today. Kevin, DG, Dollar General, they're lower today after RBC downgraded the stock to sector perform from outperform. What are you seeing in terms of price activity?
Yeah, so from a price action standpoint, they are actually within the midst of a fairly big downtrend, or coming in the midst right now of a downtrend, as we've seen 3 consecutive gap downs, but not only gap downs, major down days following suit to those as well. A big part of this has to do just with the inflation talks that are now part of the major headlines right now. I mean, put into perspective, part of the reason why they had some of the wins that they saw in 2020 was just due to some of the stimulus effects, which a lot of their consumer base were probably some of the main folks to actually be eligible for those stimulus checks. This is part of the reason why RBC Capital believes that this actually may now start to work against them. They did actually tweak their price target to 207, which is just $1 higher, but they did actually lower their rating from outperform to sector perform. And they had just a couple of major points of feedback. Again, the macro headwinds from the inflation talks, Not only that, but just they believe that they may actually come into some, operating environment, we can say obstacles, to phrase it that way, in terms of the sense of how the inflation may come into perspective, which may lower consumer spending power. And so those are things that, although they may see near-term benefits and they may, potentially see the consumer habits, be part of what they see in the growth in the longer term, they believe that inflation more so is one of the bigger points that may draw down that growth within a larger spectrum of a picture. And we're talking, over 2 years of an outlook here.
Inflation also, as some of those stimulus measures start to fade out, certainly that could impact them as well. They mentioned, let's talk a little bit about Alibaba. Set to report quarterly results tomorrow. This is before the open. EPS, I saw, Kevin, at $1.91 a share. They're expecting revenue of $27.92 billion. What else should we be looking for in terms of this report?
Yeah, well, it'll be interesting to see us how Alibaba navigates the regulatory environment that they're in. I mean, again, just, from things they may mention within the conference call, granted, in 2020, they did see a boost in demand. The revenue did jump 35.2% on the year to $509 billion. The net income was up 70% in the year 2020. And in the most recent quarter, they did, talk about the reports of how they saw the 50% increases within the cloud computing revenue. However, right now within the near term, they have taken a huge hit from Chinese and United States regulators. On the Chinese side of the spectrum, co-founder Jack Ma actually criticized regulators for having a quote unquote pawn shop mentality when it came to banking. This actually followed suit with the Chinese regulators suspending the IPO of their affiliate Ant Group, which they actually went on further to initiate an antitrust crackdown. And then ultimately, this ended up in a $2.8 billion fine for Alibaba as they violated those antitrust regulations. But not only that, on the United States side of the spectrum, there was some Senate bills that went into effect here back in March that could potentially lead to threats to Alibaba in terms of being delisted within the United States within a matter of years if they can't continue to meet some of these strict accounting measures that the United States has imposed on these Chinese stocks to prove that they aren't being controlled by foreign governments. So I'd be interested to see how they talk about navigating through that environment, and also in terms of if they can keep up with the upticks that they've been talking about in reports to the cloud computing revenues, since they have seen increases within the e-commerce and the cloud services environment.
Yeah, you can really see how all of that's been weighing on sentiment in terms of price activity. They rallied up to 319 back in the end of October of last year and then sold off. They come off down to the 210 level, 211, and they recently just retested that level. But you can see how they've been struggling to get anything going to the upside here. Investors are going to want to see this level support hold here. Certainly earnings are going to be a big part in terms of determining whether that will be the case or not. Kevin, appreciate you joining us here. A great breakdown in terms of a look at a couple stocks you've got your eye on and a review of that CPI number. Certainly it's still on the minds of many traders and investors today as we head into PPI tomorrow. Kevin Street, always a pleasure to have you on the show, and we look forward to having you back here. We're going to take a quick break. When we come back, my chart of the day, the U.S. dollar. Stay right here on the TD Ameritrade Network. Midday moves at Liechtenstein. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Let's look at the stories making headlines this hour. Americans are increasing their spending as vaccinations continue and pandemic restrictions ease, according to the Visa U.S. Spending Momentum Index. The index reading implies that 65% of consumers are spending more than they did a year ago, while only 35% are spending the same or less. In April 2019, before the pandemic, 51% of consumers were spending more, according to the Card Payments Network. The California Air Resources Board wants almost every trip on Uber and Lyft to be in an electric vehicle, mandating costly measures that the ride-hailing platforms call unrealistic without additional public subsidies for EVs, Reuters reports. The proposed mandate, expected to pass on May 20th, require EVs to account for 90% of ride-hailing vehicle miles traveled by 2030. The companies are pushing back, wanting taxpayers to shoulder the cost. And the U.S. Treasury sold $41 billion in 10-year notes at a high auction yield of 1.684%, with solid demand for the benchmark paper. Investors bid $2.45 for every $1 on offer from the Treasury, firmly higher than the $2.36 bid to cover ratio recorded at the prior auction on April 12th and the highest since January, when the yield was at 1.68%. Indirect bidders took down just under 64% of the sale, an improvement on last month's sale and the best since August of 2020, suggesting foreign demand remained firm. This has been your TD Ameritrade Network Market Update. Now back to Midday Movers with Ben Lichtenstein.
Thank you, Stephanie Lewicki, and welcome back to Midday Moves at Lichtenstein. It's time for my shot of the day. I've got my eye on the U.S. dollar futures contract. I think you should as well. It's been a volatile week with inflation data this morning, rates spiking. Well, again, take a look at the move that we've seen. First and foremost, I want to pull up the daily time frame so you can see the trend environment that's been playing out to the downside. And I also want you to take a look here at what's been going on here in terms of the weekly time frame, because we're nearing some key support here as we worked our way back down to this 90 even level this week. We've got some lows from back in February of 2018 to contend with. Here you can see the intraday time frame, though, the move up that we've seen this week. We've kind of reversed the pattern that we had been seeing in terms of some of that downside momentum. We bottomed out just below 90 even, and we've worked our way back up to that 90, 75, 90, 80 area. Now, I want to remind everybody that if you don't have access to the dollar index futures contract, that's the /DX here on the left. You can always pull up the index, that's the $DXY. You can see how these two track each other very closely. Again, the futures contract is tradable, the index is not, but if you want to keep an eye on the dollar and you don't have access to the futures contract, definitely pull up the $DXY. Another quick look at the daily time frame shows how we've been weakening after failing around 93.50, but really the reason I've got my eye on the dollar is because the relationship it shares with some of the commodities, which feeds back into that inflation narrative. Crude to the upside with the dollar weakening, and well, ultimately you can see here how recently the dollar's been a little bit more closely tied to rates than in years past. We've seen kind of an inverse correlation. Rates starting to inch up here recently, so's the dollar, and we certainly saw that playing out here on that move off of the lows from earlier this year up into recent highs. Again, the TNX up around 1 3/4%, right around the dollar maxing out right up around that 93.50 area. So certainly something to keep an eye on. Financial markets here, a reflection of what we're seeing in terms of some of these inflation concerns. I want to bring in the chart master next. I want to bring in Mr. Ben Watson. He's joining us this afternoon to shift attention back on over to a couple stocks. Ben, we were just taking a look at the dollar on the move. You've got your eye, it looks like, on a couple individual names you wanted to bring to our attention. First, DPZ. Yep. Domino's. I saw this spiked on the news that activist investor Bill Ackman, well, his fund, Pershing Square Capital Management, has sold its holdings in Starbucks and replaced them with Domino's Pizza. They now hold a 6% stake.
Well, you can't live on coffee alone, right? You got to have some pizza in there, right, Ben? So look, this has been an intermediate to long-term sideways trend with a pretty strong intermediate upward rally, and we get this bounce up off of that 420 support. And really now what happens with this activist move, we get a bounce and this little bit of a pullback into the 436. And I think this is where this candle is really kind of interesting. We don't see a lot of big candles like this unless there's some sort of news event that happens. And we sometimes call this a hypodermic needle candle. We might talk about this one as throwing the dough up in the air and it comes and flops back down on your face. But it broke up above on this gap down rally to above the 436 half, but well off those highs. So now the question is, can this in the follow through gain some traction, at least enough to break out through that 436 again and continue to make some new higher highs? If not, you've got this support that's building right here down around the 405 mark that could be a pretty solid level of support at this point, Ben.
I mentioned the 6% stake. They told the Journal that that wasn't as big of a slice of the pie as they wanted. Apparently, they wanted more. Talk to us, because they were pretty clear in terms of the restaurant industry. They said as long as the fund's been around, they've never lost money investing in the industry. But it looks like the RSI got a little bit overdone to the upside. It's pulling back some right now, but oftentimes you talk about those prior areas of resistance providing current support. I'd imagine that's what investors want to see at this point.
Yeah, very definitely. And the fact is, I think this is a bullish sign, the fact that the RSI reversed at this point. It didn't really drop significantly here below that overbought line. So I think if it can work its way back up into overbought and this price can hold that support off the 420, I think that becomes a pretty bullish bounce type of area, maybe a bigger bull flag in this longer, intermediate to long-term run to the upside.
Ben, let's move on. You've also got Tesla on your radar. I'm looking right now, down by about 2 1/3%. Now, JP Morgan had some comments calling the reports related to Tesla's halting of the Shanghai expansion. They basically called it old news. They said that they had been reported by local media early in April. They went on to say that media reporting on Tesla's April electronic vehicle sales plunging 67% month over month, they said those are inaccurate. Basically, they were debunking some of these concerns that investors have been faced with.
Yeah, absolutely. And while that started to really move the stock up off of that support level yesterday, we get again this gap down into this kind of really, it's been toggling between just a doji star here and an inverted hammer at this support level today and right at this 593. That becomes kind of the key challenge. Now at this point, it's an equal low. If it breaks down to the next support level below into that 553, now that's an equal low to that longer term trend. If it starts to move lower than that 553, then I think that's when investors begin to worry on the long-term trend here, because that's now starting to make lower highs. It's got to get it back up through that 715 resistance to really start beginning to make those new higher highs here, and it's not there yet, Ben.
Looks like RSI is trending lower here as well, but still holding some key support.
Yep, it is. Lower low versus price. Price is holding the support. This could be a little bit of a bullish bounce, but RSI's got to turn around and start moving for this to get off that support level.
All right, that JP Morgan note basically pointed out how some of the activity that they've seen is more seasonally related rather than tied to some of the geopolitical tensions that initially we had heard the media talking about in terms of U.S.-China relations, and this all tying back to that Shanghai plant. Let's talk a little bit about Target coming off 3 days in a row here after posting up 217.39. I saw a price target hike from UBS to 210 from 185. They've got the stock with a neutral rating. Morgan Stanley also increased their price target to 205 from 195. They have an equal rating on TGT.
Yep, those price target hikes, though, not lifting the price of the stock as it comes bouncing down from that 212 resistance. Now, maybe one of the things that Jenny talked about in the update.
Monthly crypto dip. Ethereum is now down about 10% from its high early this morning. It is technically only down 1.55% from the previous 1.7. Now, but it's about to dip below 4,000. And I mean, just consider it was 4,400 earlier this morning. That is a huge sell-off. That's $400 per coin less, which is actually, well, I guess that wouldn't be more than 10%. It would be slightly less than 10%. I'm flip-flopping my math here. Maybe like a 9% drop from its high this morning, but it's continuing to go just as we're watching it right here. It looks like it might have dipped right there, slightly below 4,000, and came back up and back down. Bitcoin now down below 54. So, if you follow some of these trends, just like we had Bitcoin just a couple of days ago, or a couple of weeks ago, with the Coinbase fiasco, and then last week we had the Dogecoin Elon Musk fiasco, which could be after these events where they maybe don't really do what people thought they would do, or something like that. It sort of makes sense to have a little bit of a sell-off. And if that's the case, I sadly always welcome these types of sell-off because they're buying opportunities. It's, I mean, 10% dip in a day, or sometimes 25 to 30% for those kind of 2 or 3 days. It's a massive buying opportunity. Kind of interesting. We haven't seen a big of a dip in Dogecoin. It's down, but only down a couple of days, which is not as high.
24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon. It's 2 p.m. in Chicago. We got 1 hour left in the trading session. Bulls hoping for a bit of a stand here as we've got some strength showing up. But man, it has been a rocky session. And with all the dynamics playing out that we've been cautioning about here now for some time, this has been a market that's been reeling with the possibility of inflation, and it's here. Is it going to stick around? Is it going to be powerful? Is it going to be painful? Those are all up for grabs right now. We're not waiting around to find out. We've got two big issues for this market that continue to weigh on investors on the long side right now, and that is a peak earnings growth for tech that has been unwinding since earnings. Nothing to do with inflation there. We've seen fades in the biggest, most important companies despite incredible numbers they put up. The bigger numbers you did during earnings season, the more the market puts you in the category of a quarantine stock that's never going to hit that growth again. And so that's been one issue. Then on top of that, now we have real inflationary forces that are at work. Everybody knew we were going to get a hot number. Everybody knows that there was a base effect from a year ago that would push that number up. But to see the sequential month-over-month change and the speed at which prices are going up, the story is about a lack of supply across all kinds of industries, from energy to tech to Chick-fil-A sauce. You can't even get double Chick-fil-A sauce, apparently. That's how much of a problem there is with the supply chain. So some of that stuff is going to be temporary for sure. But right now the market's not waiting to figure that out, and it shouldn't. This is the argument that we made yesterday here on the show, was that the risk reward of being long bonds in an environment where inflation's now picking up, the reopening around the world is just getting started. Ours here has already gotten started, and some of our economic data is moving pretty quickly to the upside. In fact, there's an argument that maybe the momentum of our own data might be peaking, but the overall trajectory and the path going forward for us and the rest of the world getting back to normal is very much in play still, as vaccines now are getting more and more of the global population. So why stick around and wait to find out if inflation's going to be here for a month, 2 months, 3 months, 6 months? And without any hikes from the Fed, we can be sure that at least the central bank will not be responsible for stamping out a recovery. And that's the framework for bonds that I've been arguing here. It will bring more selling and deep selling as we've gotten today. So TLT is the most important mover, of course, down. If you want to be short bonds, you could buy TBT, the inverse ETF that tracks the yield basically. But here's a selling in bonds, and it's not letting up throughout the day. The 30-year made new lows after a good 10-year auction. That's important. Thought maybe if the 10-year auction went well, we'd find buyers for bonds. Market would stabilize. Stocks are a little bit here, but bond market, not really. We were just pushing new lows of the day again after that auction. So it seems like even if there's buyers here for the bonds, that there's just enough selling pressure at this point. Again, why would you even want to take the risk of owning bonds in an environment that we're seeing right now? So the dollar too is very important here. I want to come back, as we pointed out this morning, the dollar arguably the most important asset right now, because what we've seen is basically a free fall in the dollar over the past month. But today we're finding buyers. Now we know that when the stock market gets hit, a lot of times the dollar gets bid, so maybe there's some risk-off action happening there. But if you look at the way the dollar's played out throughout the day, it's been strength basically from the get-go. The fact that you've got the dollar strong on this inflationary print should be a little reassuring that at least for the moment, this is not highly problematic inflation. It's probably more inflation related to some of the short-term supply chain issues and what's happening for recovery, which is a good thing. It's a good thing. People are going to get paid more because right now the jobs are going to have to hike their wages. There's a lot of good things happening here. Unfortunately for the stock market, especially tech, it's been running on bad things for a year. So why should we see some of this unwind again? So the dollar finds some support around 90 here, and the dollar gets a nice little bid. This is a good day for the dollar for sure. If it's good inflation, then the dollar can remain maybe strong. If it's bad inflation that's going to erode the reserve currency status and all that stuff, then maybe the dollar will get slammed. And that's why gold and Bitcoin are very important today too, because they're down as well. Because the story here is not about hyperinflation. It's about recovery. Short-term inflation, maybe it'll go longer. Maybe it'll turn into hyperinflation. I don't know. I can't figure that out. Nobody else can, frankly. What we're seeing right now, though, is that this story about Bitcoin especially, and gold too. Gold tried early this morning. Gold jumped and then went right back around. The idea that these are inflation hedges is just not working. If you look at the way Bitcoin's performed relative to the NASDAQ since the NASDAQ's closing high on April 16th, day that I cautioned for more downside in the market, Bitcoin's been getting slammed since then. It's down worse than the NASDAQ. What kind of hedge is this? Look, I've always maintained here the most important thing, the most compelling thing, in my opinion, for Bitcoin would be if Bitcoin goes up as the market goes down. That has never happened in a meaningful way before. We've made new highs in the market and new lows in the market while we've made lows and highs in Bitcoin, respectively. It's always worked like that. And now it still works like that, except this time we actually have inflation as the driving force. What we've got right now is recovery, and inflation worries that are the biggest concern for investors in the equity market. It's down, and Bitcoin's down even more. It's bogus, the story that this is an inflation hedge. It's a lie. Moreover, if it doesn't work now, Bitcoin is in for a serious reckoning. A serious reckoning. It has to be, because the whole narrative that's built around it right now is crumbling to pieces. All right, let's come back to the movers real quick. It's a big deal. And if it starts to get really heavy, then why wouldn't it affect tech too? Because everybody that owns Bitcoin and crypto owns tech as well. It's a serious issue if Bitcoin starts to break down. It didn't do anything today. This is the hottest print for month-over-month inflation since 1982. Way above what people expected. Oh, Bitcoin rallied 100%. Bitcoin did this or that. No. What happens right now is what matters, because we're seeing the market respond. Everything here is reorienting. Bonds, dollar, gold, stocks, Bitcoin, everything's responding to warming inflation, and Bitcoin's doing the worst. All right. Crude oil's working. Commodities are working. That makes sense. Everything here is telling us a very clear story. The risk, of course, that the inflation can run away, but right now the market is giving us a general idea that there's a healthy amount of demand and recovery that's taking place. That being said, though, some of the reopening trades are getting hit too. So while the reopening might be good for some of these stocks, keep in mind they've already run a lot. And so you see pullbacks not just in the ARK fund and the growth stuff, but also the reopening trades too. That's where the sell-off is getting problematic. The Russell's going down with the NASDAQ. We're seeing the Dow getting hit now. Only energy stocks are higher. Banks were higher early and they faded too. So it's just not a lot working right now. The combination of inflation risk and what we've seen for high valuation companies that are just exhausted. And apparently some crypto stuff too. Let's go to Nicole. Let's talk some more movers here. My rant is over. Nicole, there's plenty of stock-specific stories out there though. So I'm talking macro. Give us some of the stock stories that are happening today.
Yeah, as you can see, the sell-off is broad-based, and in some cases, you're seeing some stocks drop dramatically. A name like Array Technologies, you can see it's down over 40% today, dropping below the IPO price of last October. This company, basically Array, makes ground systems for solar energy products, and they've faced a couple of things: rising costs, less than attractive tax benefits, moving not in favor of their direction. So you can see that the stock is selling off here. Costs, steel and freight are on the rise for this company, and that's one thing that they note. When you see the stock here dropping below the $22 IPO price. The other thing is the tax credits, the investment tax credits are being reduced. And so that is not in favor of this company, which is now trading at around $14. Last October, this went public, the NASDAQ, October 15th at a $22 price, but they missed their profits and they're pulling the guidance. So it is a miss all the way around. There is nothing that's coming out on this that would make you say, I'm dying to buy this one. Other than maybe you like the concept, right? Ground systems for solar energy products. But for right now, they're facing higher costs, unfavorable tax landscape. That being said, how about looking at a name like Dollar General, which, like many in an inflationary environment, in a reopening environment, those trucking costs have been on the rise for Dollar General. And as a result, the company is moving to even expand its own fleet so they can get Dollar General fresh out, refrigerated trucks. But that'll cost them something, no doubt. And so you are seeing a couple of moves here. Downgraded to sector perform from outperform at RBC Capital. Price target now 207. And they expect growth to slow in 2021. They are expanding their own private trucking fleet. The stock has come up from 173 mid-March up to this level of 206. But as you look at a chart, it really is choppy. at best. And so that's something that is worth noting today, down about 3% on the heels of this downgrade I'm telling you about. And last but not least, DraftKings getting a price target cut over at Goldman Sachs. So DraftKings, they did come out, right? They had a good quarter, and they did see their users on the rise, and the average amount per user, right? The dollars spent was up 48% year over year. DraftKings is still favored on Wall Street overall. You did have Cathie Wood over at ARK selling off some of her Apple stake, in fact, 30% of her Apple stake in ARK, and picking up DraftKings and Coinbase. But it did come out with better than expected sales and had good full year guidance. But you are seeing that now. Goldman Sachs cutting the price target to $77 from $88 for DraftKings. Right now it's at $42, so you still have a lot of upside potential.
You know, it's like picking through the worst of the poison here, selling big tech for some of the other high growth names that are really under pressure. It's like, you know, as much as these businesses people seem to love, you know, I know tons of people use DraftKings all the time. We've talked with the company about their plans to continue to expand. The legalization story seems to be compelling. But at the end of the day, one of the things that I've just learned here working with traders is that, you know, price action is king, as they say on the technicals, and it's hard to really get excited about some of these fundamental stories when DraftKings goes from 55 to 42 in a couple days, right? Penn too getting slammed lately as well. So just everything that kind of has to do with speculating of various forms is coming under serious pressure, and to see the cut, you know, on DraftKings as well, just kind of symbolically is notable as well. I mean, even while some people are upgrading it, to see the price just get slammed like that.
Yeah, absolutely. A cut is a cut, right? And so whatever they thought at $88, they don't think anymore. Now they think Goldman Sachs is talking about $77. So to your point, I know it recently sold off, and these have been, you know, these growth names have been a little out of favor and have certainly been extremely volatile. And the names within the ARK fund have been even more volatile. So we'll continue to watch the story. But they do have 1.5 million monthly unique paying customers, which beat out that 1.3 million. So they did something right for sure over at DraftKings.
Okay. All right. So in this moment here, price target cut, even if it's $30 above where it trades right now, is enough to kind of pile on to some of the negativity in some of these trades. Nicole, appreciate the heads up. Array Technologies is also dragging on the solar group too. That's an interesting story there as well. As TAN ETF, TAN is down 4% right now, 5% actually now. All right, we'll catch you at the bell, Nicole, and talk some more movers then. Right now, I want to bring in Andrew Smith, the Chief Investment Strategist at Delos Capital Advisors. Andrew, welcome back to the show. You're here on a big day, I think one that is going to stick in our memories for some time, and certainly stands out as a lot of these charts come on deeper pressure for high growth names. Yesterday, a lot of people were thinking, okay, these things have had enough now. And I guess think again, how big a deal is the section that we're looking at right now?
Yeah, well, I mean, really, it's only 4% over the last few weeks, coming from all-time highs. So it's not necessarily a big constructive, you know, something seismic occurring underneath the surface. What's just happened is what you alluded to earlier. There has been so many dollars flowing into our high growth names. That inflation print that came out this morning really kind of caught people by surprise because of the month-over-month sequential increase. But really now, hey, is there going to be increased taper talk? Is there going to be increased, you know, moving forward of a risk of Fed raising those rates? And that really starts gyrating risk assets. But most importantly, that hurts the indexes, which are so overexposed to technology sectors, that growth now starts really coming under pressure, as those are long duration assets that have a lot of sensitivity to real rates or break-even rates.
We're getting kind of the rest of the market caught up. To your point, the S&P only down 4% from the highs, the NASDAQ a little bit more, but then there's a whole cohort of companies that are people's favorites that are just getting crushed. Downtrends on a technical basis, lower lows, lower highs, and also bear markets as we're down 20% or more in a lot of these stocks. What's the risk that finds its way into the rest of the market, Andrew, where even if we look around and we see a reopening happening, if folks are losing too much money and need to take profits on other stuff? I mean, for example, I see Expedia down today, down big. I mean, Expedia just hit a wall here after being near at highs.
Yeah, so that's that earnings recovery kind of that we've talked about, or that you've mentioned before, that the momentum is now starting to wane. We have seen a lot of great price appreciation just over the last year, and specifically year to date. So having some of these names starting to pull down, show some different technical aspects that have breakdown characteristics, that really is just a phenomenon on, earnings momentum slowing, the amount of dollars that have gone into the market, and those are what investors need to be worried about. Investors need to really not allocate to companies that really have been the darlings. They want to go find those cyclical names, those names that have continued earnings expectation with the economic recovery still intact, but also have low dispersion in their earnings. And what I mean by that is some companies out there that are really loved have a wide earnings dispersion. So they've got analysts that have, really high projection and another one with a really low projection. Those companies typically are not high quality companies. So if investors focus on those, they're going to get a better risk reward trade as we move through this kind of more volatile period that will persist for a little while longer. I think I lost volume there.
Looking at some of the economics and the market dynamics and how they connect, Andrew, thinking about the potential for the wages to play a role and the joblessness to fill the gap that we saw in the last employment report. What's on the top of your mind there? I mean, I know you've got a few ways to look at this. Demand for workers, demand for jobs. Right now, apparently the workers are in more demand than the jobs.
Yeah, and I think that's the biggest risk that investors truly need to focus on. So what we're really thinking about now is the jobs are there, right? But the amount of stimulus checks that are going out, the amount of people that are still choosing to maybe not go to work because of the COVID assistant programs that are in place, either from a state level and federal level, is really kind of creating this opportunity cost where people are not wanting to go back to work immediately. Well, what happens is these companies now need to bid up their compensation packages, which creates that wage inflation. So now with wage inflation coming in, we know economically and historically, wage inflation really kind of exacerbates our inflationary stories. So the Fed's dual mandate already is being kind of ticked with a check mark that inflation is here. Is it transitory? You said it earlier. It might be, it might not be. I think that there's probably a little bit more pervasive and persistent inflation scenarios that will continue to occur because of structural things that happen from COVID. But really what pulls the Fed forward is the fact that people need to go back to work and wages will pick back up. And that right there might cause them to pick up their pace of taper conversations.
The blue line here, jobs, workers hard to find. The list of reasons for why businesses are having issues. We just saw this from the NFIB, the survey here of those small businesses, that huge move up is how difficult it is to find workers right now. Is there any potential, Andrew, in your mind that folks are now so well supported by the government that there's going to be a rude awakening if they expect they can hold out from taking these jobs for longer than the government is willing to keep the employment benefits going? Or is there going to be a mismatch there at some point where if I'm waiting for improvements to be made at my job until I want to go back, I feel comfortable with my financial situation right now, but what if that job then a couple months from now isn't available, or if they haven't changed something and my stocks are down or my employment is not coming through anymore? I mean, what's the possibility here that we just have this smooth transition where all the employers go, yeah, we're going to hike our wages? I mean, we've seen some of that, but we've seen it from companies that are the best and the most dominant in their space, like Chipotle, for example. That stock has crushed everything in the restaurant space. They can afford to hike wages. So is there a potential mismatch coming down the road somewhere?
Yeah, definitely. I think a lot of just the supply constraints that we've seen have caused companies to remove guidance, have caused companies to slow certain CapEx plans because we just don't know what supply chains look like right now, given post-COVID. That will potentially derail the hiring, the employment aspect. And there will be a mismatch potentially if individuals forego not going to work and these companies now down the road decide, hey, we are not going to hire anymore. We're pulling back the amount of people we're hiring. And then especially as the economic momentum will decelerate. It has been a phenomenal recovery, and we can't expect this rate of change or this momentum to continue. The economy will still grow. It just might now be at a slower pace. So yeah, there is that potential risk there where people just choose and forego not to go back, and those jobs might not be there in 6 months' time.
Thinking about kind of what comes next, if we do see that this inflation potential has sticking power, should we think about today as being dynamics that can hold, Andrew? Are we going to just keep seeing yields grind higher until something changes here?
Yeah, I think there's a big potential with that. We've seen break-evens move higher. We've seen companies talk about supply chain issues. We have seen individuals have to go out and rent cars because of used car prices just soaring through the roof. Be it transitory or not, we still think there's a few more months left of this inflation acceleration aspect, and investors need to prepare for that because these violent moves higher that are occurring in interest rates obviously is impacting the riskiest of the markets. Bitcoin, SPACs, IPOs, all of those are pooling or seeing asset outflows because they have been the darlings of Wall Street. But now this higher interest rate environment is causing people to reprice and focus on shorter duration stocks or risk assets.
Okay. Andrew, thanks for the connecting here between the economy and markets. Always good to catch up and see what charts you got your eyes on. Thanks a lot.
Thank you.
Andrew Smith is Chief Investment Officer at Delos Capital Advisors. Let's begin our corporate conversations next. We're going to talk cloud companies. They've been under a lot of pressure. One of them trying to hold on today. Dynatrace, the CEO, will be joining us right after the break here to talk about the company's earnings. Cloud stocks are down 2.5% today. Dynatrace down 1.5%. Stable after earnings.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Shares of Dynatrace down 1.5% today. In a cloud space, it's getting rocked. The stock has been stable the last 48 hours after reporting earnings that exceeded expectations. We have the CEO joining us. John Van Siclen is the Chief Executive Officer at Dynatrace, ticker DT. John, welcome to the program here. You guys just reported an earnings that is trying to keep you out of some of the muck of selling that's happening in the market right now. So walk me through what the company has done over the past year as we see growth beat expectations, revenue of 31% on the year, and just about every analyst on the street says to buy your stock.
Well, it has been a great year. You know, as we all know, it was a crazy one to start. Our fiscal year starts April 1st. So pandemic at first proved tremendous resiliency in our value proposition as we helped global 15,000 companies build better applications and extend that application reach further and faster. And so the growth this year we're quite pleased with, a little over 30% year-over-year growth. and a solid balance, really, of growth and profitability.
John, one of the things that stands out when I look at your company versus its peers, it's just a very clean-looking financial statement progress over the last couple of years in terms of both top and bottom line, where you actually are generating earnings on the bottom line. How is that possible right now? We've seen so many companies in your space that are still unprofitable. What sets you apart there?
Well, there's a couple things. One of them is an efficiency in our product that is unique. Our gross margins are best in class, which helps drive the rest of the P&L. But also, we focus on the 15,000 largest companies on the planet, the biggest brands, those with the biggest cloud projects. And as most people in tech know, it's an 80-20 rule. 20% of the buyers out there spend 80% of the money, and we focus where the money is.
What about for growth going forward? We saw a huge pickup in demand for pretty much all things tech over the last year. Will you be able to sustain that as things get back to normal and businesses are able to operate back in offices? We've heard some of the big bank leaders talk about how they're planning to bring people back into the office. But it looks like from what I see in the analyst expectations, they're still looking for 20 to 30% growth from your company in the coming quarters. And that's about what you did over the past year.
Yeah, well, our business is fueled by two megatrends that are, sort of long-term megatrends. The first one is that software is eating the world. And the second one is that digital transformations are cloud first. And we're at the intersection of both those megatrends. So whether there's challenged verticals, they still need to spend on software. When things are really good and growing, people spend on software. And as long as they continue to do that and they continue to do it with modern clouds, Dynatrace is well positioned for continued growth at those kinds of levels.
What about for clients right now? Is your emphasis on getting the biggest bang for your buck for clients that are already with the company? Is it coming up with new products and existing relationships, building on those, or will we expect to see advertising and marketing pick up as you continue to compete? Companies like Datadog, Splunk within your category, the stocks have done quite considerably worse than yours, frankly, over the last now year-long period, given some recent selling. So do you see this as an opportunity to get ahead of the competition?
Certainly do. We're intensifying our investments in both commercial expansion, that's sales operations, some of our partner programs and marketing efforts, as well as our innovation engine. Just in the last 4 months, we brought out 2 additional monetizable modules, on top of our platform. Brings us to 6. We had 4 before, 6 now. So it sets us up well, for continued building blocks for growth in the future. Solid commercial expansion, great innovation, and a great market to scale into.
Okay. John, looking forward to seeing this come to fruition and talking more about it. Congrats on the quarter, and congrats on standing out right now in this environment. Appreciate you joining us, John Van Sicklen, the Chief Executive Officer at Dynatrace. Thank you. Ticker DT. Trying to hang in there as investors just bail from tech as a whole. We've got new lows on the day for the Russell 2000 and the S&P 500, just really falling apart here now, down 3% for small caps.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Let's talk some options trades. VIX is popping and volatility is back. Tom White has a few stocks he's got his eyes on for us. Tom, let's talk some VIX first. As any options trader needs to think about volatility right now, it's starting to pick up. So if you didn't buy your umbrellas in case of rain, they're getting a little bit pricier here as the market makes new lows of the day. 28 now, a level we haven't seen since March. What do you think?
Yeah, I think it just kind of reflects the uncertainty in the markets as we're sliding to session lows here today, Oliver. And this is what we always kind of try to explain. The VIX is basically, you know, a product on a short-term basis, short-term S&P 500 volatility. Demand for calls and puts in there, right? And it's starting to expand. So you're getting the fair gauge moving higher. And when it's low, when it was back down under 17, near 16, you know, we're still with that uncertainty out there and the market's at or near all-time highs is when you should start looking at this type of product. But what happens is you start getting a sell-off and then people start piling in here for some protection either on individual names or their portfolios. So seeing a lot of volumes in there today also, which is to be expected on this massive slide.
So we broke 20, but it didn't last for long, Tom. And what we saw there was some of that froth that had been in the VIX was coming from call buyers, keeping it elevated. It fits, right, with the fact that we've seen those big growth names all roll over now. So the things people were YOLOing on was helping keep the VIX bid, except this time now it's a bid because maybe people are YOLOing in the opposite direction.
Yeah, I think you're exactly right there, where now that we had a lot of volume and you kept that VIX elevated up to near 20, even though markets were hitting new all-time highs coming out of the pandemic earlier this year, now you're seeing it concentrated on the put side, where they're bidding up every downside put that they can in the S&P 500 options, which is equating to that demand and increasing the price of that VIX product.
Okay. All right, let's talk your trades here. Let's talk Las Vegas Sands first, because it's not just the tech stuff that's hurting today. In fact, it's even worse now in some of the reopened themes and consumer discretionary stocks in particular. LVS is not too bad. It's down 2%, but still, I'm looking at the away ETF, the travel ETF, down 3.3%. I mean, it's just really no hiding out, even in the reopening trades today. So what was the option you saw on LVS?
Well, if you looked at it in the September calls, they were buying some out-of-the-money ones at the 60 strike. They bought about 5,000 of those for a debit of $3.80. Takes that break even back up to 63.80. But you're giving yourself some duration here, Oliver. 128 days in this trade. Now, you got to remember, in early March, LVS was trading above 66. We're starting to see some record numbers, year-over-year numbers out of some of the casinos in Las Vegas and Macau that are up 1,000%. Now, what does that mean? Well, there was nothing going on last May, so you have to take that into consideration. Right. But they have slowly moved higher as people are getting vaccinated. People are willing to go to these casinos. You were just in Vegas, Oliver. You know that. You know that, and you know travel's picking up there. And if you continue to see that acceleration in Macau and some of the other places in the Far East, along with Vegas, you know, this is one of those reopening plays that's worked out well, because it's only down about 7% this year, but it's sliding about 10% this month, and that's a concern. 200-day moving average is around 55, so basing out around there. So you need that move up above 63.80. But I think the key here is in these September calls is that they're giving themselves plenty of time to get the air travel back, to get the visitations back, and the vaccinations are getting widespread. So that should be a bonus for LVS moving into the fall.
Interesting. All right. So a call buyer here stepping in, saying enough's enough. Maybe looking at some of the moving averages as potential support. I can dig that. If you think that today you just got everything kind of getting thrown out, baby, with the bathwater, etc. What about for Qualcomm? You got to trade there, and they didn't like some of the Apple news the other day, and the stocks continued to come under pressure. What are you looking at here, Tom?
Yeah, I think somebody may be taking a bearish view here because what we've seen there on the technical side is a break of its 50 and 200-day moving averages this week, and also, you know, it's got a flag of a death cross coming into play where that 50-day goes below that 200-day. And if it fails to hold the support that it's currently at right now, stock's down over 3% today, it could slide down to 110. And I think the unusual option activity I saw in here is somebody that's either protecting a long stock position by buying some out of the money puts or just taking a shot to the downside. They were in there buying the May 28th weeklies, so just a short-term trade of about 16 days here. They were buying the 115 strike puts. They bought 5,000 of those, a debit of 135, so it takes a break even to 113.65 to the downside over the next 2.5 weeks. So maybe somebody playing that we're going to see some continued weakness in the tech space, especially these chip names. And you mentioned that they could potentially lose another customer in Apple by 2022, 2023 in their 5G cellular modem chip. So maybe that's putting some pressure on this stock also. But it is sliding. Technicals are broken down.
Definitely. Chips from the get-go this morning, just really in a lot of pain and getting wrapped up with everything else as if they weren't the kind of backbone of the entire economy around the world on a global basis. We're here talking inflation and recovery, but now there's issues obviously with the chip supply chain, so they're not working either. Chips are down 4%. Qualcomm getting hit here too. You got one more for us, Tom. What's the last one?
Visa. This stock just hit its all-time highs at the end of April, Oliver, above 237 a share. Pulled back about 5%, 6% so far this month. Payment volumes, they're above pre-pandemic levels. Brick and mortar volumes are up 3% from pre-pandemic levels. So things are going well for these, these credit card companies. But at the same time, if consumer spending starts to pull back or anything like that, coming off all-time highs, we could see some more downside. But I think somebody taking advantage of the pullback that we've seen so far this month, buying some August 230 strike calls. They bought 15,000 of those for a debit of $7.60. So paying a pretty big option premium. That takes that break even to 237.60 over the next 100 days. So you have over 3 months in this trade. Break even's about 7.5%, 8% above the current share price, and it would be a new all-time high to get above that break even. They did sell out of a long position that they had in those August options. They were selling the August 240 calls, so they rolled them down $10 and buying the 230 calls. They were also in there rolling down calls in MasterCard, so I think this is somebody playing the fintech space in that August cycle as we get that. We got retail sales later this week. We'll see what type of volumes we get there. But their business has been improving, but maybe some profit taking here. But somebody looking to pick up this slide that we're seeing so far this month in Visa.
Okay, all right. Thank you, Tom. Good stuff, sir. Appreciate the movers here. Mr. White, we got to run. We got still more to talk about. And then we're going to shift gears over to commodities. Today, nothing's really working, apart from crude oil and a few others that fit into that inflation theme. We're talking ags and more when we come back 20 minutes until the bell rings, but bulls would rather it just go up now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Jenny Horn. Here's a few after-hours earnings to keep on your radar. Bumble is reporting after the closing bell, with analysts expecting losses of 4 cents a share on revenue of $164 million. Since going public in February, the stock has fallen over 35% and hit new 52-week lows Monday. Online dating competitor Match reported a strong earnings beat in its first quarter, but has since given up much of its post-earnings gains. Vroom is lower ahead of its first quarter earnings. Analysts are expecting a loss of roughly 63 cents a share on revenue of $518 million. Last week, analysts at Wedbush boosted their full-year earnings estimates for Vroom. Wedbush currently has an outperform rating on the stock with a $50 price target, which implies a 42% upside to the stock's current price. And PLBY has shed over 10% ahead of its first quarter report. The company returned to public markets in February for the first time since 2011 of its revenue from e-commerce sales and brand licensing. It now has over 1 million active digital customers with over 50 million social media fans. Last year, its sales improved by 89% year over year. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Welcome back to Market on Close. Today we've got crude oil working, and that's where the list stops. Dan Deming is joining us to talk some commodities in the action today, how they fit in. Dan, I'm sure we're going to branch out and talk a little bit about the day overall, because what a session it has been. But crude oil is staying strong. Is this a clear sign that we've got more room to run? If the talk of the town is inflation, everybody's got cars they got to fill up now?
Well, for the short term, it appears that there has been a bit of a panic in the East Coast for trying to get through the gas lines there. I think, Oliver, yes, I still think even without the pipeline issue that some of the country's dealing with right now, that the demand, I think, is going to continue to increase over the coming months. The expectations are that that's going to be the case. And, and certainly when you look at the production numbers, they're just well below last year. You still have some you have rigs coming online, but I think there's some supply chain disruptions here that will probably persist for some time. And I think that bodes for the price increase when you look at WTI and particularly RBOB, where you're seeing RBOB outpacing WTI year to date.
So, Dan, with crude now trying to get through that level, trying to get to new highs, we also have that story, of course, about the pipeline hack and some of the supply chain going offline there, too. It's just every sector now dealing with this. If we do start moving through previous highs for crude oil, does that change the kind of stickiness of the inflation discussion?
Yeah, very well could, Oliver. Yeah, because we keep pushing up here, unable to quite take out those highs. Now, even today, we got up into the 66 handle briefly. Now we've fallen back into the 65.75, I believe. But you continue seeing it knocking on that ceiling. And if we do all of a sudden see a breakthrough there, along with several of these other commodities that are just coming off of multi-year highs, and in the case, of soybeans, there's another one that's green today, Oliver. Soybeans are up and really basically at I believe the highest level in 2012 possibly, so almost 9 years, I think. So there's one that continues to find strength even with the selling pressure as we're seeing some of the ags come off today.
Dan, what to you looks like a good trade in this market? I mean, we've got commodities that have been going vertical now, somewhat parabolic, a lot of them, with the exception of crude, which is trying to break out at that high. But soybeans, I mean, lumber, we saw that go parabolic, and now it's had a couple bad days. But the stock market now for the NASDAQ is really beat up and kind of getting closer towards oversold territory. Not quite there, but getting there. I mean, is this a buy the dip environment? Is it a sell the drop even more than it's already dropped? What to you looks compelling across this action?
Yeah, Oliver, I think it's going to be a little dicey here, I think, for the short term, because there certainly seems to be other things participating in this kind of shifting and dynamics. And the tech situation continues to put pressure on the overall market. The market was trying to not react too significantly to some of the tech weakness that we experienced in certain areas the last couple of months. But ultimately, the weight, I think, has just kind of been a little bit too much for the overall market to support. Couple that with just the dynamics. And this report this morning, again, just continues to increase those drum beats for the shift in the Fed policy. We'll have to see what tomorrow holds from the PPI data as well as retail sales. But yeah, this was quite a significant report, and just feeds into that idea. And it was weird. The market was kind of stunned. You even saw rates actually go lower slightly until they really started to run here later in the session. So I think when you're looking around, Oliver, I think if you continue to see these dynamics, when you look at relative strength, there's no question there's still relative strength in the energy sector. And I think that's one way you could possibly play this moving forward as a contrarian type of play. Because you continue to see those ETFs that hold those names within the energy sector performing very well, and particularly performing well today.
Since we're talking commodities here, Dan, to connect with another conversation, we had Sam Stovall on the show yesterday from CFRA, and the chief strategist there making the case for why consumer discretionary stocks are the most at risk right now, and they downgraded the group today. They're the worst performer, down 3% right now, consumer discretionary. Is there kind of a proxy way to play some of these inflationary moves by actually thinking about shorting restaurant companies, food stocks, anybody that's going to have to deal with a higher input price?
Well, yeah, there are ways, Oliver. Certainly, you could look at the options market's one way to do it. If you wanted to, again, define your risk, but still have the opportunity to participate to the downside by, buying put spreads on some of these names that you might think will realize further weakness. There's different ways to play it, obviously. You can do this call selling as well, or selling call spreads to define your risk to the upside. So that's one area where you could look to potentially play this market, from an option standpoint. As far as the underlyings, really, it's going to be more about, as you pointed out, I think it's going to be more of a sector type of scenario. So I think that you got to define those sectors that are at risk, and then decide how you might want to play those sectors. If there's individual names that you feel that are in some peril or in jeopardy right now, then you can certainly look at possibly playing those outright. Or I always like to look at a broader type of swath when I evaluate the market, and therefore we evaluate a lot of these ETFs, and that's where we look for relative strength. And we're seeing it in the energy sector, but there's no question when you look at the semiconductors and you look at the consumer discretionaries, both those all those ETFs right now are under some pressure.
Okay, Dan, thanks for the walkthrough here as we continue to see commodities on the move. Some of these slowing down a little bit, but some of the big ones definitely not. Crude up, and some of those agricultural commodities still pushing higher. Thanks, Dan, for the breakdown here. Can't forget, about the futures. We're going to, though, take a short break from some of the intraday market action. Even with the violence over the last couple sessions, there's still new companies coming to market. We'll talk with the latest IPO in the e-commerce space, Global E. The co-founder joins us here to take us into the bell. Right now, the NASDAQ is at the lows of the day, down 2.6% for futures. Cannot find a bid. Has been trying to find buyers since 11 a.m., but every push gets cut a little bit shorter. And now it looks like we might be breaking two new lows of the day. We're already there for the Russell 2000, down a whopping 3.3%. Even energy has turned red as the one outlier in this down market breaks with 8 minutes left.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
What do you look for when you trade?
I want free access to research,
Yep, TD Ameritrade's got that.
free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
U.S. stocks just made new lows of the day, but a little volatility hasn't stopped Global E to join the public markets today after the IPO. Let's bring in the co-founder. Joining us, Amir Shlaet is the CEO and co-founder at Global E. Amir, thank you for being here this afternoon. Congrats on the IPO. Introduce yourself to our viewers first, because we've been talking about e-commerce nonstop the past year. Where does Global E fit in?
First of all, thank you for having me. It's a very special day for Global E, obviously. And very quickly, what we do at Global E is we work with online retailers and brands, and we provide them a full end-to-end service for their international kind of cross-border direct-to-customer sales by providing a full suite of services that really kind of localizes and makes the shopper experience seamless, regardless of where they're shopping from in the world.
Now, is this, as a consumer, to help me find where I want to shop? Does it help a business owner build their shop online? How does it fit in between both the customer and the business owner?
We're kind of B2B2C. So we work with the merchants. The merchants are our kind of direct clients. And what we do is we kind of plug our technology into their site and provide them automatically with a very rich and deep layer of localization that then helps all their international traffic to convert much, much better. We're talking in kind of 60% upwards in international conversion rates. So kind of picking a lot of money off the floor by providing a much, much better and more simple and intuitive experience for their shoppers from abroad by giving them the ability to shop in local currency, paying with the local payment methods, getting great shipping offering, a landed cost guarantee, including duties and taxes, localized returns, and so on and so forth.
Right now, where do you plan to expand the most? One of the things I do notice from looking at your company is there's obviously in the name, global. You've got different hubs for people all across the world. Where is the growth opportunity right now?
So you're right. We are global already by nature, but I think there's growth opportunities for us both in the geographies where we're already fully established in, which is currently Europe, kind of UK, Northern Europe, and North America. And we have a ton of runway ahead of us in these markets already. Plus, we are already looking and making our first steps into the Asia Pacific region. So this is going to be kind of the next horizon for us, if you will.
I see big revenue growth on the top line, double from a year ago, from what I see, roughly about double. In terms of profitability, are you making money on the business right now?
Yes, actually, we've been making money for more than a year now. We're cash positive. We're generating money, and but so the reasoning for the IPO right now was actually to further step on it in terms of business development opportunities, potential acquisitions of capabilities to broaden the offering even further. But yes, we already broke even a while back.
Then going forward, are there partnerships? Or is it competition? Do you see other smaller e-commerce players that fit in within your goals? Or is this going to be about spending and using that profitability, that cash flow to market yourself to consumers in new areas?
So both. We're going to continue spending money on expanding our reach within the markets that we're active in, and new markets, but also, as you mentioned, adding new capabilities through different players in the e-commerce field that can further add value to our offering. And to that, we already have great partnerships. We have many dozens of partners that we work with on various levels because we just add more pie for everyone in our ecosystem. We have very strong partnerships, strategic partnerships with the likes of DHL, of Facebook, of Shopify, and we definitely plan to expand these in the future.
Okay. This sounds exciting, and we will continue the conversation. Amir, thank you for being here this afternoon.
Thank you for having me.
Thank you, and congratulations. Amir Schlahet is the CEO and co-founder at Global E, ticker GLBE. 90 seconds, and then this market's done for the day. It has been a rough one. We're at the very lows of the session as we speak. We'll give you a minute to close out the trades. We'll come back here and walk you through what happened.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Well, I say no to kale. Yeah, they say if you blanch it, it's better, but that seems like a lot of work.
Now offering 0 commissions on online trades. We charge you less, so you have more to invest.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Market on Close. There it is. Red everywhere today. Pretty rough session. Started off with inflation and then everything else just kind of followed to the downside. NASDAQ ending down, what do we at? 350 points. Dow, 682. 2% down for the Dow. That's been the most resilient of the indexes. S&P 500, which has also been stable and firm, rolls over. Russell 2000 and the NASDAQ now are locked together. How about that? Remember when it was one or the other? The either or market? If the NASDAQ was down, small caps were up? Not anymore. That's not what's happening. What we're getting is a very broad defrothing of everything out there, from big tech to travel stocks, from Expedia to Square. Big declines anywhere from 5 to 6% for companies that had just been making highs coming into earnings and then have gotten blasted. Worst part about it, honestly, is that we ended at the very lows of the session. And even though the Treasury auction went smoothly, they were still selling in bonds. Bonds ended at the high of the day for yields, just about, not quite, but basically there. Let's talk some more stocks and about what we learned here today with Nicole Pedalides, host of Market Overtime. Getting ready in about 60 minutes time. All right, Nicole, so a little bit of a wake-up day today, for sure. Good day for shorts, bad day for longs.
And that's what we're seeing, too, as we start to talk to folks. I mean, you're starting to see a lot more short interest, and that has been picking up. And that in itself is showing you the trend that people are thinking about. Bill Bailey, who was on with us of NASDAQ IR Intelligence earlier today, was talking about fund flows and institutional money and what they were buying. And it turned out that even some of the safe trades, they just weren't interested in a lot of everything, right? They were out of tech. And what they did see, as Bill Bailey was saying, was that short selling had really picked up. And that doesn't necessarily bode well for optimism, right? It shows that people are getting nervous. We had Liz Ann Saunders on of Charles Schwab earlier today, and she talked about three sectors. Financials, healthcare, and energy obviously being the outperforms. And those were the sectors that were doing well today in the early going. But as you could see, you noted, we finished at the end of the day at the lowest point. This is the worst week in 6 months for stocks as we look at what's going on here. And we saw home builders, right? We look at the prices of lumber and what's been going on there. We're seeing home builders. Lennar, I just checked, is down 7%. So names like Lennar and Pulte Home and D.R. Horton are all under pressure despite what has still been a great housing market. I know that we've had some issues with supply, and so it's been pulling back a little bit in some parts, in some cases. But the big picture is you would think it'd be great, but no, it's not. And so you are seeing the home builders under pressure. Another group that came under pressure are the semis. Yep. Names like AMAT and Western Dig and Lam are all also to the downside. And the last thing I'll leave you with when I was talking to Bill was the technicals. So in addition to the concerns that people are having about rising inflation or just where are we in this market, was that the NASDAQ was closer to correction territory after breaking down than it is clearly to all-time highs. So that's what we're looking at. And we saw at least a 5% sell-off from Friday to yesterday at one point. So not surprised to see it, I guess, going and retesting those areas.
You know, the technical breakdown, I'm glad you mentioned that. We're going to talk some more about that with our guys here throughout the day and this afternoon. I also really like the point that you bring up on the home builders. A perfect example of a group that seemed to have everything going for them and so resilient throughout the different tweaks and nuances of every different market regime the past 8 months. Home builders found a way to work, right? When the market pulled back in February, home builders were quick to snap back. Then when we had a little volatility earlier on, in the year, in April, when the market started first kind of getting hit, home builders were steady. NASDAQ went flat, home builders made highs, so it's just a group that has been infallible in many ways with the extreme amount of demand that's come in. And I do find some analogs there between the home builders and the chip makers because they both reflect this economic recovery and the demand for their products, but now the supply chain issues maybe are starting to weigh a little bit. If they're worried about chips and their inability to make what they need to meet demand, then maybe those valuations come under pressure. Maybe that's starting to find its way into the home builders, or maybe it's just rates finally kind of eating away at maybe the potential for all the mortgage apps. I don't really know the story.
Yeah, and market breadth is terrible. And it's hard to really pinpoint what the story is until we're sure and certain that it happens over and over and over again. You make a great point about the chips. When you're building a home, you know how many chips go into these homes? They're so technologically advanced at this point. You need all those chips. We've talked to so many companies talking about rising costs for steel or trucking or freight or all these costs that they're facing. So it is a big deal here going forward, and we'll see. And, we'll be getting retail sales. We'll be getting some more data. But, so far payrolls were not that great, right? We got last week's data. We'll be getting some more data coming in. It doesn't feel so wonderful, but where's the buy the dip mentality? Let's see if they step in tomorrow.
Yeah, not there today as we end at the lows. Just no buying appetite. Only energy, barely 6 basis points made it by, scraped by on the day today with those stocks higher. So, all right, not a pretty picture. Still 2 days left, as you mentioned. Some economic data, PPI tomorrow. So we'll see how that shows up for the inflation side as well. But other than that, jobless and consumer sentiment, I think we are sort of adrift now, lost at sea, if no one starts buying these dips. Thanks for the update, Nicole, on the movers. Let's bring our panelists. Scott Connor is joining, Director of Trader Education. And we've got Stephanie Lewicki, Senior Manager of Trader Education at TD Ameritrade. Guys, good afternoon. So, Scott, one of the first things that pops out to me is the VIX curve inverted today. If we look at the VX futures and you go over on your Thinkorswim platform and hit the panel to look at the futures curve, what you're going to get is a little bit of flip-flop. So what does that mean to you, Scott?
Yeah, absolutely. And we saw the short-term VIX almost catch up with the long-term VIX. Looks like that gap is narrowed very close. Now, we only see that when we really start to get sort of extreme levels of uncertainty and fear in the marketplace. And I think that's what was reflected here. But I thought it was kind of strange, Oliver, that this morning, when those numbers first came out, and as hot or warm or whatever you want to argue they were, they caught us by surprise, right? So no one really saw those numbers coming. But the markets didn't initially react that much. It took a minute, and there was sort of a delayed effect. But boy, I tell you, the markets really started marching lower and never looked back. And like you mentioned, went into the close. And I think that's what's a little concerning is going in tomorrow's PPI number, because obviously these numbers we saw in the CPI are things we haven't seen for more than a decade. Well, the question is, for everyone who's watching right now, we know that one data point doesn't make, Oliver, a trend, but data points that do reverse start every trend, right? So again, the question's still out there, but I think PPI takes on a little more significance tomorrow, because if we don't see, some sort of improvement with PPI, this movement or momentum to the downside could continue, because Oliver, right now, from the highs last Friday, we've got a 6% move to the low, to the downside for the Russell and NASDAQ, and about a 4% for the Dow Jones and Russell. 6%, that's getting pretty close to the 10% correction level. So I think that's why we're watching so closely, Oliver.
I like the point there, too, about kind of some of the technical areas, those levels, vol getting bid up. That really is the difference today versus other days where we've had such NASDAQ-specific weakness, Steph, right, where we've talked about that either-or market, the two-faced market, bifurcated market, a lot of different names for it, where when one thing was down, you could be on the other side. People have barbelled. Okay, I'm down in my tech, but I'm up in my recovery. I'm down in my cyclicals, but I'm up in my growth, and we went back and forth. That didn't happen. Something happened here today that really snapped everything.
Yeah, I definitely think there's some warning signs in the market now. You know, we were sitting at a comfortable level in VIX for quite some time, and this spiking up to 28, above 28 at one point today. I think that's really a sign of caution. You know, if we get up to 30, I think that's really time to be worried. But yes, this sell-off, it continues, and like you said, it's broad-based. It's across the board, from the Russell to the Nasdaq. You already said, if you look at the stay-at-home trades to the reopen trades, all getting just killed this week as well. I think the one interesting thing is we saw gold get pushed down today too, and you would think gold would have rallied on this news, this inflation worry, but I think market expectations are becoming distorted, and there's too much hype around numbers that there's little room for logic in some of these moves. So that's what makes it even harder. If we're seeing this inflation, you're not seeing it in gold. Also, you did see the dollar pop today. The dollar has been trending lower, so you got maybe a little flight to safety in the dollar possibly. You got yields popping back up. You know, that 1.7, I think, was the high yield back in April, sitting at 1.695. Bitcoin even broke down today. Bitcoin, for the most part, I think was holding steady, and today it's almost down 5%. So where the money's going, we have some money sitting on the cash, and that CPI number, what Scott said, at one data point doesn't make a trend, but it is certainly very concerning. You're now seeing, if you go out to Fed funds futures, you're now seeing a rate hike priced in at 100% out in December of 2022. Prior to the number this morning, it was at 88%. So now we'll pay close attention to what that rate hike, the probability start to change at. But again, heard from Fed today, Clarita, that hey, we don't have to worry about inflation. It's transitory. We keep hearing the same message, and I think we just have to stay on our toes and just see if this is going to be short term, temporary, or if this is going to be long term.
That's where it seems like over the kind of long stretch, Scott, maybe we'll look back at this as a buying opportunity for some of the more industrially themed recovery companies and those that'll be involved in future infrastructure plans, for example. To me, at least personally, the buy the dip case still looks pretty weak on new downtrends that are forming in tech. That's my own personal view. But for some of the more economically sensitive companies that are getting hit right now, that are getting wrapped up in this, one of the things that I think is very interesting is trying to think about how to define that transitory, right? Where, okay, maybe this is only a period that will be limited for an inflationary impulse, but it's not going to be that short, right? I mean, the reason we're getting this is because things are coming back online and there's a lot of demand and a lot of money out there. And the rest of the world actually has been offline up until a couple weeks ago. So these are U.S. data we're seeing, but everybody else is just getting the party started. So even if it is transitory, it's not transitory like this is the only print, right? So maybe some of these will be a buying opportunity long term, but like short term, why try and fight this headwind?
Right. Short term, absolutely. And I love Stephanie's point there about the Fed and the Fed funds futures, sort of indicating that we're expecting sooner than later interest rate hikes, because it's kind of interesting. We haven't looked at Fed funds in quite a while, but suddenly it's now in the circle of indicators that we're watching. And what does that mean? Well, that means that I think there may be pressure now on the Fed to move up their sort of their mantra of no rate changes until 2023. That's slightly changing. And when that mentality starts to change and people start to challenge, the Fed's outlook, and we saw the rates today go almost back to 1.7 on the 10-year, at some point, is the Fed going to capitulate or at least start to, entertain the idea of maybe they are going to need to raise rates? And again, they need more data points than just this one. But I think that, again, tomorrow, the PPI, when that comes out, if that shocks like the CPI did, remember, whatever's in the pipeline of the PPI eventually trickles down to the CPI, right? So I think that's why we're going to have to watch that number so carefully. Now, if that comes in tame and okay, that might be enough for the market to say, hey, 6% correction in the NASDAQ, well, that's good enough for right now. But if that PPI number comes in and surprises like the one today, I don't know, Arla. It's hard to argue that we don't see some sort of 10% correction. And then maybe, like you said, that's the time to at least start thinking about, for someone who wants to put money into the market or gain exposure in the market, start looking there. Because absolutely, picking the absolute bottom is very, very difficult, almost impossible. But everyone's looking for opportunities to get back into the market. And 10% is oftentimes a sort of a benchmark that people will look to sort of begin that process. So, again, a lot rides on tomorrow's number, Oliver.
Yeah. So is CPI the big one? PPI is going to add on to that. I'm with you there where, jobless claims and to think about how folks are taking those jobs. I'm not sure how much relief it provides, though, if the wages are going to go up. And now there's kind of stickiness to that's a good thing, right? There's this big difference between the economy and the market right now where some of the good things that we're seeing are causing blowback here. And I think that's the big question for traders and investors in the stock market is, does transitory inflation mean transitory risk in markets? One of the things that we also pointed out was the amount of call buying that was happening all year, basically, the past year, Steph, until we saw some of these trades start to roll over. So when you've got Tesla still getting beat up, ARK in a downtrend, the stuff that you could rely on buying the dip is just not working. So how important are watching those technical kind of indicators to see where trend is now, right? Because trend goes both ways. Trend's your friend to the upside, trend's your friend to the downside if you're short.
Well, technicals, you have Apple and Amazon below their 200-day moving averages right now, and it is incredibly important to watch all these tech stocks because these are the big ballers, the one that have the big footprint in the NASDAQ, in the S&P 500. So when we talk Apple so much, Apple down 6% on the week, down 2.5% today. Microsoft down 5% on the week. You have Amazon down 4%, Alphabet down 6% on the week. These are the big ones that make up the majority of these indices, and those indices are in so many different IRAs, 401k, mutual funds, ETFs, ARK. That's a big one that everybody's watching because, again, that's a very, there's a lot of stocks in there that are very popular among retail traders, and it did so well for so long, and now it's just getting hit. So when you're putting these names, you got to put those up on your watch list. And, sometimes these corrections we say are a bit healthy. We ran up so quickly from these pandemic lows, but it's still kind of, it's mind-boggling because of the earnings that we're getting out. The fundamentals seem to be there, what they're reporting. The fundamentals are there. And then just a week, 2 weeks after earnings, we're still in earnings season. We still have some big names to come out, but the names are just getting crushed. And so as we focus, we were so closely focused for so long on the weekly jobless claims number when we never paid a lot of attention to it prior to a year ago. We're going to start to really pay attention to any kind of data point that has inflation in it, like Scott said, PPI tomorrow, or, the commodity prices that we have all been watching and talking about so closely, lumber and the grains and copper and iron ore and steel and all of them just running wild. And now we're seeing that reflected in some of the data. So it puts the Fed, the Fed's been in a tricky spot, but we got to see, this is getting a little, maybe a little worrisome. It's okay, I think, to sit out, watch till maybe the dust settles to see what happens.
Okay. Dust didn't seem like it was settling at the end of the day. It seemed like we were finding new sellers, amazingly, into the very last moments here. And bonds then that ticked down at the low of the day. Right now we're at the high for yield. Just doesn't matter how much we're selling stocks. Nobody wanted to buy bonds. Problem with that means they didn't want to buy gold either. And as we talked about for Bitcoin too, Bitcoin down as well. So there's just there hasn't really been anywhere to hide apart from some of the commodity-centric inflationary assets. Scott, as a sort of a trading example, leave us maybe on this, is if I'm of the view that, I don't like this inflation print, I think stocks have more to go to the downside, what kind of trades work in an environment where VIX is rising, but I still think there's more, to go to the downside here? What kind of trade makes sense, and what kind of strategy do we think about if we do want to short even as VIX is climbing?
Sure, great question. Typically when you see implied volatility rise, or the VIX, like we said today, I think where did it close? About 28, somewhere around that range.
Yeah.
That's definitely on the high end of where we've been. So when that happens, what happens? Well, higher volatilities raise the value or the prices of all the calls and puts, both, right? Particularly the puts. So if you're thinking about a strategy that uses options that might give you a little protection to the downside for stocks that you own, you could look at the covered call strategy. So for each 100 shares, you sell one out of the money call and try to collect some premium or credit received from those short calls. Now, if the stock rallies, that puts a cap on the maximum gains you will receive from the stock from that point on. But if your outlook is that there still could be more to come, that's one way. The other one is that, let's say we do get down 10% and you're thinking, okay, I think that's enough. I'd like to maybe redeploy some of my cash back into the market. Well, then you can, again, puts are pumped up as well. You can go maybe a little bit lower than the current stock price and sell an out of the money put, collect a good sized premium for that, a relatively large premium, if you will. And then take on the responsibility or the obligation of buying the stock if it continues to go down at that lower price, right? Now, if the stock doesn't go down, the market does start to rally back up or just consolidate, then you still collect the credit or the premium from that out of the money put that was sold. So these are approaches that oftentimes option traders consider when volatility levels are high like this.
Okay. Thanks, Scott. Thanks, Steph. Good stuff, guys. And definitely a very interesting way to end this Wednesday. We still got some more to talk about, though. We're going to take a break from some of this intraday analysis. So we're going to look at stocks, overlook stocks coming up next. We're going to talk 3 specific companies that had some interesting moves in today's session. We'll try and find a few winners in the group. We had a few stocks that were doing pretty well here. Insight was up on the day. And we're also going to look at an energy company in addition to one stock that really started moving. Big winner in liquidity services.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Welcome back to Market on Close. It's time for some overlooked stocks. Let's find some winners in today's session and break up these doldrums with none other than George Tillis. Who else to make us feel good about some trades moving to the upside, George? Hey, amazingly, GT, a stock called Liquidity Services is rallying at a moment where everybody's questioning liquidity, it seems. But, of course, this is a very different company. It's an e-commerce trade. So what's going on?
You know, it's an interesting company. We've actually talked about this about 6 months or so ago, but I'm going to call this sort of the e-commerce company that is akin to eBay for inventory. It comes down to commercial or industrial and business inventory. So you can kind of call it the eBay for business surplus inventory, things like merchandise returns, like a major inventory at Costco, for instance. This is basically an online auction place, but it's interesting enough. It's more of a counter-cyclical business, but I think right now it's gaining a lot of traction, both from a financial standpoint, but also because of its core business, which I think is growing based upon a lot of small businesses and medium-sized businesses and even governments, OJ, that are looking to raise money. They're selling surplus inventory, things like autos, equipment, and these are places, or liquidity services, a place where they can do that as well. So they have a retail supply chain. They also have capital assets group, government surplus, as well as small business surplus. So it's basically, like I said, an eBay of inventory, but of small business inventory and equipment. But the stock, I mean, it's really just doing extremely well. I know COVID has created a lot of opportunities. It's also created a lot of distress in many areas, but this stock is up over 460% over the last year. And I think it's based upon its core business and the market that it serves.
Okay. So we talked earlier with the e-commerce company Globe, GLBE, and the new IPO today, Global E Online, and basically a huge market share that they want to continue to take. And even though some of these trades have unwound, liquidity services is not, George. Does that mean it's a matter of time? I mean, we saw Etsy blow up on earnings. We're looking at Amazon weakening, pulling back. How come they're able to sidestep all of the e-commerce drag?
I think it's their business. I think the total addressable market has been underserved. I think the reason being is you have to think about the size of equipment when you're dealing with it. And when you talk about Etsy, you're talking about, just giving an example, like, facial masks. These are small items. They're cheap to ship around. Liquidity services deals in bigger items. And these are, again, a little bit more challenging as a business to gain scalability and gross margins. But this company has done that. And I think this is a marketplace that is becoming established as we speak. And the financials seem to back it as well. So I went back and looked. They reported earnings, I believe, on the 7th, and they showed 16% year-over-year sales growth. The previous quarter, they actually showed a decline of about 5% in sales growth. But their sales quarter-over-quarter as well as year-over-year are improving. And I don't know if you can pull up a price chart of the stock over the last year, but you'll notice the stock seems to gap a little bit higher every single earnings conference call, at least the last two. And I think this speaks to not just more of an e-commerce stay-at-home trade. This is really about business and of course, commercial businesses, restaurants, for instance, that are selling and buying equipment. These are the types of products that are sold amongst many different kinds of products that are sold through their platform. So their gross merchandise volume is increasing as it's gaining exposure. It's not dealing with the end consumer like maybe an Amazon, for instance, or an Etsy is, which again differentiates it from other e-commerce platforms. But at the same time, I think their services are increasing as well. So what that means is that they're bolting on additional revenue streams on top of existing customers that are using their system. Things like risk management, fulfillment, transportation, and warehousing. So if you add all these additional services and you're growing from a GMV standpoint, gross merchandise volume, your top line sales as a company are growing, and now the EBITDA margins are expanding, you get a stock that continues higher despite this market condition, which is really poor right now.
Okay. And George, let's go over to another one, CVR Energy, ticker CVI. Had a nice move today, 8.5%. Energy stocks did rally, but it was still a little bit of an up and down day for the group, and they barely crossed positive, and even this stock shaved off about $1.50, about $1 from its highs.
Yeah, I mean, the energy space overall held up better than, I'd say, other sectors, OJ, but CVR is basically a refining company for petroleum products, distillates like diesel fuel, gasoline, jet fuel. But they also have pipeline and storage, again, which is a more consistent business. I think the refining business is, again, very volatile. So you like to see, of course, companies that are diversified. They serve markets, which include, of course, the end retail markets, like gas stations, but they also serve commercial businesses like railroads and farm cooperatives. So they've got a well-diversified business. It's actually a smaller player as a refiner overall, but they also have a nitrogen business. And so fertilizer, I think, is one of the catalysts for this business, which, again, helps insulate it from refining spreads or crack spreads, as they're known, the catalytic crack spreads, which are, again, refining margins, which I did look at them prior to the segment here, OJ, have been rising, ironically, since November when COVID vaccine news came out. But there is some news today on the company. They're actually now, in lieu of expanding some petroleum refining capacity in Kansas, they're actually converting one of the refiners to biofuel. So I think what they're doing is of course, They're generating some additional tax credits with this. I think biofuels still have a place as an alternative energy versus going pure electric. I think biofuels are still a bridge fuel. And I think they see plentiful tax credits to capitalize on. So overall, I think it's a stable business. It's got, like I said, a well-diversified business, including fertilizer. But you're going to see pockets of struggles in the refining space, especially around this market environment. But one of the things I did notice about the company, and this is very unusual, is I do think they're getting a tax credit. I didn't get to read all the information on it from this conversion of a refining plant in Kansas, because they're paying out a special dividend, and the dividend yield on the company, OJ, looking at the trailing, is about 12%, and that's quite large relative to an earnings yield of negative 9% over the last year. So I think what's happening here is that they're generating cash to continue to service their dividend, but as long as their revenue can continue to expand, which last quarter their sales did increase 29%, and I think that has to do with the fertilizer business, they may be able to sustain that dividend, which is quite robust, at least on a trailing basis of 12%, and in a forward basis, it's about 8%.
Okay. So, all right, dividend paying energy stock at a time when we've got the administration talking about energy and needing to protect pipeline companies. I don't think anybody had that one in their bingo for the Biden administration's first 6 months. But okay, so energy companies with this specific event, pushing crude higher. That's helping, but also this whole reflation theme that is better for them than a lot of other companies out there. George, last one you've got on your list today, and I do like that because if we're thinking about ways to kind of hedge your overall equity exposure, inflationary, reflationary themes, energy stocks may be one way to do it. George, last one you've got, though, on your list is Insight healthcare stock. Many will know, but many will have bad memories from over the past year. It's continued to get hit on its therapeutics and clinical stage development that I guess have not been too exciting.
Yeah, so Insight's a biotech company, OJ. Yeah, you're right. And so I'll address the price performance. It's actually down 17% over the last year. And it's basically a company that has a leading drug called Jakafi, which is basically a drug that they're partnering up with Novartis. This is the primary drug that a lot of analysts are really hoping for getting FDA approval. Today, they actually got the start, or they initiated the start of a phase 3 enrollment trial to deal with large cell lymphoma. So again, it's an oncology phase 3 trial that was started today. They do have large partnership with Novartis on this particular drug. But outside that, the company does have some core products that are already in distribution. They've got partnerships with Eli Lilly and arthritis, also in dermatology and other oncology areas of healthcare needs. So the company itself, like I said, is struggling over the last year. I think there's been so much focus on COVID versus a lot of the R&D out there, especially dealing with things like cancer and of course a large cell lymphoma, which is again a terrible and fatal disease. But looking at its top line sales, it's respectable year over year, about 6%. It doesn't have any debt, plenty of free cash flow. But again, I think the market and a lot of the analysts, which are kind of all over the map on the stock, are really waiting to see if they're going to get some endpoint results that are very positive in the first enrollment of their patients in their phase 3 trial for dealing with lymphoma. So we'll have to see on this one. But overall, it seems to be trading alongside Novartis, which again, it's got a licensing agreement and its main partner in this particular area.
Okay, so right now, this has not really been the biggest group, ironically enough, that we've got biotech saving the world. Unless you've been in some of the specific winners like Moderna. I mean, even Pfizer hasn't been a huge rewarding stock over the past year. So maybe there is some potential, thematic switch here as investors maybe look for something outside of what's worked, right? And think about these companies able to sell through to medical centers and hospitals again on a more traditional, regular basis. So perhaps a little bit of a comeback story, George, for some of these healthcare stocks?
Yeah, I think so. I think it's important to recognize that there's been so much, like I said, emphasis placed on COVID-19, that there's so many, potential curative medicines out there that are in development. So, I can't say what to do, but, every once in a while I'll look at the FDA dates when things are expected to get approval or disapproval for many types of drugs. So that might be one way to kind of look at Insight's potential and look at some end stage result deadlines. But you do want to see partnerships and licensing agreements, but you also want to see drugs that are already in the pipeline, not in the pipeline, but are already developed for sale. And this has got both. So it's got an R&D aspect, but it also, again, has recurring and stable revenues for drugs that are already on the marketplace treating other diseases. And that gives you an idea that's not a pure play, unproven, and of course, unrevenue generating or non-revenue generating drug that's speculative, and it's a sort of a one-hit wonder. This is not the case for Insight, but again, there's a lot riding on this particular drug, which has been in many stage trials. Now it's its third stage trial for many years.
Okay. George, thanks for the details. A nice little diversion here from thinking about the carnage from today. Some winners and up movers. George Tillis, our contributor from Salt Lake, and the overlooked stocks in the session. Let's talk some more earnings. When we come back, the Chartmaster has his eyes on three very important companies reporting tomorrow. We'll look at the technicals for Disney, DoorDash, and Airbnb.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
It's time for the Chartmaster. Ben Watson has his eyes on the future as we continue to spin into a more positive tone here after a bit of a bloodbath today. Ben, let's talk Airbnb. And we've got Disney in the list too. We've got earnings coming up. Only a couple now for Airbnb since going public. This will be our second one. But it's happening at significantly lower levels than the first. We're at $142. Last time it was closer to $200.
It was, and this has been a stock that's been in an overall sideways trend really since the IPO. It's been in an intermediate term downtrend, and yesterday was a bright spot of hope, right? We had this little gap down rally yesterday, and today now we get this gap down into maybe an inverted hammer at this 139 support level. So the key is holding this support rather than breaking lower. If it breaks lower, there's really not a lot between here and that 125 first little bounce to the downside after it came out to the market. And so I think this is where this level becomes critical, because we saw this pull back and move from here yesterday. There were buying pressures present at this support level. So we don't have a lot of sentiment information just because of the length of time that this has been on the market. But the long-term sentiment's deep down and oversold. not surprising here given the trend that's been going on for the last little while. But intermediate term sentiment is rising, still in oversold. So maybe that is the bright spot along with this level of support in the inverted hammer. Possibility of a reversal from here and a bounce if this earnings number comes out, which is their second earnings, comes out good. We might see this move back up to the 147 mark.
So not a lot of room to work with here, obviously. A shortened sample size, maybe some support, maybe a candle that suggests reversal. Well, at least today down 1.5%, 1.75%, not the worst mover out there. IPOs have been really, really struggling. The IPO ETF was down 3.5%. So Airbnb perhaps showing some outperformance relative to the newer issues of this market. So maybe that's one thing here. And, if they talk about a guidance that shows recovery, maybe there's some hope here that can go with that technical take. What about for DoorDash, Ben? Also, recent IPO, even worse chart.
Yeah, it is. I mean, this has been in more of an intermediate to long-term downtrend, just abjectly, not really even sideways. We had that same kind of gap down rally yesterday, but it was below the 126 support. So it already broke that support level. As a matter of fact, it's been teasing below that level over the last couple of days. We get the gap down sell-off today, which takes it even lower ahead of the earnings announcement. Now, to be fair, there's nothing from a previous support level here below that 126. So we're simply looking at projected or symmetrical moves to the downside. 126 is really kind of that next little level here. The 112 mark is the symmetrical projection from the last little move from support to support previously. And then below that, that next symmetrical move takes it down to 108. That's all theoretical because it's never been there before. But that's where we could find some stopping points. If this breaks back up above 126, you got to look at that 130 level as the next resistance overhead. But combined sentiment still falling in oversold with some room to move to the downside.
Okay. All right. So it's not looking good is the bottom line. Already slipping.
Right.
The small degree of support maybe it could have had is kind of broken. And you just hope that for bulls, there's something decent in this earnings. Obviously it's going to be tricky from a guidance standpoint, given all of these specific quarantine demand for delivery. And then they couldn't, turn that profitability in that period. Going to be a very interesting message, especially when so many people are fighting for improved wages and work conditions at some of these delivery and stocks like this. So last one, Ben, for Disney. Okay, this one we do have a lot of time to see over the past couple of years. So we get a lot more chart to work with here.
We really do. I mean, this has been a long-term uptrend. It's been, to be fair, in an intermediate-term downtrend where it's been making lower lows. And even though I've got these lines drawn in here as horizontal levels of support, you could connect the dots amongst those lows and draw that to the downside. So now, ahead of the earnings announcement, we get the break below today, the 181 support level, which really hasn't closed below that level really since that January, February timeframe. And so that really becomes kind of a challenge because breaking below that 181 then potentially leads even further down to that 165 support. There's not a lot in between 181 and that 165. Maybe a couple of little levels right in the middle there, but it could move quickly. And Disney can move and has moved quickly on recent earnings announcement. But you've got some positive things coming, right? The reopening of parks and resorts that could add to the revenue number. So that's going to be something that investors are definitely going to be looking for. If it bounces and breaks back up through 181, then I think you got to see 187 as the next level of resistance. But you've got long-term sentiment falling below mid-range. However, intermediate-term sentiment kind of coiling up. Lower highs, higher lows ahead of the earnings. That could be the possibility of a little bit of a pop, but it's not hugely bullish at this point. So the fact that it's already broken the support going into the earnings announcement, that's a little bit worrisome for bulls. But if the numbers are good, again, remember that Disney can move big on earnings.
Yeah, okay. It certainly has over the last couple of years, thanks to the development of the streaming business as well. So now they got a little parks mixed into it. So 3 stocks to look for tomorrow on very clear messages on the reopening. Maybe Airbnb and Disney sounding more similar tone than DoorDash. Ben, thanks for the charts. We got to go. Speaking of earnings, we got to check in with Fubo TV. Big report this morning and a rally in the wake of the numbers, but it still doesn't do much to take back the losses from the last couple months. It's been a wild ride in stock, but the numbers sure are adding up on the bottom line right now.
Feel that? That's the beat of global markets. The rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Hello traders, I'm Rick Ducat checking in with today's market news. Traders are showing no love to Bumble despite an earnings beat. Shares of the online dating app are slightly down in the aftermarket as EPS came in at $1.69 a share versus a 2-cent loss year over year. Consensus estimates came in at -4 cents. Bumble boosted first quarter revenues to $170.7 million, more than twice as much as the $79.1 million from the same time last year, and above analyst expectations of $164.6 million. The change comes as paying users increased during the coronavirus pandemic, up 27% from the previous year. Sonos posted a record earnings beat, launching shares up more than 15% since the market closed. The company, which designs and manufactures sound systems and smart speakers, logged adjusted EPS of 31 cents per share versus -34 cents last year. Consensus estimates were for an adjusted loss of 22 cents. Revenue came in at $332.9 million, up from $175.1 million last year, and beating estimates of $251.5 million. CEO Patrick Spence said Sonos saw broad strength across its product lines, as sales were driven by repeat customers as well as consumers shifting toward higher-end products. While Sonos is feeling the effects of the global chip shortage, Spence said the company is managing by pursuing longer-term deals. And Vroom shares are up sharply after better than expected earnings. The company, which offers an e-commerce platform for buying and selling cars, reported adjusted EPS of -57 cents versus estimates of -63 cents. Diving into the numbers, Vroom's total gross profit nearly doubled versus the same period last year. E-commerce unit growth also was up 96% year over year. Looking ahead to next quarter, Vroom sees EPS of -58 cents to -51 cents versus consensus of -44 cents. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Remick.
Let's talk some more earnings. Fubo TV up almost 10% today, reversing a downtrend in the stock over the last couple months. Let's dive into the numbers with the CEO and co-founder, David Gandler, is back with us here on the program. David, thanks as always for talking with us. Let's jump straight into the numbers because you beat the big expectations that were already built in for top-line growth and the subscriber growth as well, where you went ahead of your own outlook in numbers. So what's the big drive over the last quarter? Is it more of the same? Is it cord cutting? Is it people finding out who you are? Where is that latest push coming from?
Yeah, I think it's all of the above. I think, as you know, we've been executing very well in the last 3 quarters. In fact, the first 3 quarters that we've been a publicly traded company on the NYSE. So, the macro trends are still in play. People are cutting the cord. Advertising revenue continues to shift, from traditional television to digital, and people are enjoying the product. And so, brand awareness continues to improve. I think that this is a trend that we'll likely experience going forward.
One of the big questions, of course, everyone's asking about every stock right now that did great last year is what's the post-quarantine growth? Obviously, from streaming, there's a lot of time for eyeballs that you got over the past year, but there's also a lot of dedication for sports where people are going to watch it no matter what the situation is. Do you think you'll have better growth still than competitors in the streaming space going forward?
Yeah, for sure. I think we also have to remember that there was a period before COVID that also existed, and people actually watched television and went outside. And the numbers that we're seeing are certainly in line with the trends prior to COVID. March 15th to April 15th, we're seeing really solid growth. The reason I mentioned that time period is that's when we started to see people go home, leave the office and move into this new sort of reality. And as we come out of it, I think you hit the nail on the head. People will continue to watch sports. They'll continue to make time for their favorite teams. And, we're seeing that at least in the early stages of the second quarter, but viewership hours, remain strong.
If there's anything here that analysts want more from, it's on the bottom line. Adjusted EBITDA loss of $46.5 million. They were looking for about 43, so they understand that right now the bottom line is negative. But what is the plan to turn that around, or what will help lift that bottom line? Do any of the prices change? Do any of the costs and expenses that you've laid out change over the coming months?
Yeah. Look, it's a good question. And, one of the things that's not in those numbers is the fact that, the numbers that were laid out were only video numbers, right? So we ended up spending about, almost roughly around $2 million on wagering, setting up the team. There were, fees associated with the acquisition. So, from our perspective, we were pretty much in line. Operating expenses grew 80%, of course, because we're a 6-year-old company, they're going to grow. But more importantly, revenue grew at 135% year over year. So our revenue is growing at a faster rate than our expenses, which obviously is always a good sign for profitability. Clearly, there's a path. Advertising revenue, again, is an area that drives profitability for Fubo. And, we started the year at $7.11 of advertising revenue per user in the first quarter, which was, roughly in line with fourth quarter. And as you know, advertising also a seasonal business, and we think that our first quarter number is a solid base for the rest of the year, and we look to double our advertising revenue for 2021. So we're super excited, phenomenal quarter, and setting ourselves up for a stellar 2021.
David, I don't generally expect CEOs to comment about market action. Obviously, you know that the stocks come under a great deal of pressure the last 4 or 5 months. Does that change any of your strategy in terms of how to generate cash or pressure for that bottom line, or possibly selling to a bigger company that might want your specific mousetrap for viewers through the sports side?
Well, I think you're right. We have a very unique company. The company is really developing a new category, which I like to call interactive television, with our approach to sports betting and video. But our balance sheet is quite strong with over $400 million of cash. We have enough capital to build a full service betting app and continue to grow our videos. So, it's our responsibility to review all types of deals. But I think we're actually well positioned to attract more customers in betting, as well as continue to take market share on the video side. So from our perspective, nothing changes really. And I think in terms of market action, I would just say that one thing, I think you've seen a rotation out of growth stocks. This is not anything specific to Fubo, into cyclicals with rising rates of inflation. So, what we've been doing is continuing to focus on our business. And, I think nothing has changed other than the price. So we actually feel much better about our business for 2021 than going in to 2021 at the end of 20. So, again, we feel really good.
Okay. David, thanks for the update. Appreciate it.
Thank you so much for having me.
Thank you. David Gandler is the co-founder and CEO at Fubo TV. We've got 1 minute left. Let's end on a quick cut the cord. Here's a chart of the NASDAQ versus the VIX in 2001. I pointed this chart out back in February because when the volatility index VIX broke its well-established floor back then, it signaled that fervor and call buying and speculation was fading from the market. The peak in the NASDAQ came shortly thereafter. The point of that chart was to think about similar dynamics today. In February, I said that when VIX breaks our floor of 20, it probably means that the speculative call buying is letting up, and that means that the froth in the market is about to come off. If you look at this chart, the same chart like this one today, it looks spookily similar. On the right side, you see there we broke down through 20 in VIX. Shortly thereafter, the NASDAQ starts to roll over. I'll make it very concise and very straightforward. I think that right now we have a very high probability the market has peaked for a sustainable period. We had incredible froth, only comparable to the .com in the NASDAQ, and tech names are now rolling over, and it looks like yields have nowhere to go but up from here until that correlation breaks. It's hard to be bullish on tech, and we know how important that is to the broader market, so buckle up. I think we are definitely in regime change here. Thanks for being with us here today. Market Overtime is up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device. Welcome to Market Overtime. I'm Nicole Petalides, live in New York City. Thanks for being with us. Stocks sell off as April's CPI data has investors worried about inflation.
We will break down what it means for your long-term portfolio. Here's a look at how the indices finished. The S&P 500 down 2.14%. The NASDAQ down 2.6%. The Dow Jones Industrial Average down nearly 2 full percentage points. And the Russell 2000, the biggest laggard on the day, down 3.25%. Taking a look here at some of the winners and losers in the markets, shares of Pfizer rose under 1%. The CDC panel has now recommended the COVID-19 vaccine for 12 to 15-year-olds. The expanded authorization comes ahead of summer, when many parents are looking to send their children to summer camp. More than 150 million U.S. adults have received at least one vaccine dose. Norton LifeLock jumps 7.2% after BofA Securities upgrades the stock from underperform to buy the price target of $30. The move comes after the company reported upbeat earnings and increased its buyback program. The analyst sees a potential renaissance for consumer security. Domino's Pizza hit a record high after Bill Ackman's Pershing Square closes at nearly 6% stake in that company. Stock finished off the highs, up about 0.75%. Ackman tells the Wall Street Journal he puts Domino's in the category of super durable growth companies and likes the chain's own delivery infrastructure that doesn't rely on outside delivery services. Now to the downside. Home builders sell off after hitting record highs on Monday. D.R. Horton was down 7.3% for the session, now down 11% for the past 2 days. Stock is trading at 3-week lows. Shares of American Airlines fell 3.8%. But in a bit of good news for the airline, it says it's seen flying at 85 to 90% of 2019 capacity by July. And one of its executives says some of its larger corporate customers have indicated they plan to resume travel in the third quarter. Finally, Tesla falls 4.4% to close below $600 a share. It is the first time closing below $600 since March 8th. Meanwhile, the National Highway Traffic Safety Agency says it's opened up a safety probe into a fatal crash in California on May 5th. The Dow sees its worst decline since January. The S&P 500 closes its lowest level since April 1st. Let's break down today's market sell-off. Joining me now, Kevin Hinks, co-host of Fast Market. Wow, what a day, right? Market breadth has just been pretty rough, and now you get these market numbers. The April CPI data was tough to stomach, right?
Yeah, these were big numbers, Nicole. And, the reaction was kind of muted to start the day. But here's what happened that gave this market no oxygen today, Nicole, and no chances of bouncing. The 10-year note consistently was under pressure the entire day, and therefore the 10-year yield closed at its high level of the day, 1.695%. So that gradual increase in yields as the day went on, Nicole, really put this market on its heels and never let it off. And now, Nicole, we go to bed tonight on eggshells as we wait for the PPI number to come out tomorrow morning at 7:30. And even so, the expectations for the month-over-month data is relatively muted at 0.3 and the ex-food and energy 0.4. The year-over-year numbers are still big, Nicole, 5.9% and 3.7%. in the ex-food and energy. So we're looking at overnight worrying about a PPI number that, remember, last month was a hot number at the producer level. So we're going to be nervous throughout the evening waiting for this number to come out. But this day was described as a day where the bond market, bonds and notes, and the 10-year yield never gave this market a chance to catch its footing on the lower levels. And Nicole, nothing was really safe today. If you look, gold was down. Normally a risk-off assets, and that was down on the day. Bitcoin was down on the day. Very few things were in the green today, Nicole, other than VIX and some of the risk-off assets. But this was a global sell-off across the board, Nicole. Everyone was involved in this one.
Yeah, it really was very evident, right? We saw big jumps here in prices year over year, but some could argue that 1 month doesn't make a trend, right? So now we'll have to wait and see, because we just got this jobs report on Friday and that wasn't any good either.
Right. What your viewers should understand, Nicole, is remember something. The year-over-year numbers are comparing right now to last April, when we were in the depths of the pandemic and the coronavirus. So the year-over-year numbers should be big numbers in terms of a recovery of the U.S. economy. The month-over-month numbers that jumped, those were a little concerning, and people may have been a little head faked by the big numbers in year over year. Those you can discount because of where we were a year ago and how bad things were. That being said, the month over month numbers, Jerome Powell can come out and say transitory and things like that, but the market isn't going to view it as transitory. They're going to trade on it. And so the market will soften as we consume and digest these slightly hotter than expected inflation numbers, Nicole.
Yeah, you mentioned the Treasury yield spiking and actually closing basically on the highs of the day, near 1.7%. And that's helpful to financials. But, even those couldn't hold on to the end. Tech stocks, everybody's watching that closely, that group closely. Apple, for example, closing below its 200-day moving average. First time in 13 months. And the NASDAQ is closer to correction territory than it is to new highs.
Yeah, this was a broad sell-off, Nicole. Like I said, no one was safe from this one. There was really nowhere to hide if you were long equities or Bitcoin or gold or anything like that. I mean, the only thing that was higher was because of that microeconomic story with crude oil was slightly higher. Besides that, Nicole, other than the U.S. dollar, which was sharply higher, that helped weigh on some of the commodities and the metals as well. But besides that, Nicole, not a lot of green on my screen. I don't know about yours. Not a lot of green over here.
Yeah. No, it's true. I mean, it was tough to find green. I mean, that being said, you said about the PPI. Right. We'll wait on that. We still have retail sales and some other things that we're watching for. I mean, the rest of the week, I guess we have to wait and see. Market breadth was terrible, and sometimes the day after this kind of day, they buy them back.
Hopefully, Nicole, if we think about it this way, if you're looking for something to hang on to tomorrow morning, you're hoping for some muted PPI numbers. And maybe last month's PPI and then this month's CPI were just a one-off or that transitory event that Jerome Powell's talking about. If we get muted PPI tomorrow, that may ease the fears of some investors. And then, remember, our Red Book data, that high frequency data that we get every Tuesday morning for retail, that's leading to a pretty strong retail sales number that we should get Friday morning. So the economy's is extremely healthy. I think we'll see that in the retail sales. What would help this market tomorrow is a muted or uneventful PPI number, Nicole.
All right, let's wait for that then. Kevin Hanks, thank you so much. Co-host Fast Market. Thanks, Kevin. Creating a balanced portfolio is one key to meeting your long-term financial goals. So how do you do that, particularly in this environment? Andrew Rosen's with us, President, Partner, Diversified Lifelong Advisors. So Andrew, tell us, what tips do you have for investors to create a balanced portfolio?
Yeah, thanks for having me on, Nicole. I would tell you the first thing I look at in creating a balanced portfolio is understanding the goals of your portfolio. You have to understand that all portfolios aren't created equal. And the goal of a portfolio for someone who maybe is looking to retire next year versus 10 years from now, they're not the same thing. They're not created equal. So you really have to look at it and decide, what is the purpose of my portfolio and my buckets of portfolios. And so when I look at creating a balanced portfolio, it starts and ends with the goals. And then there's many other tentacles that certainly go into it.
Yeah, and as you said, you have to define your objectives here and what your goals are. Are you 2 years away? Are you 22 years away from retirement, right? And risk is a key part. I mean, how does risk play into all of this as well?
Yeah, so risk is an interesting one. At our firm, we really look at risk through two spectrums. One is the risk you're willing to take, and the other is the risk you're able to take. And they're not necessarily the same things. And quite honestly, they're two separate things, because you can have people that have plenty of ability to take risk but no willingness, and others who have plenty of willingness to take risks and no ability. So you really have to figure out who you are as an investor and what you're able to do, and then it can flow into other areas of the diversification of your portfolio and other ways of balancing it to be in line with your specific goals.
Okay, and so can investors rebalance their position too often? Maybe even lose out on potential gains if they start to do this?
For sure. Our belief and what the studies would suggest is quarterly is a good cadence for rebalancing. If you look at quarterly, it prevents you, once you figure out your overall balance and your diversification that you're looking through, keeping we like quarterly rebalancing at our firm, prevents you from getting out of whack from a 60-40 portfolio, because our analysis and your goal suggests that's where we need to be, from drifting to an 80-20 and now being exposed. And what we've seen the past couple of days is it's not a fun thing to look in the mirror or call your advisor and have them say, oh, wait, you got unnecessarily beat down the past few days because we weren't diligent in keeping you aligned. So too often, I think anything short of quarterly is probably a bit excessive. I've seen monthly, I've seen annually. Our favorite is by far quarterly at our firm.
Right. Okay. And then you said to look at equities versus bonds and how you're doing this diversification, but it's not just equities, right? There's details within these equities and bonds. There's details. There's different types of bonds. Tell me about when you're talking about equities versus bonds.
Yeah. So when you talk about equities, you're really talking about the overall diversification, which falls into many categories. You're going to look U.S. versus domestic, or domestic versus international. You're going to look within that large companies and small companies, active managers and passive, growth and value. So you really have to be on top of figuring out the right amount of exposure to all these different elements of the global equity market. And not enough people like promise you I'm not sitting in the dark. Stocks when, quite frankly, a higher percentage of the largest stocks in the world are international. So shadowy here, very strange. But anyway, so we'll do a quick close here on the market. It's absolutely a cool day. Part of the reason why I have non-much trading and given a lot of commentary, it's just been absolutely brutal. From what I understand, it's the worst day in the Dow since spreading that risk out. Are you going short or long your duration? January, so like January 27th, something like that. Brutal day in the Nasdaq as well, probably the worst day at least since early March when things went satellite is more of our approach when we look at definitely the lowest point in the Nasdaq since March. Since late March, it looks like since March 25th, when it was below 13,000. Today the low is at 13,002. Above 13,000, which is great. That makes sense. The arcing corrections pose the Nasdaq, which did actually hit an all-time high just on April 26th, so 2 weeks ago. But the Nasdaq has definitely been continuing to trend upwards. Just has taken 3 really, I guess, interesting day to be here. 10th was kind of an interesting day because it opened pretty high but ended lower than it started. So like halfway through the day, or early halfway, I guess the Dow and the S&P were actually all-time highs, and it all went down. So the Nasdaq is crap. We also saw Ethereum, Bitcoin, basically all of Bitcoin taking a pretty early run this morning, market and all-time high 4,400 earlier this morning. So yeah, in the last hour and a half, things have kind of gone back up. As you can see, there's a high of Ethereum 440 or 4,400 at 9:30 this morning, and then in an all-time day low at 9640 around 2 o'clock. And then here in the last probably 2 hours, it has well, it's really a little is really critical to
nearly 2
keeping as much of your
It's
money as
bounced back up to
possible.
4,100.
So it's as important to make it as it is
Coin.
to keep it.
Litecoin,
Andrew
Dogecoin,
Rosen, good way to end that.
you're all
Thank you
making
very
a
much.
little bit
Andrew Rosen,
back here.
President, Partner,
The big news, I
Diversified
think, is the
Lifelong
Treasury
Advisors. Thank you.
has gone
Thanks
up.
for having me.
Coming up
He's
next,
playing around with
Scott
coming up to
Durfee is
last
standing by with TD Ameritrade to join us
very
to
big jump,
discuss opportunity costs
4.37%,
and key
up
considerations
to
for your
1.695.
long-term portfolio. You don't want to miss it. Keep it right here. It's ahead on Market Overtime.
So really interest rate. 12 ago, it was up 1.7, so it's the highest it's been since then. Well, actually, 1.67. I want to say it hit 1.7 today, very briefly. Didn't hit 1.65, but that's actually March 31st. So, things were really cooling off there. We probably need someone like Jerome Powell to come out and make a big speech tomorrow. He's a couple of times marks. Man, just an all-around bad day. Not a whole lot of good thing again. Lumber down again for I believe the 4th day in a row. It's not making massive.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I don't want any trade minimums.
Yeah, I totally agree. They don't have any of those.
I want to know what I'm paying up front.
Yes, absolutely.
Do you just say yes to everything?
Down 14%.
Say no to kale.
Building houses 14% cheaper than it was on Monday, so that's good.
Now
But
offering
it's still
0 commissions on online trades. We charge you less, so you have more to
14% is
invest.
what's up. So not a whole lot of good today. Let's see if what was positive. Oil was positive. So you see it was up. Energy transfer was up. It's down after hours. And AMC.
This is my headquarters.
So we've had AMC on the
is where I trade
today.
and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets.
Only thing.
Okay. I'm plugged into equities. Trade confirmed.
Which is that.
And I have global access 24/7, meaning I can do what I need to do. Then
So
I can focus on what I want to do.
dollar for dollar correlated, but
Visit your online broker today to learn more.
today is, or right now, I should say, it's trading at 65.72. So that's trading at 65.90.
Welcome back to Market Overtime. I'm Nicole Petalides live in New York. Thanks for being with us. How can opportunity cost impact your long-term portfolio? Scott Durfee is with us, contributor for TD Ameritrade Network. He's here to explain. Let's start with what exactly is opportunity cost?
We had a high earlier.
That's a big question and extremely important question to answer, especially right now, Nicole. With the things that are going on today, and you and Kevin were talking about it a minute ago, and it just everything that's happening in the market really can create a little bit of a sense of uncertainty and various things like that. But especially when it comes to opportunity costs. So first off, opportunity cost simply means that it's actually the process of choosing one investment or another that would have been more profitable. And it's a very difficult concept to pin down because there's literally thousands of investments that an investor or a trader could make. So you really do need to consider those 4 things.
Bad day, then good day, and bad day.
Yeah,
bad days
absolutely. So
absolutely
let's get into these
good
4 key
days.
considerations for opportunity cost in a long-term portfolio. I'm glad you
That's
broke it down
we're getting through
into
it.
bullet points for us so we can take some notes.
Bright and sunshine, I think, when we're
these are important bullet points to consider too, Nicole. The first one is we just have to avoid
how much
analysis
Zoom
paralysis.
is actually
That's a
making.
term that we
I think we're all expecting Zoom to be
it's an extremely important one to consider.
Right now,
If we are
because
just
everyone
so
cancels
busy
their accounts.
considering what
They're
could be,
going to
what
prove
should be, what could
happening.
be, and shoulda, woulda,
I think
coulda
will
on every one of our investments before we make
It will
investment,
go back up to
sometimes we just get frozen and are not able to make any decision.
Probably
And
not.
that
I
can,
wish
in and of
I wish I had
itself,
sold
may be one of the
shares
biggest
when it's
opportunity
portfolio.
costs that we have to our long-term
February,
portfolios. Now, you
I
were just
sold them
talking
at a time
about
which I considered
portfolio
very
allocation
good.
with your last
I didn't
segment.
sell them
And
because
that's
I
the
expected
most
the next
important
day
component when
stocks
it
to go
comes
up, and it's
to
not. The next day was
opportunity cost avoidance.
if we have a plan, we need to know what that plan is, what the balancing should look like. Should I be 60-40? Should I be 70-30? Or whatever the case may be, depending on your time horizon, your goals, etc. Then we just need to stick to the plan. We need to know that there will be investments that outperform what we do, but we just need to stick to the plan. Except we do need to make sure that we are rebalancing on a regular basis. That's really the key to making sure that we stay in flow with in momentum with where we're headed with our goal on our portfolio is the rebalancing. And then we need to remember opportunity cost is a function of time. Hanging on to something just because it was part of our plan and we've gone through several rebalancing processes and it's still not up to snuff or where we expected it to be, we need to be able to make a decision and execute that decision at that time rather than just hang on to it. I mean, look at many of the different things that we could have invested in over the last little while. And you can see that there's been some things, even within certain sectors and so forth, that have way outperformed others. And we just need to keep those things in mind, in the forefront, but not get too caught up in it.
Okay, so what's the bottom line here? Because I always think of opportunity costs when someone says that is when you hold on to this losing stock and just keep holding on to it. It's like, okay, opportunity cost. You tried it, didn't work, get out, right?
Yeah, get out. Opportunity cost should never be a prime consideration because it can lead you to take more risk than you should in an effort to get the highest possible return. And at the same time, it's good to keep the concept in mind in order to keep your opportunity costs at a reasonable minimum. So, it's all balance. We talk about balance in everything that we do in our lives, in the market and everything else. And this is a key indicator as to one of the things that we really do need to keep in balance.
Yeah, Scott, it's great to chat with you about this. Such an important topic.
Let me
go out to. Thanks so much, Scott Durfee, contributor, TD Ameritrade.
Let me look it up here.
Now, for you long-term investors, how can you avoid the volatility effect?
We'll go out
John
to the
Tennison's with us,
180.
Vice President, Chief Investment Officer,
Okay, it wasn't
Warrior,
March 1st.
to talk about this because
Yeah,
we're
March
looking at
1st. So
long-term investing, right?
I
And
have
it's
a
all
pretty good
about your
feeling
planning. But why
they
is
are going to also
volatility
again
such
see just
an
absolutely
issue
blow
for
out,
so
just
many?
like they did then.
Well, it's an
And
issue
honestly,
for
just
so
like they did
many
then,
because all the behavioral finance
they
that's been
nearly
coming out
doubled.
recently. I mean, I think a lot of us know the work well of Danny Kahneman.
Actual, this was
We all know that we're
September. I
predisposed to
think
make
they
the wrong decisions at the wrong
cool
time,
off.
and
They
we're
just went
particularly
crazy.
vulnerable to that when markets
So
get volatile, right? We just have
we
this.
should
We
be
want to make
like
ourselves
a
safer,
year.
and the idea is that if we get
It was
out of the market,
earlier on the
if we
first.
sell out,
So
we'll
the
become
second,
safer.
June
When in
2nd,
reality, we may well be
2008,
increasing the risk, but we're
crushed
not going to
earnings.
achieve our long-term
They were
goals.
129.
As I was listening to your last two guests, I was nodding along
This
with
was a
them.
huge
This
one,
idea
right? After
of
every
having a
earnings
plan
call, they
and
absolutely
sticking
crushed
to
it.
it. If
This
that's
went
what you
from
can do, you really can
19
turn
up to
volatility
29,
into your friend,
16
right? You create these
where it had gone
opportunities
up to
where
588
whatever
after
asset
that.
it is that is,
Then
having
this was
experiencing
one of the
downside
weird stocks that
volatility,
actually went up a lot
you're a
in
buyer.
October when a lot of other things were going down.
So,
And it went
so
down in
often
November when other
investors
things were going
turn to
up.
safety during
And then it,
volatility. But
after
how can
hours
investors
crushed it,
stay?
and then the
Is
next
that a
day went
trap
down.
or
And it's the
right?
same
I
thing
mean,
here.
you
After
tell
hours
me because that's
crushed it
something
and
that's
then
on your
went down.
radar.
But that was on June 1st.
Yeah,
The next
and I think
earnings
it
call
just
I
goes
mentioned
back to this idea that
be June
probably one of
1st.
the
Sorry,
most
that was
persistent
March 1st. The
things that
next one
we
should have been June
see
1st. And
in
then after
markets is that
they were
lower
they're
prices
gonna blow it out of the
typically
water.
mean higher expected returns in the future. Sometimes you have to
And
wait a little
I'm
while for that,
hoping that
but
that
that's the
provides
reason to
some
be
sort of catalyst
systematic about how
that
you go about
we're going to
rebalancing.
see
All of the comments that you heard in the last two segments,
things
we
like
want to be very
Twilio,
systematic about it, in
Peloton,
part
and
because we know as humans we have
some
a
of those
tendency to,
stocks
as you
are
mentioned, maybe hold on to the loser a little too long, hold on to the winner a little
people
too
going
long.
back to the
So if
office.
we're more systematic about that,
They're not going
in
to
a
die with the band.
long-term plan,
And if
it really
that
gives
gets
us
back
the
up to
ability
$40 a share, which
to
very well
to
could,
see that
then
volatility coming
yeah,
and
I might
know that we
drop
have a
back
plan
to
in
stuff
place,
weird
right?
because
Know that
I think we're still going to
that
see this
volatility can
emotional
become our
reaction
friend
like for the
and
next
we
year
can basically
of
trade
things
into it to our advantage.
spiking up and then dying down, spiking up
Yeah.
and dying
Talk
down until we
about
get to the
controlling,
where
you
we're
know, you
completely
can only
figured
control what you
out.
can control.
We can really
And
assess
one
what's
thing you
going to happen
can
with these
control, you
over
can't
these
know the
things.
ups and downs of the market,
Anyway,
right? Try to
guys, we're
time
going
it
to
is sort
sign
of
out for
silly, but
today.
dollar cost
Let's all just sleep tight tonight and hope for a better day tomorrow. Sound good?
Volatility
I think that's what I'm gonna do. You can do what you want.
That's exactly right. And if you're entering the
Anyway,
market
guys,
with